Section 22 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 6. Citigroup Invited Regulatory Scrutiny. As subprime originations grew, Citigroup decided to expand, with troubling consequences. Barely a year after the Gramm-Leach-Bliley Act validated its 1998 merger with Travelers, Citigroup made its next big move. In September 2000, it paid $31 billion for Associates First, then the second largest subprime lender in the country after household finance. Such a merger would usually have required approval from the Federal Reserve and the other bank regulators, because Associates First owned three small banks in Utah, Delaware, and South Dakota. But because these banks were specialized, a provision tucked away in Gramm-Leach-Bliley kept the Fed out of the mix. The OCC, FDIC, and New York State bank regulators reviewed the deal. Consumer groups fought it, citing a long record of alleged lending abuses by Associates First, including high prepayment penalties, excessive fees, and other opaque charges in loan documents, all targeting unsophisticated borrowers who typically could not evaluate the forms. Quote, "It's simply unacceptable to have the largest bank in America take over the icon of predatory lending," unquote, said Martin Eakes, founder of a nonprofit community lender in North Carolina. Advocates for the merger argued that a large bank under a rigorous regulator could reform the company, and Citigroup promised to take strong actions. Regulators approved the merger in November 2000, and by the next summer, Citigroup had started suspending mortgage purchases from close to two-thirds of the brokers and half the banks that had sold loans to Associates First. Quote, "We were aware that brokers were at the heart of that public discussion and were at the heart of a lot of the controversial cases," unquote, said Pam Flaherty, a Citigroup senior vice president for community relations and outreach. The merger exposed Citigroup to enhanced regulatory scrutiny. In 2001, the Federal Trade Commission, which regulates independent mortgage companies' compliance with consumer protection laws, launched an investigation into Associates First's pre-merger business and found that the company had pressured borrowers to refinance into expensive mortgages and to buy expensive mortgage insurance. In 2002, Citigroup reached a record $215 million civil settlement with the FTC over Associates' quote, "systematic and widespread deceptive and abusive lending practices," unquote. In 2001, the New York Fed used the occasion of Citigroup's next proposed acquisition, European American Bank on Long Island, New York, to launch its own investigation of Citi Financial, which now contained Associates First. Quote, "The manner in which Citigroup approached that transaction invited regulatory scrutiny," former Fed Governor Mark Olson told the FCIC. "They bought a passel of problems for themselves, and it was at least a 2-year issue," unquote. The Fed eventually accused Citi Financial of converting unsecured personal loans, usually for borrowers in financial trouble, into home equity loans without properly assessing the borrower's ability to repay. Reviewing lending practices from 2000 and 2001, the Fed also accused the unit of selling credit insurance to borrowers without checking if they would qualify for a mortgage without it. For these violations and for impeding its investigation, the Fed in 2004 assessed $70 million in penalties. The company said it expected to pay another $30 million in restitution to borrowers. End of section 22. Section 23 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 6. Federal Rules Intended to Curb Unfair or Abusive Lending. As Citigroup was buying Associates First in 2000, the Federal Reserve revisited the rules protecting borrowers from predatory conduct. It conducted its second round of hearings on the Homeownership and Equity Protection Act, or HOEPA, and subsequently the staff offered two reform proposals. The first would have effectively barred lenders from granting any mortgage, not just the limited set of high-cost loans defined by HEPA, solely on the value of the collateral and without regard to the borrower's ability to repay. For high-cost loans, the lender would have to verify and document the borrower's income and debt. For other loans, the documentation standard was weaker, as the lender could rely on the borrower's payment history and the like. The staff memo explained this would mainly, quote, affect lenders who make no documentation loans, unquote. The second proposal addressed practices such as deceptive advertisements, misrepresenting loan terms and having consumers sign blank documents, actions that involve fraud, deception, or misrepresentations. Despite evidence of predatory tactics from their own hearings and from the recently released HUD Treasury report, Fed officials remained divided on how aggressively to strengthen borrower protections. They grappled with the same trade-off that the HUD Treasury report had recently noted. Quote, we want to encourage the growth in the subprime lending market, unquote, Fed Governor Edward Gramlich remarked at the Financial Services Roundtable in early 2004. Quote, but we also don't want to encourage the abuses. Indeed, we want to do what we can to stop these abuses, unquote. Fed General Counsel Scott Alvarez told the FCIC, quote, there was concern that if you put out a broad rule, you would stop things that were not unfair and deceptive because you were trying to get at the bad practices and you just couldn't think of all the details you would need. And if you did think of all the details, you'd end up writing a rule that people could get around very easily, unquote. Greenspan, too, later said that to prohibit certain products might be harmful. Quote, these and other kinds of loan products, when made to borrowers meeting appropriate underwriting standards, should not necessarily be regarded as improper, unquote, he said. Quote, and on the contrary, facilitated the national policy of making home ownership more broadly available, unquote. Instead, at least for certain violations of consumer protection laws, he suggested another approach, quote, if there is egregious fraud, if there is egregious practice, one doesn't need supervision and regulation. What one needs is law enforcement, unquote. But the Federal Reserve would not use the legal system to rein in predatory lenders. From 2000 to the end of Greenspan's tenure in 2006, the Fed referred to the Justice Department only 3 institutions for fair lending violations related to mortgages. First American Bank in Carpentersville, Illinois, Desert Community Bank in Victorville, California, and the New York branch of Société Générale, a large French bank. Fed officials rejected the staff proposals. After some wrangling, in December 2001, the Fed did modify HOEPA, but only at the margins. Explaining its actions, the board highlighted compromise. Quote, the final rule is intended to curb unfair or abusive lending practices without unduly interfering with the flow of credit, creating unnecessary creditor burden, or narrowing consumers' options in legitimate transactions, unquote. The status quo would change little. Fed economists had estimated the percentage of subprime loans covered by HOEPA would increase from 9% to as much as 38% under the new regulations. But lenders changed the terms of the loans to avoid the new rules' revised interest rate and fee triggers. By late 2005, it was clear that the new regulations would end up covering only about 1% of subprime loans. Nevertheless, reflecting on the Federal Reserve's efforts, Greenspan contended in an FCIC interview that the Fed had developed a set of rules that have held up to this day. This was a missed opportunity. says FDIC Chairman Sheila Bair, who described the one bullet that might have prevented the financial crisis. Quote, I absolutely would have been over at the Fed writing rules prescribing mortgage lending standards across the board for everybody, bank and non-bank, that you cannot make a mortgage unless you have documented income that the borrower can repay the loan, unquote. The Fed held back on enforcement and supervision, too. While discussing HOEPA rule changes in 2000, the staff of the Fed's Division of Consumer and Community Affairs also proposed a pilot program to examine lending practices at bank holding companies' non-bank subsidiaries, such as Citi Financial and HSBC Finance, whose influence in the subprime market was growing. The non-bank subsidiaries were subject to enforcement actions by the Federal Trade Commission, while the banks and thrifts were overseen by their primary regulators. As the holding company regulator, the Fed had the authority to examine non-bank subsidiaries for, quote, compliance with the Bank Holding Company Act or any other federal law that the board has specific jurisdiction to enforce, unquote. However, the consumer protection laws did not explicitly give the Fed enforcement authority in this area. The Fed resisted routine examinations of these companies, and despite the support of Fed Governor Gramlich, the initiative stalled. Sandra Braunstein, then a staff member at the Fed's Consumer and Community Affairs Division and now its director, told the FCIC that Greenspan and other officials were concerned that routinely examining the non-bank subsidiaries could create an uneven playing field because the subsidiaries had to compete with the independent mortgage companies over which the Fed had no supervisory authority, although the Fed's HOEPA rules applied to all lenders. In an interview with the FCIC, Greenspan went further, arguing that with or without a mandate, the Fed lacked sufficient resources to examine the non-bank subsidiaries. Worse, the former chairman said, inadequate regulation sends a misleading message to the firms and the market. If you examine an organization incompletely, it tends to put up a sign in their window that it was examined by the Fed. And partial supervision is dangerous because it creates a good housekeeping stamp. But if resources were the issue, the Fed chairman could have argued for more. The Fed draws income from interest on the Treasury bonds it owns, so it did not have to ask Congress for appropriations. It was always mindful, however, that it could be subject to a government audit of its finances. In the same FCIC interview, Greenspan recalled that he sat in countless meetings on consumer protection, but that he couldn't pretend to have the kind of expertise on this subject that the staff had. Gramlich, who chaired the Fed's Consumer Subcommittee, favored tighter supervision of all subprime lenders, including units of banks, thrifts, bank holding companies, and state-chartered mortgage companies. He acknowledged that because such oversight would extend Fed authority to firms, such as independent mortgage companies, whose lending practices were not subject to routine supervision, the change would require congressional legislation, quote, and might antagonize the states, unquote. But without such oversight, the mortgage business was, quote, like a city with a murder law, but no cops on the beat, unquote. In an interview in 2007, Gramlich told the Wall Street Journal that he privately urged Greenspan to clamp down on predatory lending. Greenspan demurred, and, lacking support on the board, Gramlich backed away. Gramlich told the Journal, quote, he was opposed to it, so I did not really pursue it, unquote. Gramlich died in 2008 of leukemia at age 68. The Fed's failure to stop predatory practices infuriated consumer advocates and some members of Congress. Critics charged that accounts of abuses were brushed off as anecdotal. Patricia McCoy, a law professor at the University of Connecticut, who served on the Fed's Consumer Advisory Council between 2002 and 2004, was familiar with the Fed's reaction to stories of individual consumers. Quote, "That is classic Fed mindset," said McCoy. "If you cannot prove that it is a broad-based problem that threatens systemic consequences, then you will be dismissed," unquote. It frustrated Margot Saunders of the National Consumer Law Center. Quote, "I stood up at a Fed meeting in 2005 and said, 'How many anecdotes makes it real? How many tens of thousands of anecdotes will it take to convince you that this is a trend?'" Unquote. The Fed's reluctance to take action trumped the 2000 HUD Treasury report and reports issued by the General Accounting Office in 1999 and 2004. The Fed did not begin routinely examining subprime subsidiaries until a pilot program in July 2007 under new chairman Ben Bernanke. The Fed did not issue new rules under HOEPA until July 2008, a year after the subprime market had shut down. These rules banned deceptive practices in a much broader category of, quote, "higher-priced mortgage loans," unquote. Moreover, they prohibited making those loans without regard to the borrower's ability to pay, and required companies to verify income and assets. The rules would not take effect until October 1, 2009, which was too little, too late. Looking back, Fed General Counsel Alvarez said his institution succumbed to the climate of the times. He told the FCIC, quote, "The mindset was that there should be no regulation. The market should take care of policing, unless there already is an identified problem. We were in the reactive mode because that's what the mindset was of the 90s and the early 2000s, unquote. The strong housing market also reassured people. Alvarez noted the long history of low mortgage default rates and the desire to help people who traditionally had few dealings with banks become homeowners. End of section 23. Section 24 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. States' longstanding position. As the Fed balked, many states proceeded on their own, enacting mini HEPA laws and undertaking vigorous enforcement. They would face opposition from two federal regulators, the OCC and the OTS. In 1999, North Carolina led the way, establishing a fee trigger of 5%. That is, for the most part, any mortgage with points and fees at origination of more than 5% of the loan qualified as high-cost mortgage, subject to state regulations. This was considerably lower than the 8% set by the Fed's 2001 HEPA regulations. Other provisions addressed an even broader class of loans, banning prepayment penalties for mortgage loans under $150,000 and prohibiting repeated refinancing, known as loan flipping. These rules did not apply to federally chartered thrifts. In 1996, the Office of Thrift Supervision reasserted its longstanding position that its regulations, quote, "occupy the entire field of lending regulation for federal savings associations, leaving no room for state regulation," unquote. Exempting states from, quote, "a hodgepodge of conflicting and overlapping state lending requirements," unquote, the OTS said. Note, the phrase exempting states is in the printed copy, but it must be a typographical error and must instead read exempting thrifts. Returning to the text, would let thrifts deliver, quote, "low-cost credit to the public free from undue regulatory duplication and burden," unquote. Meanwhile, the elaborate network of federal borrower protection statutes would protect consumers. Nevertheless, other states copied North Carolina's tactic. state attorneys general launched thousands of enforcement actions, including more than 3,000 in 2006 alone. By 2007, 29 states and the District of Columbia would pass some form of anti-predatory lending legislation. In some cases, two or more states teamed up to produce large settlements. In 2002, for example, a suit by Illinois, Massachusetts, and Minnesota recovered more than $50 million from First Alliance Mortgage Company, even though the firm had filed for bankruptcy. Also that year, Household Finance, later acquired by HSBC, was ordered to pay $484 million in penalties and restitution to consumers. In 2006, a coalition of 49 states and the District of Columbia settled with AmeriQuest for $325 million and required the company to follow restrictions on its lending practices. As we will see, however, these efforts would be severely hindered with respect to national banks when the OCC in 2004 officially joined the OTS in constraining states from taking such actions. Quote, "The federal regulators' refusal to reform predatory practices and products served as an implicit endorsement of their legality," unquote. Illinois Attorney General Lisa Madigan testified to the commission. End of section 24. Section 25 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Community lending pledges. Quote, "What we do is reaffirm our intention," unquote. While consumer groups unsuccessfully lobbied the Fed for more protection against predatory lenders, they also lobbied the banks to invest in and loan to low and moderate income communities. The resulting promises were sometimes called CRA commitments or community development commitments. These pledges were not required under law, including the Community Reinvestment Act of 1977. In fact, they were often outside the scope of the CRA. For example, they frequently involved lending to individuals whose incomes exceeded those covered by the CRA, lending in geographic areas not covered by the CRA, or lending to minorities on which the CRA is silent. The banks would either sign agreements with community groups or else unilaterally pledge to lend to and invest in specific communities or populations. Banks often made these commitments when courting public opinion during the merger mania at the turn of the 21st century. One of the most notable promises was made by Citigroup soon after its merger with Travelers in 1998, a $115 billion lending and investment commitment, some of which would include mortgages. Later, Citigroup made a $120 billion commitment when it acquired California Federal Bank in 2002. When merging with Fleet Boston Financial Corporation in 2004, Bank of America announced its largest commitment to date, $750 billion over 10 years. Chase announced commitments of $18.1 billion and $800 billion, respectively, in its mergers with Chemical Bank and Bank One. The National Community Reinvestment Coalition, an advocacy group, eventually tallied more than $4.5 trillion in commitments from 1977 to 2007. Mortgage lending made up a significant portion of them. Although banks touted these commitments in press releases, the NCRC says it and other community groups could not verify this lending happened. The FCIC sent a series of requests to Bank of America, J.P. Morgan, Citigroup, and Wells Fargo, the nation's 4 largest banks, regarding their CRA and community lending commitments. In response, the banks indicated they had fulfilled most promises. According to the documents provided, the value of commitments to community groups was much smaller than the larger unilateral pledges by the banks. Further, the pledges generally covered broader categories than did the CRA, including mortgages to minority borrowers and to borrowers with up to median income. For example, only 22% of the mortgages made under JP Morgan's $800 billion Community Development Initiative would have fallen under the CRA. Bank of America, which would count all low and moderate income and minority lending as satisfying its pledges, stated that just over half were likely to meet CRA requirements. Many of these loans were not very risky. This was not surprising, because such broad definitions necessarily included loans to borrowers with strong credit histories. Low income and weak or subprime credit are not the same. In fact, Citigroup's 2002 pledge of $80 billion in mortgage lending consisted of entirely prime loans to low and moderate income households, low and moderate income neighborhoods, and minority borrowers. These loans performed well. J.P. Morgan's largest commitment to a community group was to the Chicago CRA Coalition, $12 billion in loans over 11 years. Of loans issued between 2004 and 2006, fewer than 5% have been 90 or more days delinquent, even as of late 2010. Wachovia made $12 billion in mortgage loans between 2004 and 2006 under its $100 billion in unilateral pledges. Only about 7.3% were ever more than 90 days delinquent over the life of the loan, compared with an estimated national average of 14%. The better performance was partly the result of Wachovia's lending concentration in the relatively stable Southeast, and partly a reflection of the credit profile of many of these borrowers. During the early years of the CRA, the Federal Reserve Board, when considering whether to approve mergers, gave some weight to commitments made to regulators. This changed in February 1989, when the board denied Continental Bank's application to merge with Grand Canyon State Bank, saying the bank's commitment to improve community service could not offset its poor lending record. In April 1989, the FDIC, OCC, and Federal Home Loan Bank Board, the precursor of the OTS, joined the Fed in announcing that commitments to regulators about lending would be considered only when addressing specific problems in an otherwise satisfactory record. Internal documents and its public statements show the Fed never considered pledges to community groups in evaluating mergers and acquisitions, nor did it enforce them. As Glenn Loney, a former Fed official, told Commission staff, quote, "At the very beginning, we said we were not going to be in a posture where the Fed's going to be sort of coercing banks into making deals with community groups so that they can get their applications through," unquote. In fact, the rules implementing the 1995 changes to the CRA made it clear that the Federal Reserve would not consider promises to third parties or enforce prior agreements with those parties. The rules state, quote, "An institution's record of fulfilling these types of agreements with third parties is not an appropriate CRA performance criterion," unquote. Still, the banks highlighted past acts and assurances for the future. In 1998, for example, when Nations Bank said it was merging with Bank America, it also announced a 10-year, $350 billion initiative that included pledges of $115 billion for affordable housing, $30 billion for consumer lending, $180 billion for small businesses, and $25 and $10 billion for economic and community development, respectively. This merger was perhaps the most controversial of its time because of the size of the two banks. The Fed held 4 public hearings and received more than 1,600 comments. Supporters touted the community investment commitment, while opponents decried its lack of specificity. The Fed's internal staff memorandum recommending approval repeated the Fed's insistence on not considering these promises. Quote, The board considers CRA agreements to be agreements between private parties and has not facilitated, monitored, judged, required, or enforced agreements or specific portions of agreements. Nations Bank remains obligated to meet the credit needs of its entire community, including low and moderate income areas with or without private agreements, unquote. In its public order approving the merger, the Federal Reserve mentioned the commitment, but then went on to state that, quote, an applicant must demonstrate a satisfactory record of performance under the CRA without reliance on plans or commitments for future action. The board believes that the CRA plan, whether made as a plan or as an enforceable commitment, has no relevance in this case without the demonstrated record of performance of the companies involved, unquote. So, were these commitments a meaningful step or only a gesture? Lloyd Brown, a managing director at Citigroup, told the FCIC that most of the commitments would have been fulfilled in the normal course of business. Speaking of the 2007 merger with Countrywide, Andrew Plepper, head of Global Corporate Social Responsibility at Bank of America, told the FCIC, quote, at a time of mergers, there's a lot of concern sometimes that 1 + 1 will not equal 2 in the eyes of communities where the acquired bank has been investing. So what we do is reaffirm our intention to continue to lend and invest so that the communities where we live and work will continue to economically thrive, unquote. He explained further that the pledge amount was arrived at by working closely with our business partners, who project current levels of business activity that qualifies toward community lending goals into the future to assure the community that past lending and investing practices will continue. In essence, banks promised to keep doing what they had been doing, and community groups had the assurance that they would. End of section 25. Section 26 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Bank Capital Standards, Arbitrage. Although the Federal Reserve had decided against stronger protections for consumers, it internalized the lessons of 1998 and 1999 when the first generation of subprime lenders put themselves at serious risk. Some, such as Keystone Bank and Superior Bank, collapsed when the values of the subprime securitized assets they held proved to be inflated. In response, the Federal Reserve and other regulators reworked the capital requirements on securitization by banks and thrifts. In October 2001, they introduced the recourse rule, governing how much capital a bank needed to hold against securitized assets. If a bank retained an interest in a residual tranche of a mortgage security, as Keystone, Superior, and others had done, it would have to keep $1 in capital for every dollar of residual interest. That seemed to make sense since the bank, in this instance, would be the first to take losses on the loans in the pool. Under the old rules, banks held only 8% in capital to protect against losses on residual interests and any other exposures they retained in securitizations. Keystone and others had been allowed to seriously understate their risks and to not hold sufficient capital. Ironically, because the new rule made the capital charge on residual interests 100%, it increased banks' incentive to sell the residual interests in securitizations, so that they were no longer the first to lose when the loans went bad. The recourse rule also imposed a new framework for asset-backed securities. The capital requirement would be directly linked to the rating agency's assessment of the tranches. Holding securities rated AAA or AA required far less capital than holding lower-rated investments. For example, $100 invested in AAA or AA mortgage-backed securities required holding only $1.60 in capital, the same as for securities backed by government-sponsored enterprises. But the same amount invested in anything with a BB rating required $16 in capital, or 10 times more. Banks could reduce the capital they were required to hold for a pool of mortgages simply by securitizing them, rather than holding them on their books as whole loans. If a bank kept $100 in mortgages on its books, it might have to set aside about $5, including $4 in capital against unexpected losses and $1 in reserves against expected losses. But if the bank created a $100 mortgage-backed security, sold that security in tranches, and then bought all the tranches, the capital requirement would be about $4.10. Quote, regulatory capital arbitrage does play a role in bank decision-making, unquote, said David Jones, a Fed economist who wrote an article about the subject in 2000 in an FCIC interview. But, quote, it is not the only thing that matters, unquote. And a final comparison. Under bank regulatory capital standards, a $100 AAA corporate bond required $8 in capital, 5 times as much as the AAA mortgage-backed security. Unlike the corporate bond, it was ultimately backed by real estate. The new requirements put the rating agencies in the driver's seat. How much capital a bank held depended in part on the ratings of the securities it held. Tying capital standards to the views of rating agencies would come in for criticism after the crisis began. It was a dangerous crutch, former Treasury Secretary Henry Paulson testified to the commission. However, the Fed's Jones noted it was better than the alternative, to let the banks rate their own exposures. That alternative would be terrible, he said, noting that banks had been coming to the Fed and arguing for lower capital requirements on the grounds that the rating agencies were too conservative. Meanwhile, banks and regulators were not prepared for significant losses on AAA mortgage-backed securities, which were, after all, supposed to be among the safest investments. Nor were they prepared for ratings downgrades due to expected losses, which would require banks to post more capital. And were downgrades to occur at the moment the banks wanted to sell their securities to raise capital, there would be no buyers. All these things would occur within a few years. End of section 26. End of chapter 6. Section 27 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 6. The Commission concludes that there was untrammeled growth in risky mortgages. Unsustainable toxic loans polluted the financial system and fueled the housing bubble. Subprime lending was supported in significant ways by major financial institutions. Some firms, such as Citigroup, Lehman Brothers, and Morgan Stanley, acquired subprime lenders. In addition, major financial institutions facilitated the growth in subprime mortgage lending companies with lines of credit, securitization, purchase guarantees, and other mechanisms. Regulators failed to rein in risky home mortgage lending. In particular, the Federal Reserve failed to meet its statutory obligation to establish and maintain prudent mortgage lending standards and to protect against predatory lending. End of section 27. End of chapter 6. Section 28 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 7. The Mortgage Machine. In 2004, commercial banks, thrifts, and investment banks caught up with Fannie Mae and Freddie Mac in securitizing home loans. By 2005, they had taken the lead. The two government-sponsored enterprises maintained their monopoly on securitizing prime mortgages below their loan limits. But the wave of home refinancing by prime borrowers, spurred by very low, steady interest rates, petered out. Meanwhile, Wall Street focused on the higher yield loans that the GSEs could not purchase and securitize, loans too large, called jumbo loans, and non-prime loans that didn't meet the GSE standards. The non-prime loans soon became the biggest part of the market. Subprime loans for borrowers with weak credit, and Alt-A loans with characteristics riskier than prime loans to borrowers with strong credit. By 2005 and 2006, Wall Street was securitizing 1/3 more loans than Fannie and Freddie. In just 2 years, private label mortgage-backed securities had grown more than 30%, reaching $1.15 trillion in 2006. 71% were subprime or Alt-A. Many investors preferred securities highly rated by the rating agencies, or were encouraged or restricted by regulations to buy them. And with yields low on other highly rated assets, investors hungered for Wall Street mortgage securities backed by higher yield mortgages. Those loans made to subprime borrowers, those with non-traditional features, those with limited or no documentation, no doc loans, or those that failed in some other way to meet strong underwriting standards. Securitization could be seen as a factory line. Former Citigroup CEO Charles Prince told the FCIC, quote, "As more and more and more of these subprime mortgages were created as raw material for the securitization process, not surprisingly in hindsight, more and more of it was of lower and lower quality. And at the end of that process, the raw material going into it was actually bad quality. It was toxic quality. And that is what ended up coming out the other end of the pipeline. Wall Street obviously participated in that flow of activity," unquote. The origination and securitization of these mortgages also relied on short-term financing from the shadow banking system. Unlike banks and thrifts with access to deposits, investment banks relied more on money market funds and other investors for cash. Commercial paper and repo loans were the main sources. With house prices already up 91% from 1995 to 2003, this flood of money and the securitization apparatus helped boost home prices another 36%. From the beginning of 2004 until the peak in April 2006, even as home ownership was falling. The biggest gains over this period were in the Sand States, places like the Los Angeles suburbs, 54%, Las Vegas, 36%, and Orlando, 72%. Foreign investors, an irresistible profit opportunity. From June 2003 through June 2004, the Federal Reserve kept the federal funds rate low at 1% to stimulate the economy following the 2001 recession. Over the next 2 years, as deflation fears waned, the Fed gradually raised rates to 5.25% in 17 quarter-point increases. In the view of some, the Fed simply kept rates too low, too long. John Taylor, a Stanford economist and former Undersecretary of Treasury for International Affairs, blamed the crisis primarily on this action. If the Fed had followed its usual pattern, he told the FCIC, short-term interest rates would have been much higher, discouraging excessive investment in mortgages. Quote, "The boom in housing construction starts would have been much more mild, might not even call it a boom, and the bust as well would have been mild," Taylor said. Others were more blunt. quote, Greenspan bailed out the world's largest equity bubble with the world's largest real estate bubble, wrote William A. Fleckenstein, the president of a Seattle-based money management firm. Ben Bernanke and Alan Greenspan disagree. Both the current and former Fed chairman argue that deciding to purchase a home depends on long-term interest rates on mortgages, not the short-term rates controlled by the Fed, and that short-term and long-term rates had become delinked. Quote, between 1971 and 2002, the Fed funds rate and the mortgage rate moved in lockstep, Greenspan said. When the Fed started to raise rates in 2004, officials expected mortgage rates to rise too, slowing growth. Instead, mortgage rates continued to fall for another year. The construction industry continued to build houses, peaking at an annualized rate of 2.27 million starts in January 2006, more than a 30-year high. As Greenspan told Congress in 2005, this was a conundrum. One theory pointed to foreign money. Developing countries were booming and, vulnerable to financial problems in the past, encouraged strong saving. Investors in these countries placed their savings in apparently safe and high-yield securities in the United States. Fed Chairman Bernanke called it a global savings glut. As the United States ran a large current account deficit, flows into the country were unprecedented. Over 6 years, from 2000 to 2006, U.S. Treasury debt held by foreign official public entities rose from $0.6 trillion to $1.43 trillion. As a percentage of U.S. debt held by the public, these holdings increased from 18.2% to 28.8%. Foreigners also bought securities backed by Fannie and Freddie, which, with their implicit government guarantee, seemed nearly as safe as treasuries. As the Asian financial crisis ended in 1998, foreign holdings of GSE securities held steady at the level of almost 10 years earlier, about $186 billion. By 2000, just 2 years later, foreigners owned $348 billion in GSE securities. By 2004, $875 billion. Quote, you had a huge inflow of liquidity, a very unique kind of situation where poor countries like China were shipping money to advanced countries because their financial systems were so weak that they were better off shipping money to countries like the United States rather than keeping it in their own countries. Former Fed Governor Frederick Mishkin told the FCIC, quote, the system was awash with liquidity, which helped lower long-term interest rates, unquote. Foreign investors sought other high-grade debt almost as safe as treasuries and GSE securities, but with a slightly higher return. They found the AAA assets pouring from the Wall Street mortgage securitization machine. As overseas demand drove up prices for securitized debt, it, quote, created an irresistible profit opportunity for the U.S. financial system to engineer quasi-safe debt instruments by bundling riskier assets and selling the senior tranches, unquote. Pierre-Olivier Gorichas, an economist at the University of California, Berkeley, told the FCIC. Paul Krugman, an economist at Princeton University, told the FCIC, quote, it's hard to envisage us having had this crisis without considering international monetary capital movements. The U.S. housing bubble was financed by large capital inflows. So were Spanish and Irish and Baltic bubbles. It's a combination of, in the narrow sense, of a less regulated financial system and a world that was increasingly wide open for big international capital movements, unquote. It was an ocean of money. End of section 28. Section 29 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Mortgages, a good loan. The refinancing boom was over, but originators still needed mortgages to sell to the street. They needed new products that, as prices kept rising, could make expensive homes more affordable to still eager borrowers. The solution was riskier, more aggressive mortgage products that brought higher yields for investors, but correspondingly greater risks for borrowers. Quote, holding a subprime loan has become something of a high-stakes wager, the Center for Responsible Lending warned in 2006. Subprime mortgages rose from 8% of mortgage originations in 2003 to 20% in 2005. About 70% of subprime borrowers used hybrid adjustable rate mortgages, or ARMs, such as 228s and 327s, mortgages whose lower teaser rate lasts for the first 2 or 3 years and then adjusts periodically thereafter. Prime borrowers also used more alternative mortgages. The dollar volume of Alt-A securitization rose almost 350% from 2003 to 2005. In general, these loans made borrowers' monthly mortgage payments on ever more expensive homes affordable, at least initially. Popular Alt-A products included interest-only mortgages and payment option ARMs. Option ARMs let borrowers pick their payment each month, including payments that actually increased the principal. Any shortfall on the interest payment was added to the principal, something called negative amortization. If the balance got large enough, the loan would convert to a fixed-rate mortgage, increasing the monthly payment, perhaps dramatically. Option ARMs rose from 2% of mortgages in 2003 to 9% in 2006. Simultaneously, underwriting standards for non-prime and prime mortgages weakened. Combined loan-to-value ratios, reflecting first, second, and even third mortgages, rose. Debt-to-income ratios climbed, as did loans made for non-owner-occupied properties. Fannie Mae and Freddie Mac's market share shrank from 57% of all mortgages purchased in 2003 to 42% in 2004 and down to 37% by 2006. Taking their place were private label securitizations, meaning those not issued and guaranteed by the GSEs. In this new market, originators competed fiercely. Countrywide Financial Corporation took the crown. It was the biggest mortgage originator from 2004 until the market collapsed in 2007. Even after Countrywide nearly failed, buckling under a mortgage portfolio with loans that its co-founder and CEO, Angelo Mozilo, once called toxic, Mozilo would describe his 40-year-old company to the Commission as having helped 25 million people buy homes and prevented social unrest by extending loans to minorities, historically the victims of discrimination. Quote, Countrywide was one of the greatest companies in the history of this country and probably made more difference to society, to the integrity of our society, than any company in the history of America, unquote. Lending to homebuyers was only part of the business. Countrywide's president and COO, David Samble, told the Commission, as long as a loan did not harm the company from a financial or reputation standpoint, Countrywide was, quote, a seller of securities to Wall Street, unquote. Countrywide's essential business strategy was originating what was saleable in the secondary market. The company sold or securitized 87% of the $1.5 trillion in mortgages it originated between 2002 and 2005. In 2004, Mozilo announced a very aggressive goal of gaining market dominance by capturing 30% of the origination market. His share at the time was 12%. But Countrywide was not unique. AmeriQuest, New Century, Washington Mutual, and others all pursued loans as aggressively. They competed by originating types of mortgages created years before as niche products, but now transformed into riskier mass market versions. Quote, the definition of a good loan changed from one that pays to one that could be sold, unquote. Patricia Lindsay, formerly a fraud specialist at New Century, told the FCIC. 228s and 327s adjust for the affordability. Historically, 228s or 327s, also known as hybrid ARMs, let credit-impaired borrowers repair their credit. During the first 2 or 3 years, a lower interest rate meant a manageable payment schedule and enabled borrowers to demonstrate they could make timely payments. Eventually, the interest rates would rise sharply, and payments could double or even triple, leaving borrowers with few alternatives. If they had established their creditworthiness, they could refinance into a similar mortgage or one with a better interest rate, often with the same lender. If unable to refinance, the borrower was unlikely to be able to afford the new higher payments and would have to sell the home and repay the mortgage. If they could not sell or make the higher payments, they would have to default. But as house prices rose after 2000, the 228s and 327s acquired a new role, helping to get people into homes or to move up to bigger homes. Quote, as homes got less and less affordable, you would adjust for the affordability in the mortgage because you couldn't really adjust people's income, unquote. Andrew Davidson, the president of Andrew Davidson & Co. and a veteran of the mortgage markets, told the FCIC. Lenders qualified borrowers at lower teaser rates with little thought to what might happen when rates reset. Hybrid ARMs became the workhorses of the subprime securitization market. Consumer protection groups, such as the Leadership Conference on Civil Rights, railed against 228s and 327s, which they said neither rehabilitated credit nor turned renters into owners. David Birnbaum from the National Community Reinvestment Coalition testified to Congress in the summer of 2007, quote, the industry has flooded the market with exotic mortgage lending, such as 228 and 327 ARMs. These exotic subprime mortgages overwhelm borrowers when interest rates shoot up after an introductory time period, unquote. To their critics, they were simply a way for lenders to strip equity from low-income borrowers. The loans came with big fees that got rolled into the mortgage, increasing the chances that the mortgage could be larger than the home's value at the reset date. If the borrower could not refinance, the lender would foreclose, and then own the home in a rising real estate market. Option ARMs, our most profitable mortgage loan. When they were originally introduced in the 1980s, option ARMs were niche products too. But by 2004, they too became loans of choice because their payments were lower than more traditional mortgages. During the housing boom, many borrowers repeatedly made only the minimum payments required, adding to the principal balance of their loan every month. An early seller of option ARMs was Golden West Savings, an Oakland, California-based thrift founded in 1929 and acquired in 1963 by Marion and Herbert Sandler. In 1975, the Sandlers merged Golden West with World Savings. Golden West Financial Corp., the parent company, operated branches under the name World Savings Bank. The thrift issued about $274 billion in option ARMs between 1981 and 2005. Unlike other mortgage companies, Golden West held on to them. Sandler told the FCIC that Golden West's option ARMs, marketed as pick-a-pay loans, had the lowest losses in the industry for that product. Even in 2005, the last year prior to its acquisition by Wachovia, when its portfolio was almost entirely in option ARMs, Golden West's losses were low by industry standards. Sandler attributed Golden West's performance to its diligence in running simulations about what would happen to its loans under various scenarios. For example, if interest rates went up or down, or if house prices dropped 5%, even 10%. Quote, for a quarter of a century, it worked exactly as the simulations showed that it would, Sandler said. And we have never been able to identify a single loan that was delinquent because of the structure of the loan, much less a loss or foreclosure, unquote. But after Wachovia acquired Golden West in 2006 and the housing market soured, charge-offs on the pick-a-pay portfolio would suddenly jump from 0.04% to 2.69% by September 2008, and foreclosures would climb. Early in the decade, banks and thrift, such as Countrywide and Washington Mutual, increased their origination of option ARM loans, changing the product in ways that made payment shocks more likely. At Golden West, after 10 years, or if the principal balance grew to 125% of its original size, the pick-a-pay mortgage would recast into a new fixed-rate mortgage. At Countrywide and Washington Mutual, the new loans would recast in as little as 5 years, or when the balance hit just 110% of the original size. They also offered lower teaser rates, as low as 1%, and loan-to-value ratios as high as 100%. All of these features raised the chances that the borrower's required payment could rise more sharply, more quickly, and with less cushion. In 2002, Washington Mutual was the second largest mortgage originator, just ahead of Countrywide. It had offered the option ARM since 1986, and in 2003, as cited by the Senate Permanent Subcommittee on Investigations, the originator conducted a study to explore what Washington Mutual could do to increase sales of option ARMs, our most profitable mortgage loan. A focus group made clear that few customers were requesting option ARMs, and that, quote, this is not a product that sells itself, unquote. The study found the best selling point for the option ARM was to show consumers how much lower their monthly payment would be by choosing the option ARM versus a fixed-rate loan. The study also revealed that many WAMU brokers felt these loans were bad for customers. One member of the focus group remarked, quote, a lot of loan consultants don't believe in it and don't think it's good for the customer. You're going to have to change the mindset, unquote. Despite these challenges, option ARM originations soared at Washington Mutual, from $30 billion in 2003 to $68 billion in 2004, when they were more than half of WAMU's originations and had become the thrift's signature adjustable rate home loan product. The average FICO score was around 700, well into the range considered prime, and about 2/3 were jumbo loans, mortgage loans exceeding the maximum Fannie Mae and Freddie Mac were allowed to purchase or guarantee. More than half were in California. Countrywide's option ARM business peaked at $14.5 billion in originations in the second quarter of 2005. About 25% of all its loans originated that quarter. But it had to relax underwriting standards to get there. In July 2004, Countrywide decided it would lend up to 90% of a home's appraised value, up from 80%, and reduced the minimum credit score to as low as 620. In early 2005, Countrywide eased standards again, increasing the allowable combined loan-to-value ratio, including second liens, to 95%. The risk in these loans was growing. From 2003 to 2005, the average loan-to-value ratio rose about 4%. The combined loan-to-value ratio rose about 6%, and debt-to-income ratios had risen from 34% to 38%. Borrowers were pledging more of their income to their mortgage payments. Moreover, 68% of these two originators' option ARMs had low documentation in 2005. The percentage of these loans made to investors and speculators, that is, borrowers with no plans to use the home as their primary residence, also rose. These changes worried the lenders even as they continued to make the loans. In September 2004 and August 2005, Mazzillo emailed to senior management that these loans could bring, quote, financial and reputational catastrophe, unquote. Countrywide should not market them to investors, he insisted. Quote, pay option loans being used by investors is a pure commercial speculation loan, and not the traditional home loan that we have successfully managed throughout our history, unquote, Mazzillo wrote to Carlos Garcia, CEO of Countrywide Bank. Speculative investors, quote, should go to Chase or Wells, not us. It is also important for you and your team to understand, from my point of view, that there is nothing intrinsically wrong with pay options loans themselves. The problem is the quality of borrowers who are being offered the product and the abuse by third-party originators. If you are unable to find sufficient product, then slow down the growth of the bank for the time being, unquote. However, Countrywide's growth did not slow, nor did the volume of option ARMs retained on its balance sheet, increasing from $5 billion in 2004 to $26 billion in 2005 and peaking in 2006 at $33 billion. Finding these loans very profitable, through 2006, WAMU also retained option ARMs, more than $60 billion, with the bulk from California, followed by Florida. But in the end, these loans would cause significant losses during the crisis. Mentioning Countrywide and WAMU as tough, in-our-face competitors, John Stumpf, the CEO, chairman, and president of Wells Fargo, recalled Wells's decision not to write option ARMs, even as it originated many other high-risk mortgages. These were hard decisions to make at the time, he said, noting, we did lose revenue and we did lose volume. Across the market, the volume of option ARMs had risen nearly fourfold from 2003 to 2006, from approximately $65 billion to $255 billion. By then, WAMU and Countrywide had plenty of evidence that more borrowers were making only the minimum payments and that their mortgages were negatively amortizing, which meant their equity was being eaten away. The percentage of Countrywide's option ARMs that were negatively amortizing grew from just 1% in 2004 to 53% in 2005, and then to more than 90% by 2007. At WAMU, it was 2% in 2003, 28% in 2004, and 82% in 2007. Declines in house prices added to borrowers' problems. Any equity remaining after the negative amortization would simply be eroded. Increasingly, borrowers would owe more on their mortgages than their homes were worth on the market, giving them an incentive to walk away from both home and mortgage. Kevin Stein, from the California Reinvestment Coalition, testified to the FCIC that option ARMs were sold inappropriately. Quote, nowhere was this dynamic more clearly on display than in the summer of 2006, when the Federal Reserve convened HOEPA, Home Ownership and Equity Protection Act hearings in San Francisco. At the hearing, consumers testified to being sold option ARM loans in their primary non-English language, only to be pressured to sign English-only documents with significantly worse terms. Some consumers testified to being unable to make even their initial payments because they had been lied to so completely by their brokers, unquote. Mona Tamatau, a regional counsel with Legal Services of Northern California, described the borrowers she was assisting as, quote, people who got steered or defrauded into entering option ARMs with teaser rates or pick-a-pay loans, forcing them to pay loans that they could never pay off. Prevalent among these clients are seniors, people of color, people with disabilities, and limited English speakers and seniors who are African American and Latino, unquote. Underwriting standards. We're going to have to hold our nose. Another shift would have serious consequences. For decades, the down payment for a prime mortgage had been 20%. In other words, the loan-to-value ratio, or LTV, had been 80%. As prices continued to rise, finding the cash to put 20% down became harder, and from 2000 on, lenders began accepting smaller down payments. There had always been a place for borrowers with down payments below 20%. Typically, lenders required such borrower to purchase private mortgage insurance for a monthly fee. If a mortgage ended in foreclosure, the mortgage insurance company would make the lender whole. Worried about defaults, the GSEs would not buy or guarantee mortgages with down payments below 20% unless the borrower bought the insurance. Unluckily for many homeowners, for the housing industry, and for the financial system, lenders devised a way to get rid of these monthly fees that had added to the cost of homeownership, lower down payments that did not require insurance. Lenders had latitude in setting down payments. In 1991, Congress ordered federal regulators to prescribe standards for real estate lending that would apply to banks and thrifts. The goal was to, quote, curtail abusive real estate lending practices in order to reduce risk to the deposit insurance funds and enhance the safety and soundness of insured depository institutions, unquote. Congress had debated including explicit LTV standards, but chose not to, leaving that to the regulators. In the end, regulators declined to introduce standards for LTV ratios or for documentation for home mortgages. The agencies explained, quote, a significant number of commenters expressed concern that rigid application of a regulation implementing LTV ratios would constrict credit, impose additional lending costs, reduce lending flexibility, impede economic growth, and cause other undesirable consequences, unquote. In 1999, regulators revisited the issue, as high LTV lending was increasing. They tightened reporting requirements and limited a bank's total holdings of loans with LTVs above 90% that lacked mortgage insurance or some other protection. They also reminded the banks and thrifts that they should establish internal guidelines to manage the risk of these loans. High LTV lending soon became even more common thanks to the so-called piggyback mortgage. The lender offered a first mortgage for perhaps 80% of the home's value and a second mortgage for another 10% or even 20%. Borrowers liked these because their monthly payments were often cheaper than a traditional mortgage, plus the required mortgage insurance, and the interest payments were tax-deductible. Lenders liked them because the smaller first mortgage, even without mortgage insurance, could potentially be sold to the GSEs. At the same time, the piggybacks added risks. A borrower with a high combined LTV had less equity in the home. In a rising market, should payments become unmanageable, The borrower could always sell the home and come out ahead. However, should the payments become unmanageable in a falling market, the borrower might owe more than the home was worth. Piggyback loans, which often required nothing down, guaranteed that many borrowers would end up with negative equity if house prices fell, especially if the appraisal had overstated the initial value. But piggyback lending helped address a significant challenge for companies like New Century, which were big players in the market for mortgages. Meeting investor demand required finding new borrowers, and homebuyers without down payments were a relatively untapped source. Yet among borrowers with mortgages originated in 2004, by September 2005, those with piggybacks were 4 times as likely as other mortgage holders to be 60 or more days delinquent. When senior management at New Century heard these numbers, the head of the secondary marketing department asked for, quote, thoughts on what to do with this pretty compelling, unquote, information. Nonetheless, New Century increased mortgages with piggybacks to 35% of loan production by the end of 2005, up from only 9% in 2003. They were not alone. Across securitized subprime mortgages, the average combined LTV rose from 79% to 86% between 2001 and 2006. Another way to get people into mortgages, and quickly, was to require less information of the borrower. Stated income or low documentation, or sometimes no documentation, loans had emerged years earlier for people with fluctuating or hard-to-verify incomes, such as the self-employed, or to serve long-time customers with strong credit. Or lenders might waive information requirements if the loan looked safe in other respects. Quote, if I'm making a 65%, 75%, 70% loan-to-value, I'm not going to get all of the documentation, unquote. Sandler of Golden West told the FCIC. The process was too cumbersome and unnecessary. He already had a good idea how much money teachers, accountants, and engineers made, and if he didn't, he could easily find out. All he needed was to verify that his borrowers worked where they said they did. If he guessed wrong, the loan-to-value ratio still protected his investment. Around 2005, however, low and no documentation loans took on an entirely different character. Non-prime lenders now boasted they could offer borrowers the convenience of quicker decisions and not having to provide tons of paperwork. In return, they charged a higher interest rate. The idea caught on. From 2000 to 2007, low and no doc loans skyrocketed, from less than 2% to roughly 9% of all outstanding loans. Among Alt-A securitizations, 80% of loans issued in 2006 had limited or no documentation. As William Black, a former banking regulator, testified before the FCIC, the mortgage industry's own fraud specialists described stated income loans as an open invitation to fraud, which justified the industry term liar's loans. Speaking of lending up to 2005 at Citigroup, Richard Bowen, a veteran banker in the consumer lending group, told the FCIC, quote, a decision was made that we're going to have to hold our nose and start buying the stated product if we want to stay in business, unquote. Jamie Dimon, the CEO of J.P. Morgan, told the commission, quote, in mortgage underwriting, somehow we just missed, that home prices don't go up forever, and that it's not sufficient to have stated income, unquote. In the end, companies in subprime and Alt-A mortgages had, in essence, placed all their chips on black. They were betting that home prices would never stop rising. This was the only scenario that would keep the mortgage machine humming. The evidence is present in our case study Mortgage-Backed Security, CMLTI 2006-NC2, whose loans have many of the characteristics just described. The 4,499 loans bundled in this deal were adjustable rate and fixed rate residential mortgages originated by New Century. They had an average principal balance of $210,536, just under the median home price of $221,900 in 2006. The vast majority had a 30-year maturity, and more than 90% were originated in May, June, and July 2006, just after national home prices had peaked. More than 90% were reportedly for primary residences, with 43% for home purchases and 48% for cash-out refinancings. The loans were from all 50 states and the District of Columbia, but more than a fifth came from California, and more than a tenth from Florida. About 80% of the loans were ARMs, and most of these were 228s or 327s. In a twist, many of these hybrid ARMs had other affordability features as well. For example, more than 20% of the ARMs were interest only. During the first 2 or 3 years, not only would borrowers pay a lower fixed rate, they would not have to pay any principal. In addition, more than 40% of the ARMs were 228 hybrid balloon loans, in which the principal would amortize over 40 years, lowering the monthly payments even further, but as a result, leaving the borrower with a final principal payment at the end of the 30-year term. The great majority of the pool was secured by first mortgages. Of these, 33% had a piggyback mortgage on the same property. As a result, more than 1/3 of the mortgages in this deal had a combined loan-to-value ratio between 95% and 100%. Raising the risk a bit more, 41% of the mortgages were no-doc loans. The rest were full doc, although their documentation was fuller in some cases than in others. In some, the loans bundled in this deal mirrored the market: complex products with high LTVs and little documentation. And even as many warned of this toxic mix, the regulators were not on the same page. End of section 29. Section 30 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Section 30. Federal Regulators. Immunity from many state laws is a significant benefit. For years, some states had tried to regulate the mortgage business, especially to clamp down on the predatory mortgages proliferating in the subprime market. The national thrifts and banks and their federal regulators, the Office of Thrift Supervision, OTS, and the Office of the Comptroller of the Currency, OCC, respectively, resisted the state's efforts to regulate those national banks and thrifts. The companies claimed that without one uniform set of rules, they could not easily do business across the country, and the regulators agreed. In August 2003, as the market for riskier subprime and Alt-A loans grew, and as lenders piled on more risk with smaller down payments, reduced documentation requirements, interest-only loans, and payment option loans, the OCC fired a salvo. The OCC proposed strong preemption rules for national banks, nearly identical to earlier OTS rules that empowered nationally chartered thrifts to disregard state consumer laws. Back in 1996, the OTS had issued rules saying federal law preempted state predatory lending laws for federally regulated thrifts. In 2003, the OTS referred to these rules in issuing 4 opinion letters declaring that laws in Georgia, New York, New Jersey, and New Mexico did not apply to national thrifts. In the New Mexico opinion, the regulator pronounced invalid New Mexico's bans on balloon payments, negative amortization, prepayment penalties, loan flipping, and lending without regard to the borrower's ability to repay. The comptroller of the currency took the same line on the national banks that it regulated, offering preemption as an inducement to use a national bank charter. In a 2002 speech, before the final OCC rules were passed, Comptroller John D. Hawk, Jr. pointed to, quote, national banks' immunity from many state laws, unquote, as a significant benefit of the national charter, a benefit that the OCC has fought hard over the years to preserve. In an interview that year, Hawk explained that the potential loss of regulatory market share for the OCC was a matter of concern. In August 2003, the OCC issued its first preemptive order, aimed at Georgia's mini HOEPA statute, and in January 2004, the OCC adopted a sweeping preemption rule applying to all state laws that interfered with or placed conditions on national banks' ability to lend. Shortly afterward, 3 large banks with combined assets of more than $1 trillion said they would convert from state charters to national charters, which increased OCC's annual budget 15%. State-chartered operating subsidiaries were another point of contention in the preemption battle. In 2001, the OCC had adopted a regulation preempting state law regarding state-chartered operating subsidiaries of national banks. In response, several large national banks moved their mortgage lending operations into subsidiaries and asserted that the subsidiaries were exempt from state mortgage lending laws. 4 states challenged the regulation, but the Supreme Court ruled against them in 2007. Once OCC and OTS preemption was in place, the 2 federal agencies were the only regulators with the power to prohibit abusive lending practices by national banks and thrifts and their direct subsidiaries. Comptroller John Dugan, who succeeded Hawk, defended preemption, noting that, quote, 72% of all non-prime mortgages were made by lenders that were subject to state law. Well over half were made by mortgage lenders that were exclusively subject to state law, unquote. Lisa Madigan, the Attorney General of Illinois, flipped the argument around, noting that national banks and thrifts and their subsidiaries were heavily involved in subprime lending. Using different data, she contended, quote, national banks and federal thrifts and their subsidiaries were responsible for almost 32% of subprime mortgage loans, 40.1% of the Alt-A loans, and 51% of the pay option and interest-only ARMs that were sold, unquote. Madigan told the FCIC, quote, even as the Fed was doing little to protect consumers and our financial system from the effects of predatory lending, the OCC and OTS were actively engaged in a campaign to thwart state efforts to avert the coming crisis. In the wake of the federal regulators' push to curtail state authority, many of the largest mortgage lenders shed their state licenses and sought shelter behind the shield of a national charter. And I think that it is no coincidence that the era of expanded federal preemption gave rise to the worst lending abuses in our nation's history, unquote. Comptroller Hawk offered the FCIC a different interpretation. Quote, while some critics have suggested that the OCC's actions on preemption have been a grab for power, the fact is that the agency has simply responded to increasingly aggressive initiatives at the state level to control the banking activities of federally chartered institutions, unquote. End of section 30. Section 31 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Mortgage securities players. Quote, Wall Street was very hungry for our product, unquote. Subprime and Alt-A mortgage-backed securities depended on a complex supply chain, largely funded through short-term lending in the commercial paper and repo market, which would become critical as the financial crisis began to unfold in 2007. These loans were increasingly collateralized not by treasuries and GSE securities, but by highly rated mortgage securities backed by increasingly risky loans. Independent mortgage originators such as Ameriquest and New Century, without access to deposits, typically relied on financing to originate mortgages from warehouse lines of credit extended by banks, from their own commercial paper programs, or from money borrowed in the repo market. For commercial banks such as Citigroup, warehouse lending was a multi-billion-dollar business. From 2000 to 2010, Citigroup made available at any one time as much as $7 billion in warehouse lines of credit to mortgage originators, including $950 million to New Century and more than $3.5 billion to Ameriquest. Citigroup CEO Chuck Prince told the FCIC he would not have approved had he known. Quote, I found out at the end of my tenure, I did not know it before, that we had some warehouse lines out to some originators. And I think getting that close to the origination function, being that involved in the origination of some of these products, is something that I wasn't comfortable with and that I did not view as consistent with the prescription I had laid down for the company not to be involved in originating these products, unquote. As early as 1998, Moody's called the new asset-backed commercial paper, or ABCP, programs a whole new ballgame. As asset-backed commercial paper became a popular method to fund the mortgage business, it grew from about 1/4 to about 1/2 of commercial paper sold between 1997 and 2001. In 2001, only 5 mortgage companies borrowed a total of $4 billion through asset-backed commercial paper. In 2006, 19 entities borrowed $43 billion. For instance, Countrywide launched the commercial paper programs Park Grenada in 2003 and Park Sienna in 2004. By May 2007, it was borrowing $13 billion through Park Grenada and $5.3 billion through Park Sienna. These programs would house subprime and other mortgages until they were sold. Commercial banks used commercial paper in part for regulatory arbitrage. When banks kept mortgages on their balance sheets, regulators required them to hold 4% in capital to protect against loss. When banks put mortgages into off-balance sheet entities, such as commercial paper programs, there was no capital charge. In 2004, a small charge was imposed. But to make the deals work for investors, banks had to provide liquidity support to these programs, for which they earned a fee. This liquidity support meant that the bank would purchase, at a previously set price, any commercial paper that investors were unwilling to buy when it came up for renewal. During the financial crisis, these promises had to be kept, eventually putting substantial pressure on banks' balance sheets. When the Financial Accounting Standards Board, the private group that established standards for financial reports, responded to the Enron scandal by making it harder for companies to get off-balance sheet treatment for these programs, the favorable capital rules were in jeopardy. The asset-backed commercial paper market stalled. Banks protested that their programs differed from the practices at Enron and should be excluded from the new standards. In 2003, bank regulators responded by proposing to let banks remove these assets from their balance sheets when calculating regulatory capital. The proposal would also have introduced, for the first time, a capital charge amounting to, at most, 1.6% of the liquidity support banks provided to the ABCP programs. However, after strong pushback, the American Securitization Forum, an industry association, called that charge arbitrary, and State Street Bank complained it was too conservative. Regulators in 2004 announced a final rule setting the charge at up to 0.8%, or half the amount of the first proposal. Growth in this market resumed. Regulatory changes, in this case changes in the bankruptcy laws, also boosted growth in the repo market by transforming the types of repo collateral. Prior to 2005, repo lenders had clear and immediate rights to their collateral following the borrower's bankruptcy only if that collateral was Treasury or GSE securities. In the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, Congress expanded that provision to include many other assets, including mortgage loans, mortgage-backed securities, collateralized debt obligations, and certain derivatives. The result was a short-term repo market increasingly reliant on highly rated, non-agency mortgage-backed securities. But beginning in mid-2007, when banks and investors became skittish about the mortgage market, they would prove to be an unstable funding source. See Figure 7.1. Figure 7.1 is labeled Repo Borrowing with the subtitle, Broker-Dealers' Use of Repo Borrowing Rose Sharply Before the Crisis. The vertical axis measures billions of dollars, and the horizontal axis measures time from 1980 to 2010. From 1980 till nearly 1990, repo borrowing was zero. From 1990 to sometime between 2005 and 2010, the graph shows repo borrowing increasing from zero to about $1.2 trillion, and then falling sharply to $396 billion in 2010. Note, net borrowing by broker-dealers, source Federal Reserve Flow of Funds Report. The graph itself can be seen on page 115 of the printed version of the report. Returning to the text. Once the crisis hit, these, quote, illiquid, hard-to-value securities made up a greater share of the tri-party repo market than most people would have wanted, unquote. Darrell Hendricks, a UBS executive and chair of a New York Fed task force examining the repo market after the crisis, told the commission. Our sample deal, CMLTI 2006-NC2, shows how these funding and securitization markets worked in practice. 8 banks and securities firms provided most of the money New Century needed to make the 4,499 mortgages it would sell to Citigroup. Most of the funds came through repo agreements from a set of banks, including Morgan Stanley, $424 million, Barclays Capital, a division of a UK-based bank, $221 million, Bank of America, $147 million, and Bear Stearns, $64 million. The financing was provided when New Century originated these mortgages, so for about 2 months, New Century owed these banks approximately $940 million secured by the mortgages. Another $12 million in funding came from New Century itself, including $3 million through its own commercial paper program. On August 29, 2006, Citigroup paid New Century $979 million for the mortgages and accrued interest, and New Century repaid the repo lenders after keeping a $24 million, or 2.5%, premium. The investors in the deal. Investors for mortgage-backed securities came from all over the globe. What made securitization work were the customized tranches catering to every one of them. CMLTI 2006-NC2 had 19 tranches, whose investors are shown in Figure 7.2. Figure 7.2 is captioned Selected Investors in CMLTI 2006-NC2 and subtitled A Wide Variety of Investors Throughout the World Purchased the Securities in This Deal, including Fannie Mae, many international banks, SIVs, and many CDOs. Returning to the text, Fannie Mae bought the entire $155 million AAA-rated A1 tranche, which paid a better return than super-safe U.S. Treasuries. The other AAA-rated tranches, worth $582 million, went to more than 20 institutional investors around the world, spreading the risk globally. These AAA tranches represented 78% of the deal. Among the buyers were foreign banks and funds in China, Italy, France, and Germany, the Federal Home Loan Bank of Chicago, the Kentucky Retirement Systems, a hospital, and J.P. Morgan, which purchased part of the tranche using cash from its securities lending operation. In other words, J.P. Morgan lent securities held by its clients to other financial institutions in exchange for cash collateral, and then put that cash to work investing in this deal. Securities lending was a large but ultimately unstable source of cash that flowed into this market. Figure 7.2 can be seen on page 116 of the printed volume of the work. The middle mezzanine tranches in this deal constituted about 21% of the total value of the security. If losses rose above 1% to 3%, by design, the threshold would increase over time. Investors in the residual tranches would be wiped out, and the mezzanine investors would start to lose money. Creators of collateralized debt obligations, or CDOs, discussed in the next chapter, bought most of the mezzanine tranches rated below AAA, and nearly all those related below AA. Only a few of the highest rated mezzanine tranches were not put into CDOs. For example, Cheney Finance Limited purchased $7 million of the top mezzanine tranche. Cheney, a structured investment vehicle, or SIV, would be one of the first casualties of the crisis, sparking panic during the summer of 2007. Parvest ABS Euribor, which purchased $20 million of the second mezzanine tranche, would be one of the BNP Paribas funds which helped ignite the financial crisis that summer. Typically, investors seeking high returns, such as hedge funds, would buy the equity tranches of mortgage-backed securities. They would be the first to lose if there were problems. These investors anticipated returns of 15%, 20%, or even 30%. Citigroup retained part of the residual or first loss tranches, sharing the rest with Capmark Financial Group. Compensated very well. The business of structuring, selling, and distributing this deal, and the thousands like it, was lucrative for the banks. The mortgage originators profited when they sold loans for securitization. Some of this profit flowed down to employees, particularly those generating mortgage volume. Part of the $24 million premium received by New Century for the deal we analyzed went to pay the many employees who participated. Quote, the originators, the loan officers, account executives, basically the salespeople who were the reason our loans came in, were compensated very well, New Century's Patricia Lindsay told the FCIC, and volume mattered more than quality. She noted, quote, Wall Street was very hungry for our product. We had our loans sold 3 months in advance, before they were even made at one point, unquote. Similar incentives were at work at Long Beach Mortgage, the subprime division of Washington Mutual, which organized its 2004 incentive plan by volume. As WAMU showed in a 2007 plan, Home Loans Product Strategy, the goals were also product-specific, to drive growth in higher margin products, option ARM, Alt-A, home equity, subprime. recruit and leverage seasoned option ARM sales force, and maintain a compensation structure that supports the high-margin product strategy. After structuring a security, an underwriter, often an investment bank, marketed and sold it to investors. The bank collected a percentage of the sale, generally between 0.2% and 1.5%, as discounts, concessions, or commissions. For a $1 billion deal like CMLTI 2006-NC2, a 1% fee would earn Citigroup $10 million. In this case, though, Citigroup instead kept parts of the residual tranches. Doing so could yield large profits, as long as the deal performed as expected. Options Group, which compiles compensation figures for investment banks, examined the mortgage-backed securities sales and trading desks at 11 commercial and investment banks from 2005 to 2007. It found that associates had average annual base salaries of $65,000 to $90,000 from 2005 through 2007, but received bonuses that could well exceed their salaries. On the next rung, vice presidents averaged base salaries and bonuses from $200,000 to $1.15 million. Directors averaged $625,000 to $1,625,000. At the top was the head of the unit. For example, in 2006, Dow Kim, the head of Merrill's Global Markets and Investment Banking segment, received a base salary of $350,000 plus a $35 million bonus, a package second only to Merrill Lynch's CEO. End of section 31. Section 32 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 7. Moody's, given a blank check. The rating agencies were essential to the smooth functioning of the mortgage-backed securities market. Issuers needed them to approve the structure of their deals. Banks needed their ratings to determine the amount of capital to hold. Repo markets needed their ratings to determine loan terms. Some investors could buy only securities with a AAA rating, and the rating agency's judgment was baked into collateral agreements and other financial contracts. To examine the rating process, the Commission focused on Moody's Investors Service, the largest and oldest of the three rating agencies. The rating of structured finance products, such as mortgage-backed securities, made up close to half of Moody's rating revenues in 2005, 2006, and 2007. From 2000 to 2007, revenues from rating such financial instruments increased more than fourfold. But the rating process involved many conflicts, which would come into focus during the crisis. To do its work, Moody's rated mortgage-backed securities using models based, in part, on periods of relatively strong credit performance. Moody's did not sufficiently account for the deterioration in underwriting standards or a dramatic decline in home prices. And Moody's didn't even develop a model specifically to take into account the layered risks of subprime securities until late 2006, after it had already rated nearly 19,000 subprime securities. In the business forever. Credit ratings have been linked to government regulations for 3/4 of a century. In 1931, the Office of the Comptroller of the Currency let banks report publicly traded bonds with a rating of BBB or better at book value, that is, the price they paid for the bonds. Lower-rated bonds had to be reported at current market prices, which might be lower. In 1951, the National Association of Insurance Commissioners adopted higher capital requirements on lower-rated bonds held by insurers. But the watershed event in federal regulation occurred in 1975, when the Securities and Exchange Commission modified its minimum capital requirements for broker-dealers to base them on credit ratings by, quote, a nationally recognized statistical rating organization, unquote, or NRSRO. At the time, that was Moody's, S&P, or Fitch. Ratings are also built into banking capital regulations under the recourse rule, which, since 2001, has permitted banks to hold less capital for higher-rated securities. For example, BBB-rated securities require 5 times as much capital as AAA and AA-rated securities, and BB securities require 10 times more capital. Banks in some countries were subject to similar requirements under the Basel II International Capital Agreement signed in June 2004, although U.S. banks had not fully implemented the advanced approaches allowed under those rules. Credit ratings also determined whether investors could buy certain investments at all. The SEC restricts money market funds to purchasing, quote, securities that have received credit ratings from any 2 NRSROs in one of the 2 highest short-term rating categories or comparable unrated securities, unquote. The Department of Labor restricts pension fund investments to securities rated A or higher. Credit ratings affect even private transactions. Contracts may contain triggers that require the posting of collateral or immediate repayment should a security or entity be downgraded. Triggers played an important role in the financial crisis and helped cripple AIG. Importantly for the mortgage market, the Secondary Mortgage Market Enhancement Act of 1984 permitted federal and state-chartered financial institutions to invest in mortgage-related securities if the securities had high ratings from at least one rating agency. Quote, look at the language of the original bill, unquote, Louis Ranieri told the FCIC. Quote, it requires a rating. It put them in the business forever. It became one of the biggest, if not the biggest, business, unquote. As Eric Kolchinsky, a former Moody's managing director, would summarize the situation, quote, the rating agencies were given a blank check, unquote. The agencies themselves were able to avoid regulation for decades. Beginning in 1975, the SEC had to approve a company's application to become an NRSRO. But if approved, a company faced no further regulation. More than 30 years later, the SEC got limited authority to oversee NRSROs in the Credit Rating Agency Reform Act of 2006. That law, taking effect in June 2007, focused on mandatory disclosure of the rating agency's methodologies. However, the law barred the SEC from regulating, quote, the substance of the credit ratings or the procedures and methodologies, unquote. Many investors, such as some pension funds and university endowments, relied on credit ratings because they had neither access to the same data as the rating agencies nor the capacity or analytic ability to assess the securities they were purchasing. As Moody's former managing director Jerome Fons has acknowledged, quote, subprime, meaning residential mortgage-backed securities, and their offshoots offer little transparency around composition and characteristics of the loan collateral. Loan-by-loan data, the highest level of detail, is generally not available to investors, unquote. Others, even large financial institutions, relied on the ratings. Still, some investors who did their homework were skeptical of these products despite their ratings. Arnold Catani, chairman of Mission Bank in Bakersfield, California, described deciding to sell the bank's holdings of mortgage-backed securities and CDOs. Quote, at one meeting, when things started getting difficult, maybe in 2006, I asked the CFO what the mechanical steps were in mortgage-backed securities if a borrower were in Des Moines, Iowa, defaulted. I know what it is if a borrower in Bakersfield defaults and somebody has that mortgage. But as a package security, what happens? And he couldn't answer the question. And I told him to sell them. Sell all of them then, because we didn't understand it. And I don't know that we had the capability to understand the financial complexities. Didn't want any part of it." Unquote. Notably, rating agencies were not liable for misstatements in securities registrations because courts ruled that their ratings were opinions protected by the First Amendment. Moody's standard disclaimer reads, quote, "The ratings are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities." Unquote. Gary Witt, a former team managing director at Moody's, told the FCIC, quote, "People expect too much from ratings. Investment decisions should always be based on much more than just a rating." Unquote. Everything but the elephant sitting on the table. The ratings were intended to provide a means of comparing risks across asset classes and time. In other words, the risk of a AAA-rated mortgage security was supposed to be similar to the risk of a AAA-rated corporate bond. Since the mid-1990s, Moody's has rated tranches of mortgage-backed securities using three models. The first, developed in 1996, rated residential mortgage-backed securities. In 2003, Moody's created a new model, M3 Prime, to rate prime, jumbo, and Alt-A deals. Only in the fall of 2006, when the housing market had already peaked, did it develop its model for rating subprime deals called M3 Subprime. The models incorporated firm and security-specific factors, market factors, regulatory and legal factors, and macroeconomic trends. The M3 Prime model let Moody's automate more of the process. Although Moody's did not sample or review individual loans, the company used loan-level information from the issuer. Relying on loan-to-value ratios, borrower credit scores, originator quality, and loan terms and other information, the model simulated the performance of each loan in 1,250 scenarios, including variations in interest rates and state-level unemployment, as well as home price changes. On average, across the scenarios, home prices trended upward at approximately 4% per year. The model put little weight on the possibility prices would fall sharply nationwide. Jay Siegel, a former Moody's team managing director involved in developing the model, told the FCIC, quote, "There may have been state-level components of this real estate drop that the statistics would have covered, but the 38% national drop, staying down over this short but multiple-year period, is more stressful than the statistics call for." Unquote. Even as housing prices rose to unprecedented levels, Moody's never adjusted the scenarios to put greater weight on the possibility of a decline. According to Siegel in 2005, quote, "Moody's position was that there was not a national housing bubble." Unquote. When the initial quantitative analysis was complete, the lead analyst on the deal convened a rating committee of other analysts and managers to assess it and determine the overall ratings for the securities. Siegel told the FCIC that qualitative analysis was also integral. Quote, "One common misperception is that Moody's credit ratings are derived solely from the application of a mathematical process or model. This is not the case. The credit rating process involves much more. Most importantly, the exercise of independent judgment by members of the rating committee. Ultimately, ratings are subjective opinions that reflect the majority view of the committee's members." Unquote. As Roger Stein, a Moody's managing director, noted, quote, "Overall, the model has to contemplate events for which there is no data." Unquote. After rating subprime deals with the 1996 model for years, In 2006, Moody's introduced a parallel model for rating subprime mortgage-backed securities. Like M3 Prime, the subprime model ran the mortgages through 1,250 scenarios. Moody's officials told the FCIC they recognized that stress scenarios were not sufficiently severe, so they applied additional weight to the most stressful scenario, which reduced the portion of each deal rated AAA. Stein, who helped develop the subprime model, said the output was manually calibrated to be more conservative, to ensure predicted losses were consistent with analysts' expert views. Stein also noted Moody's concern about a suitably negative stress scenario. For example, as one step, analysts took the single worst case from the M3 subprime model simulations and multiplied it by a factor in order to add deterioration. Moody's did not, however, sufficiently account for the deteriorating quality of the loans being securitized. Fonz described this problem to the FCIC. Quote, I sat on this high-level structured credit committee, which you'd think would be dealing with such issues of declining mortgage underwriting standards, and never once was it raised to this group or put on our agenda that the decline in quality that was going into pools, the impact possibly on ratings, other things. We talked about everything but, the elephant sitting on the table, unquote. To rate CMLTI 2006-NC2, our sample deal, Moody's first used its model to simulate losses in the mortgage pool. Those estimates, in turn, determined how big the junior tranches of the deal would have to be in order to protect the senior tranches from losses. In analyzing the deal, the lead analyst noted it was similar to another Citigroup deal of New Century loans that Moody's had rated earlier and recommended the same amount. Then the deal was tweaked to account for certain riskier types of loans, including interest-only mortgages. For its efforts, Moody's was paid an estimated $208,000. S&P also rated this deal and received $135,000. As we'll describe later, 3 tranches of this deal would be downgraded less than a year after issuance, part of Moody's mass downgrade on July 10, 2007, when housing prices had declined by only 4%. In October 2007, the M4 to M11 tranches were downgraded, and by 2008, all the tranches had been downgraded. Of all mortgage-backed securities it had rated AAA in 2006, Moody's downgraded 73% to junk. The consequences would reverberate throughout the financial system. End of section 32. Section 33 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 7, Fannie Mae and Freddie Mac, less competitive in the marketplace. In 2004, Fannie and Freddie faced problems on multiple fronts. They had violated accounting rules and now faced corrections and fines. They were losing market share to Wall Street, which was beginning to dominate the securitization market. Struggling to remain dominant, they loosened their underwriting standards, purchasing and guaranteeing riskier loans and increasing their securities purchases. Yet their regulator, the Office of Federal Housing Enterprise Oversight, or OFHEO, focused more on accounting and other operational issues than on Fannie's and Freddie's increasing investments in risky mortgages and securities. In 2002, Freddie changed accounting firms. The company had been using Arthur Andersen for many years, but when Andersen got into trouble in the Enron debacle, which put both Enron and its accountant out of business, Freddie switched to PricewaterhouseCoopers. The new accountant found the company had understated its earnings by $5 billion from 2000 through the third quarter of 2002 in an effort to smooth reported earnings and promote itself as Steady Freddie, a company of strong and steady growth. Bonuses were tied to the reported earnings, and OFHEO found that this arrangement contributed to the accounting manipulations. Freddie's board ousted most top managers, including Chairman and CEO Leland Brenzel, President and COO David Klenn, and CFO Von Clark. In December 2003, Freddie agreed with OFHEO to pay a $125 million penalty and correct governance, internal controls, accounting, and risk management. In January 2004, OFHEO directed Freddie to maintain 30% more than its minimum capital requirement until it reduced operational risk and could produce timely, certified financial statements. Freddie Mac would settle shareholder lawsuits for $410 million and pay $50 million in penalties to the SEC. Fannie was next. In September 2004, OFHEO discovered violations of accounting rules that called into question previous filings. In 2006, OFHEO reported that Fannie had overstated earnings from 1998 through 2002 by $11 billion, and that it, too, had manipulated accounting in ways influenced by compensation plans. OFHEO made Fannie improve accounting controls, maintain the same 30% capital surplus imposed on Freddie, and improve governance and internal controls. Fannie's board ousted CEO Franklin Raines and others, and the SEC required Fannie to restate its results for 2001 through mid-2004. Fannie settled SEC and OFHEO enforcement actions for $400 million in penalties. Donald Bezenius, an executive vice president at Freddie Mac, told the FCIC that the accounting issues distracted management from the mortgage business, taking, quote, a tremendous amount of management's time and attention, and probably led us to being less aggressive or less competitive in the marketplace than we otherwise might have been, unquote. As the scandals unfolded, subprime private label mortgage-backed securities, or PLS, issued by Wall Street, increased from $87 billion in 2001 to $465 billion in 2005, shown in Figure 7.3. Figure 7.3 is labeled Buyers of Non-GSE Mortgage-Backed Securities. The GSEs purchased subprime and Alt-A non-agency securities during the 2000s. These purchases peaked in 2004. There are two bar charts in Figure 7.3. On the left, labeled subprime securities purchases. On the right, labeled Alt-A securities purchases. The vertical axes are dollar amounts, and on the horizontal axes, time from 2001 through 2008. Each bar is composed of three different colors, one for purchases by Freddie Mac, a different color for purchases by Fannie Mae, and a third color for purchases by other purchasers. The chart can be viewed on page 124 of the written report. Returning to the text, the value of Alt-A mortgage-backed securities increased from $11 billion to $332 billion. Starting in 2001 for Freddie and 2002 for Fannie, the GSEs, particularly Freddie, became buyers in this market. While private investors always bought the most, the GSEs purchased 10.5% of the private-issued subprime mortgage-backed securities in 2001. The share peaked at 40% in 2004 and then fell back to 28% in 2008. The share for Alt-A mortgage-backed securities was always lower. The GSEs almost always bought the safest AAA-rated tranches. From 2005 through 2008, the GSEs' purchases declined both in dollar amount and as a percentage. These investments were profitable at first, but as delinquencies increased in 2007 and 2008, both GSEs began to take significant losses on their private label mortgage-backed securities, disproportionately from their purchases of Alt-A securities. By the third quarter of 2010, total impairments on securities totaled $46 billion at the two companies, enough to wipe out nearly 60% of their pre-crisis capital. OFHEO knew about the GSE's purchases of subprime and Alt-A mortgage-backed securities. In its 2004 examination, the regulator noted Freddie's purchases of these securities. It also noted that Freddie was purchasing whole mortgages with, quote, higher risk attributes which exceeded the enterprise's modeling and costing capabilities, unquote, including no income, no asset loans that introduced considerable risk. OFHEO reported that mortgage insurers were already seeing abuses with these loans. But the regulator concluded that the purchases of mortgage-backed securities and riskier mortgages were not a significant supervisory concern, and the examination focused more on Freddie's efforts to address accounting and internal deficiencies. OFHEO included nothing in Fannie's report about its purchases of subprime and Alt-A mortgage-backed securities, and its credit risk management was deemed satisfactory. The reasons for the GSE's purchases of subprime and Alt-A mortgage-backed securities have been debated. Some observers, including Alan Greenspan, have linked the GSE's purchases of private mortgage-backed securities to their push to fulfill their higher goals for affordable housing. The former Fed chairman wrote in a working paper submitted as part of his testimony to the FCIC that when the GSEs were pressed to, quote, expand affordable housing commitments, they chose to meet them by investing heavily in subprime securities, unquote. Using data provided by Fannie Mae and Freddie Mac, the FCIC examined how single-family, multifamily, and securities purchases contributed to meeting the affordable housing goals. In 2003 and 2004, Fannie Mae's single and multifamily purchases alone met each of the goals. In other words, the enterprise would have met its obligations without buying subprime or Alt-A mortgage-backed securities. In fact, none of Fannie Mae's 2004 purchases of subprime or Alt-A securities were ever submitted to HUD to be counted toward the goals. Before 2005, 50% or less of the GSE's loan purchases had to satisfy the affordable housing goals. In 2005, the goals were increased above 50%, but even then, single and multifamily purchases alone met the overall goals. Securities purchases did, in several cases, help Fannie meet its sub-goals, specific targets requiring the GSEs to purchase or guarantee loans to purchase homes. In 2005, Fannie missed one of these sub-goals and would have missed a second without the securities purchases. In 2006, the securities purchases helped Fannie meet those two sub-goals. The pattern is the same at Freddie Mac, a larger purchaser of non-agency mortgage-backed securities. Estimates by the FCIC show that from 2003 through 2006, Freddie would have met the affordable housing goals without any purchases of Alt-A or subprime securities, but used the securities to help meet sub-goals. Robert Levin, the former chief business officer of Fannie Mae, told the FCIC that buying private label mortgage-backed securities, quote, was a money-making activity. It was all positive economics. There was no trade-off between making money and hitting goals. It was a very broad-brushed effort that could be characterized as win-win-win, money, goals, and share, unquote. Mark Weiner, the head of Fannie's Business Analysis and Decisions Group, stated that the purchase of AAA tranches of mortgage-backed securities backed by subprime loans was viewed as an attractive opportunity with good returns. He said that the mortgage-backed securities satisfied housing goals, and that the goals became a factor in the decision to increase purchases of private label securities. Overall, while the mortgages behind the subprime mortgage-backed securities were often issued to borrowers that could help Fannie and Freddie fulfill their goals, the mortgages behind the Alt-A securities were not. Alt-A mortgages were not generally extended to lower-income borrowers, and the regulations prohibited mortgages to borrowers with unstated income levels, a hallmark of Alt-A loans, from counting toward affordability goals. Levin told the FCIC that they believed that the purchase of Alt-A securities, quote, did not have a net positive effect on Fannie Mae's housing goals, unquote. Instead, they had to be offset with more mortgages for low and moderate income borrowers to meet the goals. Fannie and Freddie continued to purchase subprime and Alt-A mortgage-backed securities from 2005 to 2008, and also bought and securitized greater numbers of riskier mortgages. The results would be disastrous for the companies, their shareholders, and American taxpayers. End of section 33. Section 34 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 7. The Commission concludes that the monetary policy of the Federal Reserve, along with capital flows from abroad, created conditions in which a housing bubble could develop. However, these conditions need not have led to a crisis. The Federal Reserve and other regulators did not take actions necessary to constrain the credit bubble. In addition, the Federal Reserve's policies and pronouncements encouraged, rather than inhibited, the growth of mortgage debt and the housing bubble. Lending standards collapsed, and there was a significant failure of accountability and responsibility throughout each level of the lending system. This included borrowers, mortgage brokers, appraisers, originators, securitizers, credit rating agencies, and investors, and ranged from corporate boardrooms to individuals. Loans were often premised on ever-rising home prices and were made regardless of ability to pay. The non-prime mortgage securitization process created a pipeline through which risky mortgages were conveyed and sold throughout the financial system. This pipeline was essential to the origination of the burgeoning numbers of high-risk mortgages. The originate-to-distribute model undermined responsibility and accountability for the long-term viability of mortgages and mortgage-related securities, and contributed to the poor quality of mortgage loans. Federal and state rules required or encouraged financial firms and some institutional investors to make investments based on the ratings of credit rating agencies, leading to undue reliance on those ratings. However, the rating agencies were not adequately regulated by the Securities and Exchange Commission or any other regulator to ensure the quality and accuracy of their ratings. Moody's, the Commission's case study in this area, relied on flawed and outdated models to issue erroneous ratings on mortgage-related securities, failed to perform meaningful due diligence on the assets underlying the securities, and continued to rely on those models even after it became obvious that the models were wrong. Not only did the federal banking supervisors fail to rein in risky mortgage lending practices, but the Office of the Comptroller of the Currency and the Office of Thrift Supervision preempted the applicability of state laws and regulatory efforts to national banks and thrifts, thus preventing adequate protection for borrowers and weakening constraints on this segment of the mortgage market. End of Chapter 7. Section 35 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 8, The CDO Machine. In the first decade of the 21st century, a previously obscure financial product called the Collateralized Debt Obligation, or CDO, transformed the mortgage market by creating a new source of demand for the lower-rated tranches of mortgage-backed securities. Footnote: throughout this book, unless otherwise noted, we use the term CDOs to refer to cash CDOs backed by asset-backed securities, such as mortgage-backed securities, also known as ABS CDOs. Returning to the text, despite the relatively high returns, tranches rated other than AAA could be hard to sell. If borrowers were delinquent or defaulted, investors in these tranches were out of luck because of where they sat in the payments waterfall. Wall Street came up with a solution. In the words of one banker, they, quote, created the investor, unquote. That is, they built new securities that would buy the tranches that had become harder to sell. Bankers would take these low investment grade tranches, largely rated BBB or A, from many mortgage-backed securities and repackage them into the new securities, CDOs. Approximately 80% of these CDO tranches would be rated AAA, despite the fact that they generally comprise the lower-rated tranches of mortgage-backed securities. CDO securities would be sold with their own waterfalls, with the risk-averse investors again paid first and the risk-seeking investors paid last. As they did in the case of mortgage-backed securities, the rating agencies gave their highest AAA ratings to the securities at the top. See Figure 8.1. Figure 8.1 is labeled Collateralized Debt Obligations, with a legend that reads, Collateralized debt obligations, or CDOs, are structured financial instruments that purchase and pool financial assets, such as the riskier tranches of various mortgage-backed securities. The diagram begins with Step 1, labeled Purchase. The CDO manager and securities firm select and purchase assets, such as some of the lower-rated tranches of mortgage-backed securities. In the diagram, an arrow extends from the lower-rated tranches to a large circle labeled New Pool of RMBSs and other securities. Step 2, Pool. The CDO manager and securities firm pool various assets in an attempt to get diversification benefits. An arrow extends from that circle to another column of tranches labeled CDO tranches. Similar to mortgage-backed securities, the CDO issues securities in tranches that vary based on their place in the cash flow waterfall. The arrow from the circle to the CDO tranches points first to the AAA tranche and is labeled First Claim to Cash Flow from Principal and Interest Payments. From there, another arrow labeled Next Claim extends downward. From there, another arrow labeled Next, etc. extends further downward. The figure can be viewed on page 128 of the written report. Returning to the text. Still, it was not obvious that a pool of mortgage-backed securities rated BBB could be transformed into a new security that is mostly rated AAA. But math made it so. The securities firms argued, and the rating agencies agreed, that if they pooled many BBB-rated mortgage-backed securities, they would create additional diversification benefits. The rating agencies believed that those diversification benefits were significant, that if one security went bad, the second had only a very small chance of going bad at the same time, and as long as losses were limited, only those investors at the bottom would lose money. They would absorb the blow, and the other investors would continue to get paid. Relying on that logic, the CDO machine gobbled up the BBB and other lower-rated tranches of mortgage-backed securities, growing from a bit player to a multi-hundred-billion-dollar industry. Between 2003 and 2007, as house prices rose 27% nationally and $4 trillion in mortgage-backed securities were created, Wall Street issued nearly $700 billion in CDOs that included mortgage-backed securities as collateral. With ready buyers for their own product, mortgage securitizers continued to demand loans for their pools, and hundreds of billions of dollars flooded the mortgage world. In effect, the CDO became the engine that powered the mortgage supply chain. Quote, "There is a machine going," unquote, Scott Eichel, a senior managing director at Bear Stearns, told a financial journalist in May 2005. Quote, "There's a lot of brain power to keep this going," unquote. Everyone involved in keeping this machine humming: the CDO managers and underwriters who packaged and sold the securities, the rating agencies that gave most of them sterling ratings, and the guarantors who wrote protection against their defaulting, collected fees based on the dollar volume of securities sold. For the bankers who would put these deals together, as for the executives of their companies, volume equaled fees equaled bonuses, and those fees were in the billions of dollars across the market. But when the housing market went south, the models on which CDOs were based proved tragically wrong. The mortgage-backed securities turned out to be highly correlated, meaning they performed similarly. Across the country, in regions where subprime and Alt-A mortgages were heavily concentrated, borrowers would default in large numbers. This was not how it was supposed to work. Losses in one region were supposed to be offset by successful loans in another region. In the end, CDOs turned out to be some of the most ill-fated assets in the financial crisis. The greatest losses would be experienced by big CDO arrangers, such as Citigroup, Merrill Lynch, and UBS, and by financial guarantors such as AIG, AMBAC, and MBIA. These players had believed their own models and retained exposure to what were understood to be the least risky tranches of the CDOs, those rated AAA or even super senior, which were assumed to be safer than AAA-rated tranches. Quote, "The whole concept of ABS CDOs had been an abomination," unquote. Patrick Parkinson, currently the head of banking supervision and regulation at the Federal Reserve Board, told the FCIC. End of section 35. Section 36 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 8. CDOs, We Created the Investor. Michael Milken's Drexel Burnham Lambert assembled the first rated collateralized debt obligation in 1987 out of different companies' junk bonds. The strategy made sense. Pooling many bonds reduced investors' exposure to the failure of any one bond, and putting the securities into tranches enabled investors to pick their preferred level of risk and return. For the managers who created CDOs, the key to profitability of the CDO was the fee and the spread, the difference between the interest that the CDO received on the bonds or loans that it held and the interest that the CDO paid to investors. Throughout the 1990s, CDO managers generally purchased corporate and emerging market bonds and bank loans. When the liquidity crisis of 1998 drove up returns on asset-backed securities, Prudential Securities saw an opportunity and launched a series of CDOs that combined different kinds of asset-backed securities into one CDO. These multi-sector or ABS securities were backed by mortgages, mobile home loans, aircraft leases, mutual fund fees, and other asset classes with predictable income streams. The diversity was supposed to provide yet another layer of safety for investors. Multi-sector CDOs went through a tough patch when some of the asset-backed securities in which they invested started to perform poorly in 2002. particularly those backed by mobile home loans, after borrowers defaulted in large numbers, aircraft leases after 9/11, and mutual fund fees after the dot-com bust. The accepted wisdom among many investment banks, investors, and rating agencies was that the wide range of assets actually contributed to the problem. According to this view, the asset managers who selected the portfolios could not be experts in sectors as diverse as aircraft leases and mutual funds. So the CDO industry turned to non-prime mortgage-backed securities, which CDO managers believed they understood, which seemed to have a record of good performance and which paid relatively high returns for what was considered a safe investment. Quote, everyone looked at the sector and said, the CDO construct works, but we just need to find more stable collateral, unquote, said Wing Chow, who ran two firms, Maxim Group and Harding Advisory, that managed CDOs mostly underwritten by Merrill Lynch. Quote, and the industry looked at residential mortgage-backed securities, Alt-A, subprime, and non-agency mortgages, and saw the relative stability, unquote. CDOs quickly became ubiquitous in the mortgage business. Investors liked the combination of apparent safety and strong returns, and investment bankers liked having a new source of demand for the lower tranches of mortgage-backed securities and other asset-backed securities that they created. Quote, we told you these BBB-rated securities were a great deal and priced at great spreads, but nobody stepped up, unquote. The Credit Suisse banker Joe Donovan told a Phoenix conference of securitization bankers in February 2002, quote, so we created the investor, unquote. By 2004, creators of CDOs were the dominant buyers of the BBB-rated tranches of mortgage-backed securities, and their bids significantly influenced prices in the market for these securities. By 2005, they were buying virtually all of the BBB tranches. Just as mortgage-backed securities provided the cash to originate mortgages, now CDOs would provide the cash to fund mortgage-backed securities. Also by 2004, mortgage-backed securities accounted for more than half of the collateral in CDOs, up from 35% in 2002. Sales of these CDOs more than doubled every year, jumping from $30 billion in 2003 to $225 billion in 2006. Filling this pipeline would require hundreds of billions of dollars of subprime and Alt-A mortgages. Quote, it was a lot of effort, unquote. 5 key types of players were involved in the construction of CDOs: securities firms, CDO managers, rating agencies, investors, and financial guarantors. Each took varying degrees of risk and, for a time, profited handsomely. Securities firms underwrote the CDOs. That is, they approved the selection of collateral, structured the notes into tranches, and were responsible for selling them to investors. 3 firms, Merrill Lynch, Goldman Sachs, and the securities arm of Citigroup, accounted for more than 30% of CDOs structured from 2004 to 2007. Deutsche Bank and UBS were also major participants. Quote, we had sales representatives in all those global locations, and their jobs were to sell structured products, unquote. Nestor Dominguez, the co-head of Citigroup's CDO desk, told the FCIC, quote, we spent a lot of effort to have people in place to educate, to pitch structured products. So it was a lot of effort, about 100 people, and I presume our competitors did the same, unquote. The underwriters' focus was on generating fees and structuring deals that they could sell. Underwriting did entail risks, however. The securities firm had to hold the assets, such as the BBB-rated tranches of mortgage-backed securities, during the ramp-up period, 6 to 9 months, when the firm was accumulating the mortgage-backed securities for the CDOs. Typically, during that period, the securities firm took the risk that the assets might lose value. Quote, Our business was to make new issue fees and to make sure that if the market did have a downturn, we were somehow hedged, unquote. Michael Lamont, the former co-head for CDOs at Deutsche Bank, told the FCIC. Chris Riccardi, formerly head of the CDO desk at Merrill Lynch, likewise told the FCIC that he did not track the performance of CDOs after underwriting them. Moreover, Lamont said it was not his job to decide whether the rating agency's models had the correct underlying assumptions. That, quote, was not what we brought to the table, unquote, he said. In many cases, though, underwriters helped CDO managers select collateral, leading to potential conflicts. More on that later. The role of the CDO manager was to select the collateral, such as mortgage-backed securities, and in some cases manage the portfolio on an ongoing basis. Managers ranged from independent investment firms, such as Chow's, to units of large asset management companies such as PIMCO and BlackRock. CDO managers received periodic fees based on the dollar amount of assets in the CDO, and in some cases on performance. On a percentage basis, these may have looked small, sometimes measured in tenths of a percentage point, but the amounts were far from trivial. For CDOs that focused on the relatively senior tranches of mortgage-backed securities, annual manager fees tended to be in the range of $600,000 to $1 million per year for a $1 billion deal. For CDOs that focused on the more junior tranches, which were often smaller, fees would be $750,000 to $1.5 million per year for a $500 million deal. As managers did more deals, they generated more fees without much additional cost. Quote, you'd hear statements like, everybody and his uncle now wants to be a CDO manager, unquote. Mark Adelson, then a structured finance analyst at Nomura Securities and currently chief credit officer at S&P, told the FCIC. Quote, that was an observation voiced repeatedly at several of the industry conferences around those times, the enormous proliferation of CDO managers, because it became very lucrative, unquote. CDO managers industry-wide earned at least $1.5 billion in management fees between 2003 and 2007. The role of the rating agencies was to provide basic guidelines on the collateral and the structure of the CDOs, that is, the sizes and returns of the various tranches, in close consultation with the underwriters. For many investors, the AAA rating made those products appropriate investments. Rating agency fees were typically between $250,000 and $500,000 for CDOs. For most deals, at least 2 rating agencies would provide ratings and receive those fees, although the views tended to be in sync. The CDO investors, like investors in mortgage-backed securities, focused on different tranches based on their preference for risk and return. CDO underwriters, such as Citigroup, Merrill Lynch, and UBS, often retained the super senior AAA tranches, for reasons we'll see later. They also sold them to commercial paper programs that invested in CDOs and other highly rated assets. Hedge funds often bought the equity tranches. Eventually, other CDOs became the most important class of investor for the mezzanine tranches of CDOs. By 2005, CDO underwriters were selling most of the mezzanine tranches, including those rated A, and especially those rated BBB, the lowest and riskiest investment grade rating, to other CDO managers to be packaged into other CDOs. It was common for CDOs to be structured with 5% or 15% of their cash invested in other CDOs. CDOs with as much as 80% to 100% of their cash invested in other CDOs were typically known as CDOs squared. Finally, the issuers of over-the-counter derivatives called credit default swaps, most notably AIG, played a central role by issuing swaps to investors in CDO tranches, promising to reimburse them for any losses on the tranches in exchange for a stream of premium-like payments. This credit default swap protection made the CDOs much more attractive to potential investors because they appeared to be virtually risk-free. But it created huge exposures for the credit default swap issuers if significant losses did occur. Profit from the creation of CDOs, as is customary on Wall Street, was reflected in employee bonuses. And as demand for all types of financial products soared during the liquidity boom at the beginning of the 21st century, pre-tax profit for the 5 largest investment banks doubled between 2003 and 2006, from $20 billion to $43 billion. Total compensation at these investment banks for their employees across the world rose from $34 billion to $61 billion. A part of the growth could be credited to mortgage-backed securities, CDOs, and various derivatives, and thus employees in those areas could be expected to be compensated accordingly. Quote, credit derivatives traders, as well as mortgage and asset-backed securities salespeople, should especially enjoy bonus season, unquote. A firm that compiles compensation figures for investment banks reported in 2005. To see in more detail how the CDO pipeline worked, we revisit our illustrative Citigroup mortgage-backed security, CMLTI 2006-NC2. Earlier, we described how most of the below AAA bonds issued in this deal went into CDOs. One such CDO was Claris Real Estate Funding III, which was underwritten by UBS, a Swiss bank. The CDO manager was Strategos Capital Management, a subsidiary of Cohen & Company. That investment company was headed by Chris Riccardi, who had earlier built Merrill's CDO business. Claros III, launched in 2006, purchased and held $9.6 million in securities from the A-rated M5 tranche of Citigroup security, along with 187 junior tranches of other mortgage-backed securities. In total, it owned $975 million of mortgage-related securities, of which 45% were rated BBB or lower, 16% A, and the rest higher than A. To fund those purchases, Claros III issued $1 billion of bonds to investors. As was typical for this type of CDO at the time, roughly 88% of the Claros III bonds were AAA rated. At least half of the below AAA tranches issued by Claros III went into other CDOs. Mother's milk to the market. The growth of CDOs had important impacts on the mortgage market itself. CDO managers who were eager to expand the assets that they were managing, on which their income was based, were willing to pay high prices to accumulate BBB-rated tranches of mortgage-backed securities. This CDO bid pushed up market prices on those tranches, pricing out of the market traditional investors in mortgage-backed securities. Informed institutional investors, such as insurance companies, had purchased the private label mortgage-backed securities issued in the 1990s. These securities were typically protected from losses by bond insurers, who had analyzed the deals as well. Beginning in the late 1990s, mortgage-backed securities that were structured with 6 or more tranches and other features to protect the AAA investors became more common, replacing the earlier structures that had relied on bond insurance to protect investors. By 2004, the earlier forms of mortgage-backed securities had essentially vanished, leaving the market increasingly to the multi-tranche structures and their CDO investors. This was a critical development, given that the focus of CDO managers differed from that of traditional investors. Quote, the CDO manager and the CDO investor are not the same kind of folks as the monoline bond insurers who just backed away, unquote, Adelson said. Quote, they're mostly not mortgage professionals, not real estate professionals. They're derivatives folks, unquote. Indeed, Chow, the CDO manager, portrayed his job as creating structures that rating agencies would approve and investors would buy, and making sure the mortgage-backed securities that he bought met industry standards. He said that he relied on the rating agencies. Quote, unfortunately, what lulled a lot of investors, and I'm in that camp as well, what lulled us into that sense of comfort was that the rating stability was so solid and that it was so consistent. I mean, the rating agencies did a very good job of making everything consistent, unquote. CDO production was effectively on autopilot. Quote, mortgage traders speak lovingly of the CDO bid. It is mother's milk to the market, unquote. James Grant, a market commentator, wrote in 2006, quote, without it, few asset-backed structures could be built, and those that were would have to meet a much more conservative standard of design. The resulting pangs of credit withdrawal would certainly be felt in the residential real estate market, unquote. UBS's global CDO group agreed, noting that CDOs, quote, have now become bullies in their respective collateral markets, unquote. By promoting an increase in both the volume and the price of mortgage-backed securities, bids from CDOs had, quote, an impact on the overall U.S. economy that goes well beyond the CDO market, unquote. Without the demand for mortgage-backed securities from CDOs, lenders would have been able to sell fewer mortgages, and thus they would have had less reason to push so hard to make the loans in the first place. Leverage is inherent in CDOs. The mortgage pipeline also introduced leverage at every step. Most financial institutions thrive on leverage, that is, on investing borrowed money. Leverage increases profits in good times, but also increases losses in bad times. The mortgage itself creates leverage, particularly when the loan is of the low down payment, high loan-to-value ratio variety. Mortgage-backed securities and CDOs created further leverage because they were financed with debt, and the CDOs were often purchased as collateral by those creating other CDOs with yet another round of debt. Synthetic CDOs, consisting of credit default swaps, described below, amplified the leverage. The CDO, backed by securities that were themselves backed by mortgages, created leverage on leverage, as Dan Sparks, mortgage department head at Goldman Sachs, explained to the FCIC. Quote, people were looking for other forms of leverage. You could either take leverage individually, as an institution, or you could take leverage within the structure, unquote, Citigroup's Dominguez told the FCIC. Even the investor that bought the CDOs could use leverage. Structured investment vehicles, a type of commercial paper program that invested mostly in AAA-rated securities, were leveraged an average of just under 14 to 1. In other words, these SIVs would hold $14 in assets for every dollar of capital. The assets would be financed with debt. Hedge funds, which were common purchasers, were also often highly leveraged in the repo market, as we will see. But it would become clear during the crisis that some of the highest leverage was created by companies such as Merrill, Citigroup, and AIG, when they retained or purchased the AAA and super senior tranches of CDOs with little or no capital backing. Thus, in 2004, when the home ownership rate was peaking, and when new mortgages were increasingly being driven by serial refinancings, by investors and speculators, and by second home purchases, the value of trillions of dollars of securities rested on just two things: the ability of millions of homeowners to make the payments on their subprime and Alt-A mortgages, and the stability of the market values of homes whose mortgages were the basis of the securities. Those dangers were understood all along by some of the market participants. Quote, Leverage is inherent in asset-backed securities CDOs, unquote. Mark Klipsch, a banker with Oryx Capital Markets, an asset management firm, told a Boca Raton conference of securitization bankers in October 2004. While it was good for short-term profits, losses could be large later on. Klipsch said, quote, "We'll see some problems down the road," unquote. End of section 36. Section 37 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 8. Bear Stearns' Hedge Funds. It functioned fine. Up until one day, it just didn't function. Bear Stearns, the smallest of the 5 large investment banks, started its asset management business in 1985 when it established Bear Stearns Asset Management, or BSAM. Asset management brought in steady fee income, allowed banks to offer new products to customers, and required little capital. BSAM played a prominent role in the CDO business as both a CDO manager and a hedge fund that invested in mortgage-backed securities and CDOs. At BSAM, by the end of 2006, Ralph Chaffee was managing 11 CDOs with $18.3 billion in assets and 2 hedge funds with $18 billion in assets. Although Bear Stearns owned BSAM, Bear's management exercised little supervision over its business. The eventual failure of Chaffee's 2 large mortgage-focused hedge funds would be an important event in 2007, early in the financial crisis. In 2003, Chaffee launched his first fund at BSAM, the High-Grade Structured Credit Strategies Fund, and in 2006, he added the High-Grade Structured Credit Strategies Enhanced Leverage Fund. The funds purchased mostly mortgage-backed securities, or CDOs, and used leverage to enhance their returns. The target was for 90% of assets to be rated either AAA or AA. As Chaffee told the FCIC, quote, "The thesis behind the fund was that the structured credit markets offered yield over and above what their ratings suggested they should offer," unquote. Chaffee targeted a leverage ratio of 10-1 for the first high-grade fund. For enhanced leverage, Chaffee upped the ante, touting the enhanced leverage fund as a levered version of the high-grade fund that targeted leverage of 12-1. At the end of 2006, the high-grade fund contained $8.6 billion in assets, using $0.9 billion of his hedge fund investors' money and $7.7 billion in borrowed money. The enhanced leverage fund had $9.4 billion, using $0.9 billion from investors and $8.5 billion in borrowed money. BSAM financed these asset purchases by borrowing in the repo markets, which was typical for hedge funds. A survey conducted by the FCIC identified at least $275 billion of repo borrowing as of June 2008 by the approximately 170 hedge funds that responded. The respondents invested at least $45 billion in mortgage-backed securities, or CDOs, as of June 2007. The ability to borrow using the AAA and AA tranches of CDOs as repo collateral facilitated demand for those securities. But repo borrowing carried risks. It created significant leverage, and it had to be renewed frequently. For example, an investor buying a stock on margin, meaning with borrowed money, might have to put up 50 cents on the dollar, with the other 50 cents loaned by his or her stockbroker, for a leverage ratio of 2-1. A homeowner buying a house might make a 10% down payment and take out a mortgage for the rest, a leverage ratio of 10-1. By contrast, repo lending allowed an investor to buy a security for much less out of pocket. In the case of a treasury security, an investor may have to put in only 0.25%, borrowing 99.75% from a securities firm, 400-1. In the case of a mortgage-backed security, an investor might pay 5%, or 20-1. With this amount of leverage, a 5% change in the value of that mortgage-backed security can double the investor's money or lose all of the initial investment. Another inherent fallacy in the structure was the assumption that the underlying collateral could be sold easily. But when it came to selling them in times of distress, private label mortgage-backed securities would prove to be very different from U.S. Treasuries. The short-term nature of repo money also makes it inherently risky and unreliable. Funding that is offered at certain terms today could be gone tomorrow. Chaffee's funds, for example, took the risk that its repo lenders would decide not to extend or roll the repo lines on any given day. Yet, more and more, repo lenders were loaning money to funds like Chaffee's, rolling the debt nightly and not worrying very much about the real quality of the collateral. The firms loaning money to Chaffee's hedge funds were often also selling them mortgage-related securities, and the hedge funds pledged those same securities to secure the loans. If the market value of the collateral fell, the repo lenders could, and would, demand more collateral from the hedge fund to back the repo loan. This dynamic would play a pivotal role in the fate of many hedge funds in 2007, most spectacularly in the case of Chaffee's funds. Quote, "The repo market, it functioned fine up until one day it just didn't function," unquote, Chaffee told the FCIC. Up to that point, his hedge funds could buy billions of dollars of CDOs on borrowed money because of the market's bullishness about mortgage assets, he said. Quote, "It became a more and more acceptable asset class, with more traders, more repo lenders, more investors, obviously. It had a much broader footprint domestically as well as internationally. So the market just really exploded," unquote. BSAM touted its CDO holdings to investors, telling them that CDOs were a market opportunity because they were complex and therefore undervalued in the general marketplace. In 2003, this was a promising market with seemingly manageable risks. Chaffee and his team not only bought CDOs, they also created and managed other CDOs. Chaffee would purchase mortgage-backed securities, CDOs, and other securities for his hedge funds. When he had reached his firm's internal investment limits, he would repackage those securities and sell CDO securities to other customers. With the proceeds, Chaffee would pay off his repo lenders, and at the same time he would acquire the equity tranche of a new CDO. Because Chaffee managed these newly created CDOs that selected collateral from his own hedge funds, he was positioned on both sides of the transaction. The structure created a conflict of interest between Chaffee's obligation to his hedge fund investors and his obligation to his CDO investors. This was not unique on Wall Street, and BSAM disclosed the structure and the conflict of interest to potential investors. For example, a critical question was at what price the CDO should purchase assets from the hedge fund. If the CDO paid above market prices for a security, that would advantage the hedge fund investors and disadvantage the CDO investors. BSAM's flagship CDOs, dubbed Clio 1, 2, and 3, were created in rapid succession over 2004 and 2005, with Citigroup as their underwriter. All three deals were mainly composed of mortgage and asset-backed securities that BSAM already owned, and BSAM retained the equity position in all three. All three were primarily funded with asset-backed commercial paper. Typical for the industry at the time, the expected return for the CDO manager, who was managing assets and holding the equity tranche, was between 15% and 23% annually, assuming no defaults on the underlying collateral. Thanks to the combination of mortgage-backed securities, CDOs, and leverage, Chaffee's funds earned healthy returns for a time. The high-grade fund had returns of 17% in 2004, 10% in 2005, and 9% in 2006 after fees. Chaffee and Tannen made millions before the hedge funds collapsed in 2007. Chaffee was rewarded with total compensation worth more than $41 million from 2005 to 2007. In 2007, the year the two hedge funds filed for bankruptcy, Chaffee made more than $17.6 million in total compensation. Matt Tannen, his lead manager, was awarded compensation of more than $5.6 million from 2005 to 2007. Both managers invested some of their own money in the funds and used this as a selling point when pitching the funds to others. But when house prices fell and investors started to question the value of mortgage-backed securities in 2007, the same short-term leverage that had inflated Chaffee's returns would amplify losses and quickly put his two hedge funds out of business. End of section 37. Section 38 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 8. Citigroup's Liquidity Puts, a Potential Conflict of Interest. By the middle of the decade, Citigroup was a market leader in selling CDOs, often using its depositor-based commercial bank to provide liquidity support. For much of this period, the company was in various types of trouble with its regulators, and then CEO Charles Prince told the FCIC that dealing with those troubles took up more than half his time. After paying the $70 million fine related to subprime mortgage lending, Citigroup again got into trouble, charged with helping Enron, before that company filed for bankruptcy in 2001, use structured finance transactions to manipulate its financial statements. In July 2003, Citigroup agreed to pay the SEC $120 million to settle these allegations, and also agreed, under formal enforcement actions by the Federal Reserve and Office of the Comptroller of the Currency, to overhaul its risk management practices. By March 2005, the Fed had seen enough. It banned Citigroup from making any more major acquisitions until it improved its governance and legal compliance. According to Prince, he had already decided to turn, quote, the company's focus from an acquisition-driven strategy to more of a balanced strategy involving organic growth, unquote. Robert Rubin, a former Treasury Secretary and former Goldman Sachs co-CEO, who was at the time chairman of the executive committee of Citigroup's board of directors, recommended that Citigroup increase its risk-taking, assuming, he told the FCIC, that the firm managed those risks properly. Citigroup's investment bank subsidiary was a natural area for growth after the Fed and then Congress had done away with restrictions on activities that could be pursued by investment banks affiliated with commercial banks. One opportunity among many was the CDO business, which was just then taking off amid the booming mortgage market. In 2003, Citi's CDO desk was a tiny unit in its company's investment banking arm, 8 guys and a Bloomberg terminal, in the words of Nestor Dominguez, then co-head of the desk. Nevertheless, this tiny operation, under the command of Thomas Maheras, co-CEO of the investment bank, had become a leader in the nascent market for CDOs, creating more than $18 billion in 2003 and 2004, close to 1/5 of the market in those years. The 8 guys had picked up on a novel structure pioneered by Goldman Sachs and West LB, a German bank. Instead of issuing the AAA tranches of the CDOs as long-term debt, Citigroup structured them as short-term, asset-backed commercial paper. Of course, using commercial paper introduced liquidity risk, not present when the tranches were sold as long-term debt, because the CDO would have to reissue the paper to investors regularly, usually within days or weeks, for the life of the CDO. But asset-backed commercial paper was a cheap form of funding at the time, and it had a large base of potential investors, particularly among money market mutual funds. To mitigate the liquidity risk and to ensure that the rating agencies would give it their top ratings, Citibank, Citigroup's national bank subsidiary, provided assurances to investors in the form of liquidity puts. In selling the liquidity put, for an ongoing fee, the bank would be on the hook to step in and buy the commercial paper if there were no buyers when it matured, or if the cost of funding rose by a predetermined amount. The CDO team at Citigroup had jumped into the market in July 2003 with a $1.5 billion CDO named Grenadier Funding that included a $1.3 billion tranche backed by a liquidity put from Citibank. Over the next 3 years, Citi would write liquidity puts on $25 billion of commercial paper issued by CDOs, more than any other company. BSAM's 3 Clio CDOs, which Citigroup had underwritten, accounted for just over $10 billion of this total, a large number that would not bode well for the bank. But initially, this strategic initiative, as Dominguez called it, was very profitable for Citigroup. The CDO desk earned roughly 1% of the total deal value in structuring fees for Citigroup's investment banking arm, or about $10 million for a $1 billion deal. In addition, Citigroup would generally charge buyers 0.1% to 0.2% in premiums annually for the liquidity puts. In other words, for a typical $1 billion deal, Citibank would receive $1 to $2 million annually on the liquidity puts alone, practically free money, it seemed, because the trading desk believed that these puts would never be triggered. In effect, the liquidity put was yet another highly leveraged bet, a contingent liability that would be triggered in some circumstances. Prior to the 2004 change in the capital rules regarding liquidity puts, discussed earlier, Citigroup did not have to hold any capital against such contingencies. Rather, it was permitted to use its own risk models to determine the appropriate capital charge. But Citigroup's financial models estimated only a remote possibility that the puts would be triggered. Following the 2004 rule change, Citibank was required to hold 0.16% in capital against the amount of commercial paper supported by the liquidity put, or $1.6 million for a $1 billion liquidity put. Given a $1 to $2 million annual fee for the put, the annual return on that capital could still exceed 100%. No doubt about it, Dominguez told the FCIC. The AAA or similar ratings, the multiple fees, and the low capital requirements made the liquidity puts a much better trade for Citi's balance sheet. The events of 2007 would reveal the fallacy of those assumptions and catapult the entire $25 billion in commercial paper straight onto the bank's balance sheet, requiring it to come up with $25 billion in cash, as well as more capital to satisfy bank regulators. The liquidity puts were approved by Citigroup's Capital Markets Approval Committee, which was charged with reviewing all new financial products. Deeming them to be low risk, the company based its opinions on the credit risk of the underlying collateral, but failed to consider the liquidity risk posed by a general market disruption. The OCC, the supervisor of Citigroup's largest commercial bank subsidiary, was aware that the bank had issued the liquidity puts. However, the terms of the OCC's post-Enron enforcement action focused only on whether Citibank had a process in place to review the product, and not on the risks of the puts to Citibank's balance sheet. Besides Citigroup, only a few large financial institutions, such as AIG Financial Products, BNP, West LB of Germany, and Société Générale of France, wrote significant amounts of liquidity puts on commercial paper issued by CDOs. Bank of America, the biggest commercial bank in the United States, wrote small deals through 2006, but did $6 billion worth in 2007 just before the market crashed. When asked why other market participants were not writing liquidity puts, Dominguez stated that Societe Generale and BNP were big players in that market. Quote, "You needed to be a bank with a strong balance sheet, access to collateral, and existing relationships with collateral managers," unquote, he said. The CDO desk stopped writing liquidity puts in early 2006 when it reached its internal limits. Citibank's treasury function had set a $23 billion cap on liquidity puts. It granted one final exception, bringing the total to $25 billion. Risk management had also set a $25 billion risk limit on top-rated asset-backed securities, which included the liquidity puts. Later, in an October 2006 memo, Citigroup's Financial Control Group criticized the firm's pricing of the puts, which failed to consider the risk that investors would not buy the commercial paper protected by the liquidity puts when it came due, thereby creating a $25 billion cash demand on Citibank. An undated and unattributed internal document, believed to have been drafted in 2006, also questioned one of the practices of Citigroup's investment bank, which paid traders on its CDO desk for generating the deals without regard to later losses. Quote, "There is a potential conflict of interest in pricing the liquidity put cheap so that more CDO equities can be sold and more structuring fee to be generated," unquote. The result would be losses so severe that they would help bring the huge financial conglomerate to the brink of failure, as we will see. End of section 38. Section 39 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 8, AIG, Golden Goose for the Entire Street. In 2004, American International Group was the largest insurance company in the world, as measured by stock market value, a massive conglomerate with $850 billion in assets, 116,000 employees in 130 countries, and 223 subsidiaries. But to Wall Street, AIG's most valuable asset was its credit rating. That it was awarded the highest possible rating, AAA by Moody's since 1986, AAA by S&P since 1983, was crucial, because these sterling ratings let it borrow cheaply and deploy the money in lucrative investments. Only 6 private sector companies in the United States in early 2010 carried those ratings. Starting in 1998, AIG Financial Products, a Connecticut-based unit with major operations in London, figured out a new way to make money from those ratings. Relying on the guarantee of its parent, AIG Financial Products became a major over-the-counter derivatives dealer, eventually having a portfolio of $2.7 trillion in notional amount. Among other derivatives activities, the unit issued credit default swaps guaranteeing debt obligations held by financial institutions and other investors. In exchange for a stream of premium-like payments, AIG Financial Products agreed to reimburse the investor in such a debt obligation in the event of any default. The credit default swap, CDS, is often compared to insurance, but when an insurance company sells a policy, regulations require that it set aside a reserve in case of a loss. Because credit default swaps were not regulated insurance contracts, no such requirement was applicable. In this case, the unit predicted with 99.85% confidence that there would be no realized economic loss on the supposedly safest portions of the CDOs on which they wrote CDS protection, and failed to make any provisions whatsoever for declines in value or unrealized losses, a decision that would prove fatal to AIG in 2008. AIG Financial Products had a huge business selling CDS to European banks on a variety of financial assets, including bonds, mortgage-backed securities, CDOs, and other debt securities. For AIG, the fee for selling protection via the swap appeared well worth the risk. For the banks purchasing protection, the swap enabled them to neutralize the credit risk and thereby hold less capital against its assets. Purchasing credit default swaps from AIG could reduce the amount of regulatory capital that the bank needed to hold against an asset from 8% to 1.6%. By 2005, AIG had written $107 billion in CDS for such regulatory capital benefits. Most were with European banks for a variety of asset types. That total would rise to $379 billion by 2007. The same advantages could be enjoyed by banks in the United States, where regulators had introduced similar capital standards for banks' holdings of mortgage-backed securities and other investments under the recourse rule in 2001. So a credit default swap with AIG could also lower American banks' capital requirements. In 2004 and 2005, AIG sold protection on super senior CDO tranches valued at $54 billion, up from just $2 billion in 2003. In an interview with the FCIC, one AIG executive described AIG Financial Products principal swap salesman, Alan Frost, as, quote, the golden goose for the entire street, unquote. AIG's biggest customer in this business was always Goldman Sachs, consistently a leading CDO underwriter. AIG also wrote billions of dollars of protection for Merrill Lynch, Societe Generale, and other firms. AIG, quote, looked like the perfect customer for this, unquote. Craig Broderick, Goldman's chief risk officer, told the FCIC, quote, they really ticked all the boxes. They were among the highest-rated corporations around. They had what appeared to be unquestioned expertise. They had tremendous financial strength. They had huge, appropriate interest in this space, backed by a long history of trading in it, unquote. AIG also bestowed the imprimatur of its pristine credit rating on commercial paper programs by providing liquidity puts, similar to the ones that Citigroup's bank wrote for many of its own deals, guaranteeing it would buy commercial paper if no one else wanted it. It entered this business in 2002. By 2005, it had written more than $6 billion of liquidity puts on commercial paper issued by CDOs. AIG also wrote more than $7 billion in CDS to protect Societe Generale against the risks on liquidity puts that the French bank itself wrote on commercial paper issued by CDOs. Quote, what we would always try to do is to structure a transaction where the transaction was virtually riskless and get paid a small premium, unquote. Gene Park, who was a managing director at AIG Financial Products, told the FCIC, quote, and we're one of the few guys who can do that. Because if you think about it, no one wants to buy disaster protection from someone who's not going to be around. That was AIG-FP's sales pitch to the street or to banks, unquote. AIG's business of offering credit protection on assets of many sorts, including mortgage-backed securities and CDOs, grew from $20 billion in 2002 to $211 billion in 2005 and $533 billion in 2007. This business was a small part of the AIG Financial Services business unit, which included AIG Financial Products. AIG Financial Services generated operating income of $4.4 billion in 2005, or 29% of AIG's total. AIG did not post any collateral when it wrote these contracts, but unlike monoline insurers, AIG Financial Products agreed to post collateral if the value of the underlying securities dropped, or if the rating agencies downgraded AIG's long-term debt ratings. Its competitors, the monoline financial guarantors, Insurance companies such as MBIA and AMBAC that focused on guaranteeing financial contracts were forbidden under insurance regulations from paying out until actual losses occurred. The collateral posting terms in AIG's credit default swap contracts would have an enormous impact on the crisis about to unfold. But during the boom, these terms didn't matter. The investors got their AAA-rated protection. AIG got its fees for providing that insurance, about 12/100% of the notional amount of the swap per year, and the managers got their bonuses. In the case of the London subsidiary that ran the operation, the bonus pool was 30% of new earnings. Financial Products CEO Joseph J. Cassano made the allocations at the end of the year. Between 2002 and 2007, the least amount Cassano paid himself in a year was $38 million. In the later years, his compensation was sometimes double that of the parent company's CEO. In the spring of 2005, disaster struck. AIG lost its AAA rating when auditors discovered that it had manipulated earnings. By November 2005, the company had reduced its reported earnings over the 5-year period by $3.9 billion. The board forced out Maurice Hank Greenberg, who had been CEO for 38 years. New York Attorney General Elliot Spitzer prepared to bring fraud charges against him. Greenberg told the FCIC, quote, "When the AAA credit rating disappeared in spring 2005, it would have been logical for AIG to have exited or reduced its business of writing credit default swaps," unquote. But that didn't happen. Instead, AIG Financial Products wrote another $36 billion in credit default swaps on super senior tranches of CDOs in 2005. The company wouldn't make the decision to stop writing these contracts until 2006. End of section 39. Section 40 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Goldman Sachs multiplied the effects of the collapse in subprime. Henry Paulson, the CEO of Goldman Sachs from 1999 until he became Secretary of the Treasury in 2006, testified to the FCIC that by the time he became Secretary, many bad loans already had been issued. Quote, "Most of the toothpaste was out of the tube," unquote, and that there really wasn't the proper regulatory apparatus to deal with it. Paulson provided examples. Quote, "Subprime mortgages went from accounting for 5% of total mortgages in 1994 to 20% by 2006. Securitization separated originators from the risk of the products they originated," unquote. The result, Paulson observed, quote, "was a housing bubble that eventually burst in far more spectacular fashion than most previous bubbles," unquote. Under Paulson's leadership, Goldman Sachs had played a central role in the creation and sale of mortgage securities. From 2004 through 2006, the company provided billions of dollars in loans to mortgage lenders. Most went to the subprime lenders Ameriquest, Long Beach, Fremont, New Century, and Countrywide through warehouse lines of credit, often in the form of repos. During the same period, Goldman acquired $53 billion of loans from these and other subprime loan originators, which it securitized and sold to investors. From 2004 to 2006, Goldman issued 318 mortgage securitizations, totaling $184 billion. About a quarter were subprime, and 63 CDOs totaling $32 billion. Goldman also issued 22 synthetic or hybrid CDOs with a face value of $35 billion between 2004 and June 2006. Synthetic CDOs were complex paper transactions involving credit default swaps. Unlike the traditional cash CDO, Synthetic CDOs contained no actual tranches of mortgage-backed securities, or even tranches of other CDOs. Instead, they simply referenced these mortgage securities and thus were bets on whether borrowers would pay their mortgages. In the place of real mortgage assets, these CDOs contained credit default swaps and did not finance a single home purchase. Investors in these CDOs included funded long investors who paid cash to purchase actual securities issued by the CDO, unfunded long investors who entered into swaps with the CDO, making money if the reference securities performed, and short investors who bought credit default swaps on the reference securities, making money if the securities failed. While funded investors received interest if the reference securities performed, they could lose all of their investment if the reference securities defaulted. Unfunded investors, which were highest in the payment waterfall, received premium-like payments from the CDO as long as the reference securities performed, but would have to pay if the reference securities deteriorated beyond a certain point, and if the CDO did not have sufficient funds to pay the short investors. Short investors, often hedge funds, bought the credit default swaps from the CDOs and paid those premiums. Hybrid CDOs were a combination of traditional and synthetic CDOs. Firms like Goldman found synthetic CDOs cheaper and easier to create than traditional CDOs, at the same time as the supply of mortgages was beginning to dry up. Because there were no mortgage assets to collect and finance, creating synthetic CDOs took a fraction of the time. They were also easier to customize because CDO managers and underwriters could reference any mortgage-backed security. They were not limited to the universe of securities available for them to buy. Figure 8.2 provides an example of how such a deal worked. Figure 8.2 is labeled Synthetic CDO. Synthetic CDOs, such as Goldman Sachs's Abacus 2004-1 deal, were complex paper transactions involving credit default swaps. Group 1 was short investors. Short investors enter into credit default swaps with the CDO, referencing assets such as mortgage-backed securities. The CDO receives swap premiums. If the reference securities do not perform, the CDO pays out to the short investors. Group 2, unfunded investors. Unfunded investors, who typically buy the super senior tranche, are effectively in a swap with the CDO and receive premiums. If the reference securities do not perform and there are not enough funds within the CDO, the investors pay. Group 3, funded investors. Funded investors, bondholders, invest cash and expect interest and principal payments. They typically incur losses before the unfunded investors. Finally, 4, the cash pool. The CDO would invest cash received from the bondholders in presumably safe assets. The complete Figure 8.2 can be viewed on page 144 of the printed version of the report. Returning to the text. In 2004, Goldman launched its first major synthetic CDO, Abacus 2004-1, a deal worth $2 billion. About one-third of the swaps referenced residential mortgage-backed securities. Another third referenced existing CDOs, and the rest commercial mortgage-backed securities made up of bundled commercial real estate loans and other securities. Goldman was the short investor for the entire $2 billion deal. It purchased credit default swap protection on these reference securities from the CDO. The funded investors, IKB, a German bank, the TCW Group, and Wachovia, put up a total of $195 million to purchase mezzanine tranches of the deal. These investors would receive scheduled principal and interest payments if the referenced assets performed. If the referenced assets did not perform, Goldman, as the short investor, would receive the $195 million. In this sense, IKB, TCW, and Wachovia were long investors, betting that the referenced assets would perform well, and Goldman was a short investor, betting that they would fail. The unfunded investors, TCW and GSC Partners, asset management firms that managed both hedge funds and CDOs, did not put up any money up front. They received annual premiums from the CDO in return for the promise that they would pay the CDO if the reference securities failed and the CDO did not have enough funds to pay the short investors. Goldman was the largest unfunded investor at the time that the deal was originated, retaining the $1.8 billion super senior tranche. Goldman's $2 billion short position more than offset that exposure. About 1 year later, it transferred the unfunded long position by buying credit protection from AIG in return for an annual payment of $2.2 million. As a result, by 2005, AIG was effectively the largest unfunded investor in the super senior tranches of the Abacus deal. All told, long investors in Abacus 2004-1 stood to receive millions of dollars if the reference securities performed, just as a bond investor makes money when a bond performs. On the other hand, Goldman stood to gain nearly $2 billion if the assets failed. In the end, Goldman, the short investor in the Abacus 2004-1 CDO, has received about $930 million, while the long investors have lost just about all of their investments. In April 2008, GSC paid Goldman $7.3 million as a result of CDS protection sold by GSC to Goldman on the first and second loss tranches. In June 2009, Goldman received $806 million from AIG Financial Products as a result of the CDS protection it purchased against the super senior tranche. The same month, it received $23 million from TCW as a result of the CDS purchased against the junior mezzanine tranches, and $30 million from IKB because of the CDS it purchased against the C tranche. In April 2010, IKB paid Goldman another $40 million as a result of the CDS against the B tranche. Through May 2010, Goldman received $24 million from IKB, Wachovia, and TCW as a result of the credit default swaps against the A tranche. As was common, some of the tranches of Abacus 2004-1 found their way into other funds and CDOs. For example, TCW put tranches of Abacus 2004-1 into 3 of its own CDOs. In total, between July 1, 2004 and May 31, 2007, Goldman packaged and sold 47 synthetic CDOs with an aggregate face value of $66 billion. Its underwriting fee was 0.5% to 1.5% of the deal totals. Dan Sparks, the former head of Goldman's mortgage desk, told the FCIC. Goldman would earn profits from shorting many of these deals. On others, it would profit by facilitating the transaction between the buyer and the seller of credit default swap protection. As we will see, these new instruments would yield substantial profits for investors that held a short position in the synthetic CDOs. That is, investors betting that the housing boom was a bubble about to burst. They also would multiply losses when housing prices collapsed. When borrowers defaulted on their mortgages, the investors expecting cash from the mortgage payments lost, and investors betting on these mortgage-backed securities via synthetic CDOs also lost, while those betting against the mortgages would gain. As a result, the losses from the housing collapse were multiplied exponentially. To see this play out, we can return to our illustrative Citigroup mortgage-backed securities deal CMLTI 2006-NC2. Credit default swaps made it possible for new market participants to bet for or against the performance of these securities. Synthetic CDOs significantly increased the demand for such bets. For example, there were about $12 million worth of bonds in the M9 BBB rated tranche, one of the mezzanine tranches of the security. Synthetic CDOs such as Auriga, Volans, and Neptune CDO4 all contained credit default swaps in which the M9 tranche was referenced. As long as the M9 bonds performed, investors betting that the tranche would fail, short investors, would make regular payments into the CDO, which would be paid out to other investors banking on it to succeed, long investors. If the M9 bonds defaulted, then the long investors would make large payments to the short investors. That is the bet. And there were more than $50 million in such bets in early 2007 on the M9 tranche of this deal. Thus, on the basis of the performance of $12 million in bonds, more than $60 million could potentially change hands. Goldman's Sparks put it succinctly to the FCIC. If there's a problem with a product, synthetics increase the impact. The amplification of the M9 tranche was not unique. A $15 million tranche of the Glacier Funding CDO 2006-4A, rated A, was referenced in $85 million worth of synthetic CDOs. A $28 million tranche of the Soundview Home Equity Loan Trust 2006-EQ1, also rated A, was referenced in $79 million worth of synthetic CDOs. A $13 million tranche of the Soundview Home Equity Loan Trust 2006-EQ1, rated BBB, was referenced in $49 million worth of synthetic CDOs. In total, synthetic CDOs created by Goldman referenced 3,408 mortgage securities, some of them multiple times. For example, 610 securities were referenced twice. Indeed, one single mortgage-backed security was referenced in 9 different synthetic CDOs created by Goldman Sachs. Because of such deals, when the housing bubble burst, billions of dollars changed hands. Although Goldman executives agreed that synthetic CDOs were bets that magnified overall risk, they also maintained that their creation had social utility because it added liquidity to the market and enabled investors to customize the exposures they wanted in their portfolios. In testimony before the commission, Goldman's president and chief operating officer, Gary Cohn, argued, quote, "This is no different than the tens of thousands of swaps written every day on the U.S. dollar versus another currency, or, more importantly, on U.S. treasuries. This is the way that the financial markets work," unquote. Others, however, criticized these deals. Patrick Parkinson, the current director of the Division of Banking Supervision and Regulation at the Federal Reserve Board, noted that synthetic CDOs, quote, "multiplied the effects of the collapse in subprime," unquote. Other observers were even harsher in their assessment. Quote, "I don't think they have social value," unquote. Michael Greenberger, a professor at the University of Maryland School of Law and former director of the Division of Trading and Markets at the Commodities Futures Trading Commission, told the FCIC. He characterized the credit default swap market as a casino. And he testified that, quote, "the concept of lawful betting of billions of dollars on the question of whether a homeowner would default on a mortgage that was not owned by either party has had a profound effect on the American public and taxpayers." End of section 40. Section 41 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Moody's, achieved through some alchemy. The machine churning out CDOs would not have worked without the stamp of approval given to these deals by the three leading rating agencies, Moody's, S&P, and Fitch. Investors often relied on the rating agencies' views rather than conduct their own credit analysis. Moody's was paid according to the size of each deal, with caps set at $500,000 for a standard CDO in 2006 and 2007, and as much as $850,000 for a complex CDO. In rating both synthetic and cash CDOs, Moody's faced two key challenges. First, estimating the probability of default for the mortgage-backed securities purchased by the CDO or its synthetic equivalent, and second, gauging the correlation between those defaults, that is, the likelihood that the securities would default at the same time. Imagine flipping a coin to see how many times it comes up heads. Each flip is unrelated to the others, that is, the flips are uncorrelated. Now, imagine a loaf of sliced bread. When there is one moldy slice, there are likely other moldy slices. The freshness of each slice is highly correlated with that of the other slices. As investors now understand, the mortgage-backed securities in CDOs were less like coins than like slices of bread. To estimate the probability of default, Moody's relied almost exclusively on its own ratings of the mortgage-backed securities purchased by the CDOs. At no time did the agencies look through the securities to the underlying subprime mortgages. Quote, "We took the rating that had already been assigned by the mortgage-backed securities group," unquote. Gary Witt, formerly one of Moody's team managing directors for the CDO unit, told the FCIC. This approach would lead to problems for Moody's and for investors. Witt testified that the underlying collateral, quote, "just completely disintegrated below us, and we didn't react, and we should have. We had to be looking for a problem, and we weren't looking," unquote. To determine the likelihood that any given security in the CDO would default, Moody's plugged in assumptions based on those original ratings. This was no simple task. Meanwhile, if the initial ratings turned out, owing to poor underwriting, fraud, or any other cause, to poorly reflect the quality of the mortgages in the bonds, the error was blindly compounded when mortgage-backed securities were packaged into CDOs. Even more difficult was the estimation of the default correlation between the securities in the portfolio. Always tricky, but particularly so in the case of CDOs consisting of subprime and Alt-A mortgage-backed securities that had only a short performance history. So the firm explicitly relied on the judgment of its analysts. Quote, "In the absence of meaningful default data, it's impossible to develop empirical default correlation measures based on actual observations of defaults," unquote. Moody's acknowledged in one early explanation of its process. In plainer English, Witt said, Moody's didn't have a good model on which to estimate correlations between mortgage-backed securities, so they made them up. He recalled, quote, "They went to the analyst in each of the groups and they said, well, you know, how related do you think these types of mortgage-backed securities are?" Unquote. This problem would become more serious with the rise of CDOs in the middle of the decade. Witt felt strongly that Moody's needed to update its CDO rating model to explicitly address the increasing concentration of risky mortgage-related securities in the collateral underlying CDOs. He undertook two initiatives to address this issue. First, in mid-2004, he developed a new rating methodology that directly incorporated correlation into the model. However, the technique he devised was not applied to CDO ratings for another year. Second, he proposed a research initiative in early 2005 to look through a few CDO deals at the level of the underlying mortgage-backed securities, and to see if, quote, the assumptions that we're making for AAA CDOs are consistent with the correlation assumptions that we're making for AAA mortgage-backed securities, unquote. Although Witt received approval from his superiors for this investigation, contractual disagreements prevented him from buying the software he needed to conduct the look-through analysis. In June 2005, Moody's updated its approach for estimating default correlation, but it based the new model on trends from the previous 20 years, a period when housing prices were rising and mortgage delinquencies were very low, and a period in which non-traditional mortgage products had a very small niche. Then Moody's modified this optimistic set of empirical assumptions with ad hoc adjustments based on factors such as region, year of origination, and servicer. For example, if two mortgage-backed securities were issued in the same region, say Southern California, Moody's boosted the correlation. If they shared a common mortgage servicer, Moody's boosted it further. But at the same time, it would make other technical choices that lowered the estimated correlation of default, which would improve the ratings for these securities. Using these methods, Moody's estimated that two mortgage-backed securities would be less closely correlated than two securities backed by other consumer credit assets, such as credit card or auto loans. The other major rating agencies followed a similar approach. Academics, including some who worked at regulatory agencies, cautioned investors that assumption-heavy CDO credit ratings could be dangerous. Quote, the complexity of structured finance transactions may lead to situations where investors tend to rely more heavily on ratings than for other types of rated securities. On this basis, the transformation of risk involved in structured finance gives rise to a number of questions with important potential implications. One such question is whether tranched instruments might result in unanticipated concentrations of risk in institutions' portfolios, unquote. A report from the Bank for International Settlements, an international financial organization sponsored by the world's regulators and central banks, warned in June 2005. CDO managers and underwriters relied on the ratings to promote the bonds. For each new CDO, they created marketing material, including a pitch book that investors used to decide whether to subscribe to a new CDO. Each book described the type of assets that would make up the portfolio without providing details. Without exception, every pitch book examined by the FCIC staff cited an analysis from either Moody's or S&P that contrasted the historical stability of these new products ratings with the stability of corporate bonds. Statistics that made this case included the fact that between 1983 and 2006, 92% of these new products did not experience any rating changes over a 12-month period, while only 78% of corporate bonds maintained their ratings. Over a longer time period, however, structured finance ratings were not so stable. Between 1983 and 2006, only 56% of AAA-rated structured finance securities retained their original rating after 5 years. Underwriters continued to sell CDOs using these statistics in their pitch books during 2006 and 2007, after mortgage defaults had started to rise, but before the rating agencies had downgraded large numbers of mortgage-backed securities. Of course, each pitch book did include the disclaimer that, quote, past performance is not a guarantee of future performance, unquote, and encouraged investors to perform their own due diligence. As Kyle Bass of Dallas-based Heyman Capital Advisors testified before the House Financial Services Committee, CDOs that purchase lower-rated tranches of mortgage-backed securities, quote, are arcane structured finance products that were designed specifically to make dangerous, lowly rated tranches of subprime debt deceptively attractive to investors. This was achieved through some alchemy and some negligence in adapting unrealistic correlation assumptions on behalf of the ratings agencies. They convinced investors that 80% of a collection of toxic subprime tranches were the ratings equivalent of U.S. government bonds, unquote. When housing prices started to fall nationwide and defaults increased, it turned out that the mortgage-backed securities were, in fact, much more highly correlated than the rating agencies had estimated. That is, they stopped performing at roughly the same time. These losses led to massive downgrades in the ratings of the CDOs. In 2007, 20% of U.S. CDO securities would be downgraded. In 2008, 91% would. In late 2008, Moody's would throw out its key CDO assumptions and replace them with an asset correlation assumption 2 to 3 times higher than used before the crisis. In retrospect, it is clear that the agency's CDO models made two key mistakes. First, they assumed that securitizers could create safer financial products by diversifying among many mortgage-backed securities, when in fact these securities weren't that different to begin with. Quote, there were a lot of things the credit rating agencies did wrong, unquote. Federal Reserve Chairman Ben Bernanke told the FCIC, quote, they did not take into account the appropriate correlation between and across the categories of mortgages, unquote. Second, the agencies based their CDO ratings on ratings they themselves had assigned on the underlying collateral. Quote, the danger with CDOs is when they're based on structured finance ratings, unquote. Ann Rutledge, a structured finance expert, told the FCIC, quote, ratings are not predictive of future defaults. They only describe a ratings management process and a mean and static expectation of security loss, unquote. Of course, rating CDOs was a profitable business for the rating agencies, including all types of CDOs, not just those that were mortgage-related. Moody's rated 220 deals in 2004, 363 in 2005, 749 in 2006, and 717 in 2007. The value of those deals rose from $90 billion in 2004 to $162 billion in 2005, $337 billion in 2006, and $326 billion in 2007. The reported revenues of Moody's Investors Service from structured products, which included mortgage-backed securities and CDOs, grew from $199 million in 2000, or 33% of Moody's Corporation's revenues, to $887 million in 2006, or 44% of overall corporate revenue. The rating of asset-backed CDOs alone contributed more than 10% of the revenue from structured finance. The boom years of structured finance coincided with a company-wide surge in revenue and profits. From 2000 to 2006, the corporation's revenues surged from $602 million to $2 billion, and its profit margin climbed from 26% to 37%. Yet the increase in the CDO group's workload and revenue was not paralleled by a staffing increase. Quote, we were under-resourced, we were always playing catch-up, unquote, Witt said. Moody's penny-pinching and stingy management was reluctant to pay up for experienced employees. Quote, the problem of recruiting and retaining good staff was insoluble. Investment banks often hired away our best people. As far as I can remember, we were never allocated funds to make counteroffers, unquote, Witt said. Quote, we had almost no ability to do meaningful research, unquote. Eric Kolchinsky, a former team managing director at Moody's, told the FCIC that from 2004 to 2006, the increase in the number of deals rated was, quote, huge, but our personnel did not go up accordingly, unquote. By 2006, Kolchinsky recalled, quote, my role as a team manager was crisis management. Every deal was a crisis, unquote. When personnel worked to create a new methodology, Witt said, quote, we had to kind of do it in our spare time, unquote. The agencies worked closely with CDO underwriters and managers as each new CDO was devised, and the rating agencies now relied for a substantial amount of their revenues on a small number of players. Citigroup and Merrill alone accounted for more than $140 billion of CDO deals between 2005 and 2007. The ratings agency's correlation assumptions had a direct and critical impact on how CDOs were structured. Assumptions of a lower correlation made possible larger, easy-to-sell AAA tranches and smaller, harder-to-sell BBB tranches. Thus, as is discussed later, underwriters crafted the structure to earn more favorable ratings from the agencies, for example, by increasing the size of the senior tranches. Moreover, because issuers could choose which rating agencies to do business with, and because the agencies depended on the issuers for their revenues, rating agencies felt pressured to give favorable ratings so that they might remain competitive. The pressure on rating agency employees was also intense as a result of the high turnover, a revolving door that often left raters dealing with their old colleagues, this time as clients. In her interview with FCIC staff, Yuri Yoshizawa, a Moody's team managing director for U.S. derivatives in 2005, was presented with an organization chart from July 2005. She identified 13 out of 51 analysts, about 25% of the staff, who had left Moody's to work for investment or commercial banks. Brian Clarkson, who oversaw the structured finance group before becoming the president of Moody's Investors Service, explained to FCIC investigators that retaining employees was always a challenge, for the simple reason that the banks paid more. As a precaution, Moody's employees were prohibited from rating deals by a bank or issuer while they were interviewing for a job with that particular institution. But the responsibility for notifying management of the interview rested on the employee. After leaving Moody's, former employees were barred from interacting with Moody's on the same series of deals they had rated while in its employ. But there were no bans against working on other deals with Moody's. End of section 41. Section 42 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. SEC, it's going to be an awfully big mess. The 5 major U.S. investment banks expanded their involvement in the mortgage and mortgage securities industries in the early 21st century with little formal government regulation beyond their broker-dealer subsidiaries. In 2002, the European Union told U.S. financial firms that to continue to do business in Europe, they would need a consolidated supervisor by 2004. That is, one regulator that had responsibility for the holding company. The U.S. commercial banks already met that criterion. Their consolidated supervisor was the Federal Reserve, and the Office of Thrift Supervision's oversight of AIG would later also satisfy the Europeans. The 5 investment banks, however, did not meet the standard. The SEC was supervising their securities arms, but no one supervisor kept track of these companies on a consolidated basis. Thus, all 5 faced an important decision. What agency would they prefer as their regulator? By 2004, the combined assets at the 5 firms totaled $2.5 trillion, more than half of the $4.7 trillion of assets held by the 5 largest U.S. bank holding companies. In the next 3 years, the investment bank's assets would grow to $4.3 trillion. Goldman Sachs was the largest, followed by Morgan Stanley and Merrill, then Lehman and Bear. These large, diverse international firms had transformed their business models over the years. For their revenues, they relied increasingly on trading and OTC derivatives dealing, investments, securitization, and similar activities on top of their traditional investment banking functions. Recall that at Bear Stearns, trading and investments accounted for more than 100% of pre-tax earnings in some years after 2002. The investment banks also owned depository institutions through which they could provide FDIC-insured accounts to their brokerage customers. The deposits provided cheap but limited funding. These depositories took the form of a thrift, supervised by the OTS, or an industrial loan company, supervised by the Federal Deposit Insurance Corporation and a state supervisor. Merrill and Lehman, which had among the largest of these subsidiaries, used them to finance their mortgage origination activities. The investment bank's possession of depository subsidiaries suggested 2 obvious choices when they found themselves in need of a consolidated supervisor. If a firm chartered its depository as a commercial bank, the Fed would be its holding company supervisor. If as a thrift, the OTS would do the job. But the investment banks came up with a third option. They lobbied the SEC to devise a system of regulation that would satisfy the terms of the European directive and keep them from European oversight. And the SEC was willing to step in, although its historical focus was on investor protection. In November 2003, almost a year after the Europeans made their announcement, the SEC suggested the creation of the Consolidated Supervised Entity, or CSE, program to oversee the holding companies of investment banks and all their subsidiaries. The CSE program was open only to investment banks that had large U.S. broker-dealer subsidiaries already subject to SEC regulation. However, this was the SEC's first foray into supervising firms for safety and soundness. The SEC did not have express legislative authority to require the investment banks to submit to consolidated regulation, so it proposed that the CSE program be voluntary. The SEC crafted the new program out of its authority to make rules for the broker-dealer subsidiaries of investment banks. The program would apply to broker-dealers that volunteered to be subject to consolidated supervision under the CSE program, or those that already were subject to supervision by the Fed at the holding company level, such as J.P. Morgan and Citigroup. The CSE program would introduce a limited form of supervision by SEC examiners. CSE firms were allowed to use a new methodology to calculate the regulatory capital that they were holding against their securities portfolios, a methodology based on the volatility of market prices. This methodology, referred to as the alternative net capital rule, would be similar to the standards based on the 1996 Market Risk Amendment to the Basel Rules that large commercial banks and bank holding companies used for their securities portfolios. The traditional net capital rule that had governed broker-dealers since 1975 had required straightforward calculations based on asset classes and credit ratings, a bright-line approach that gave firms little discretion in calculating their capital. The new rules would allow the investment banks to create their own proprietary value at risk, or VAR models, to calculate their regulatory capital. That is, the capital each firm would have to hold to protect its customers' assets should it experience losses on its securities and derivatives. All in all, the SEC estimated that the proposed new reliance on proprietary VAR models would allow broker-dealers to reduce average capital charges by 40%. The firms would be required to give the SEC an early warning notice if their tentative net capital minus hard-to-sell assets, fell below $5 billion at any time. Meanwhile, the OTS was already supervising the thrifts owned by several securities firms and argued that it, therefore, was the natural supervisor of their holding companies. In a letter to the SEC, the OTS was harshly critical of the agency's proposal, which it said had, quote, the potential to duplicate or conflict with OTS's supervisor responsibilities over savings and loan holding companies that would also be CSEs. The OTS argued that the SEC was interfering with the intentions of Congress, which, in the Gramm-Leach-Bliley Act, quote, carefully kept the responsibility for supervision of the holding company itself with the OTS or the Federal Reserve Board, depending on whether the holding company was a thrift holding company or a bank holding company. This was in recognition of the expertise developed over the years by these regulators in evaluating the risks posed to depository institutions and the federal deposit insurance funds by depository institution holding companies and their affiliates, unquote. The OTS declared, quote, we believe that the SEC's proposed assertion of authority over savings and loan holding companies is unfounded and could pose significant risks to these entities, their insured deposit institution subsidiaries, and the federal deposit insurance funds, unquote. In contrast, the response from the financial services industry to the SEC proposal was overwhelmingly positive, particularly with regard to the alternative net capital computation. Lehman Brothers, for example, wrote that it, quote, applauds and supports the commission, unquote. J.P. Morgan was supportive of what it saw as an improvement over the old net capital rule that still governed securities subsidiaries of the commercial banks. Quote, the existing capital rule overstates the amount of capital a broker-dealer needs, unquote, the company wrote. Deutsche Bank found it to be, quote, a great stride toward consistency with modern comprehensive risk management practices, unquote. In FCIC interviews, SEC officials and executives at the investment banks stated that the firms preferred the SEC because it was more familiar with their core securities-related businesses. In an April 2004 meeting, SEC commissioners voted to adopt the CSE program and the new net capital calculations that went along with it. Over the following year and a half, the 5 largest investment banks volunteered for this supervision, although Merrill's and Lehman's thrifts continued to be supervised by the OTS. Several firms delayed entry to the program in order to develop systems that could measure their exposures to market price movements. Harvey Goldschmidt, SEC Commissioner from 2002 to 2005, told FCIC staff that before the CSE program was created, SEC staff members were concerned about how little authority they had over the Wall Street firms, including their hedge funds and overseas subsidiaries. Once the CSE program was in place, the SEC had, quote, the authority to look at everything, unquote. SEC commissioners discussed at the time the risks they were taking by allowing firms to reduce their capital. Quote, if anything goes wrong, it's going to be an awfully big mess, unquote. Goldschmidt said at a 2004 meeting, quote, do we feel secure if these drops in capital and other things occur, we really will have investor protection, unquote? In response, Annette Nazareth, the SEC official who would be in charge of the program, assured the commissioners that her division was up to the challenge. The new program was housed primarily in the SEC's Office of Prudential Supervision and Risk Analysis, an office with a staff of 10 to 12 within the Division of Market Regulation. In the beginning, it was supported by the SEC's much larger examination staff. By 2008, the staff dedicated to the CSE program had grown to 24. Still, only 10 monitors were responsible for the 5 investment banks. 3 monitors were assigned to each firm with some overlap. The CSE program was based on the bank supervision model, but the SEC did not try to do exactly what bank examiners did. For one thing, unlike supervisors of large banks, the SEC never assigned on-site examiners under the CSE program. By comparison, the OCC alone assigned more than 60 examiners full-time at Citibank. According to Eric Seary, the SEC's former director of trading and markets, the CSE program was intended to focus mainly on liquidity because, unlike a commercial bank, a securities firm traditionally had no access to a lender of last resort. Of course, that would change during the crisis. The investment banks were subject to annual examinations, during which staff reviewed the firm's systems and records and verified that the firms had instituted control processes. The CSE program was troubled from the start. The SEC conducted an exam for each investment bank when it entered the program. The result of Bear Stearns' entrance exam in 2005 showed several deficiencies. For example, examiners were concerned that there were no firm-wide VAR limits, and that contingency funding plans relied on overly optimistic stress scenarios. In addition, the SEC was aware of the firm's concentration of mortgage securities and its high leverage. Nonetheless, the SEC did not ask Bear to change its asset balance, decrease its leverage, or increase its cash liquidity pool, all actions well within its prerogative, according to SEC officials. Then, because the CSE program was preoccupied with its own staff reorganization, Bear did not have its next annual exam, during which the SEC was supposed to be on site. The SEC did meet monthly with all CSE firms, including Bear, and it did conduct occasional targeted examinations across firms. In 2006, the SEC worried that Bear was too reliant on unsecured commercial paper funding, and Bear reduced its exposure to unsecured commercial paper and increased its reliance on secured repo lending. Unfortunately, tens of billions of dollars of that repo lending was overnight funding that could disappear with no warning. Ironically, in the second week of March 2008, when the firm went into its 4-day death spiral, the SEC was on site, conducting its first CSE exam since Bear's entrance exam more than 2 years earlier. Leverage at the investment banks increased from 2004 to 2007, growth that some critics have blamed on the SEC's change in the net capital rules. Goldschmidt told the FCIC that the increase was owed to, quote, a wild capital time and the firms being irresponsible, unquote. In fact, leverage had been higher at the 5 investment banks in the late 1990s, then dropped before increasing over the life of the CSE program, a history that suggests that the program was not solely responsible for the changes. In 2009, Seary noted that under the CSE program, the investment bank's net capital levels, quote, remained relatively stable and, in some cases, increased significantly, unquote, over the program. Still, Goldschmidt, who left the SEC in 2005, argued that the SEC had the power to do more to rein in the investment banks. He insisted, quote, there was much more than enough moral suasion and kind of practical power that was involved. The SEC has the practical ability to do a lot if it uses its power, unquote. Overall, the CSE program was widely viewed as a failure. From 2004 until the financial crisis, all 5 investment banks continued their spectacular growth, relying heavily on short-term funding. Former SEC Chairman Christopher Cox called the CSE supervisory program, quote, fundamentally flawed from the beginning, unquote. Mary Shapiro, the current SEC chairman, concluded that the program, quote, was not successful in providing prudential supervision, unquote. And as we will see in the chapters ahead, the SEC's Inspector General would be quite critical too. In September 2008, in the midst of the financial crisis, the CSE program was discontinued after all 5 of the largest independent investment banks had either closed down, Lehman Brothers, merged into other entities, Bear Stearns and Merrill Lynch, or converted to bank holding companies to be supervised by the Federal Reserve, Goldman Sachs and Morgan Stanley. For the Fed, there would be a certain irony in that last development concerning Goldman and Morgan Stanley. Fed officials had seen their agency's regulatory purview shrinking over the course of the decade, as J.P. Morgan switched the charter of its banking subsidiary to the OCC, and as the OTS and SEC promoted their alternatives for consolidated supervision. Quote, the OTS and SEC were very aggressive in trying to promote themselves as a regulator in that environment and wanted to be the consolidated supervisor to meet the requirements in Europe for a consolidated supervisor, unquote, said Mark Olson, a Fed governor from 2001 to 2006. There was a lot of competitiveness among the regulators, unquote. In January 2008, Fed staff had prepared an internal study to find out why none of the investment banks had chosen the Fed as its consolidated supervisor. The staff interviewed 5 firms that already were supervised by the Fed and 4 that had chosen the SEC. According to the report, the biggest reason firms opted not to be supervised by the Fed was the comprehensiveness of the Fed's supervisory approach, particularly when compared to alternatives, such as Office of Thrift Supervision, OTS, or Securities and Exchange Commission, SEC, holding company supervision. End of section 42. Section 43 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 8. The Commission concludes declining demand for riskier portions, or tranches, of mortgage-related securities led to the creation of an enormous volume of collateralized debt obligations, or CDOs. These CDOs, composed of the riskier tranches, fueled demand for non-prime mortgage securitization and contributed to the housing bubble. Certain products also played an important role in doing so, including CDO squared, credit default swaps, synthetic CDOs, and asset-backed commercial paper programs that invested in mortgage-backed securities and CDOs. Many of these risky assets ended up on the balance sheet of systematically important institutions and contributed to their failure or near failure in the financial crisis. Credit default swaps, sold to provide protection against default to purchasers of the top-rated tranches of CDOs, facilitated the sale of those tranches by convincing investors of their low risk, but greatly increased the exposure of the sellers of the credit default swap protection to the housing bubble's collapse. Synthetic CDOs, which consisted in whole or in part of credit default swaps, enabled securitization to continue and expand, even as the mortgage market dried up, and provided speculators with a means of betting on the housing market. By layering on correlated risk, they spread and amplified exposure to losses when the housing market collapsed. The high ratings erroneously given CDOs by credit rating agencies encouraged investors and financial institutions to purchase them, and enabled the continuing securitization of non-prime mortgages. There was a clear failure of corporate governance at Moody's, which did not ensure the quality of its ratings on tens of thousands of mortgage-backed securities and CDOs. The Securities and Exchange Commission's poor oversight of the 5 largest investment banks failed to restrict their risky activities and did not require them to hold adequate capital and liquidity for their activities, contributing to the failure or need for government bailouts of all 5 of the supervised investment banks during the financial crisis. End of section 43. Section 44 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Section 44, Chapter 9, All In. The Bubble, a Credit-induced Boom. In 2003, the Bakersfield, California homebuilder Warren Peterson was paying as little as $35,000 for a 10,000 square foot lot, about the size of 3 tennis courts. The next year, the cost more than tripled to $120,000 as real estate boomed. Over the preceding quarter century, Peterson had built between 3 and 10 custom and semi-custom homes a year. For a while, he was building as many as 30. And then came the crash. "I have built exactly 1 new home since late 2005, he told the FCIC 5 years later. In 2003, the average price was $155,000 for a new house in Bakersfield, at the southern end of California's agricultural center, the San Joaquin Valley. That jumped to almost $300,000 by June 2006. Quote, "By 2004, money seemed to be coming in very fast and from everywhere," unquote, said Lloyd Plank, a Bakersfield real estate broker. Quote, "They would purchase a house in Bakersfield, keep it for a short period, and resell it. Sometimes they would flip the house while it was still in escrow and would still make 20% to 30%, unquote. Nationally, housing prices jumped 152% between 1997 and their peak in 2006, more than in any decade since at least 1920. It would be catastrophically downhill from there. Yet the mortgage machine kept churning well into 2007, apparently indifferent to the fact that housing prices were starting to fall and lending standards to deteriorate. Newspaper stories highlighted the weakness in the housing market, even suggesting this was a bubble that could burst any time. Checks were in place, but they were failing. Loan purchasers and securitizers ignored their own due diligence on what they were buying. The Federal Reserve and the other regulators increasingly recognized the impending troubles in housing, but thought their impact would be contained. Increased securitization, lower underwriting standards, and easier access to credit were common in other markets too. For example, credit was flowing into commercial real estate and corporate loans. How to react to what increasingly appeared to be a credit bubble? Many enterprises, such as Lehman Brothers and Fannie Mae, pushed deeper. All along the assembly line, from the origination of the mortgages to the creation and marketing of the mortgage-backed securities and collateralized debt obligations, or CDOs, many understood, and the regulators at least suspected, that every cog was reliant on the mortgages themselves, which would not perform as advertised. The Bubble, a Credit-induced Boom. Irvine, California-based New Century, once the nation's second-largest subprime lender, ignored early warnings that its own loan quality was deteriorating and stripped power from 2 risk control departments that had noted the evidence. In a June 2004 presentation, the quality assurance staff reported they had found severe underwriting errors, including evidence of predatory lending, legal and state violations, and credit issues in 25% of the loans they audited, in November and December 2003. In 2004, Chief Operating Officer and later CEO Brad Morris recommended these results be removed from the statistical tools used to track loan performance. And in 2005, the department was dissolved and its personnel terminated. The same year, the Internal Audit Department identified numerous deficiencies in loan files. Out of 9 reviews it conducted in 2005, it gave the company's loan production department unsatisfactory ratings 7 times. Patrick Flanagan, president of New Century's mortgage originating subsidiary, cut the department's budget, saying in a memo that the, quote, group was out of control and tries to dictate business practices instead of audit, unquote. This happened as the company struggled with increasing requests that it buy back soured loans from investors. By December 2006, almost 17% of its loans were going into default within the first 3 months after origination. Quote, New Century had a brazen obsession with increasing loan originations, without due regard to the risks associated with that business strategy, unquote, New Century's bankruptcy examiner reported. In September 2005, 7 months before the housing market peaked, thousands of originators, securitizers, and investors met at the AB East 2005 conference in Boca Raton, Florida, to play golf, do deals, and talk about the market. The asset-backed security business was still good, but even the most optimistic could read the signs. Panelists had 3 concerns. Were housing prices overheated or just driven by fundamentals such as increased demand? Would rising interest rates halt the market? And was the CDO, because of its rating-driven investors, distorting the mortgage market? The numbers were stark. Nationwide, house prices had never risen so far, so fast, and national indices masked important variations. House prices in the 4 sand states, especially California, had dramatically larger spikes and subsequent declines than did the nation. If there was a bubble, perhaps, as Fed Chairman Alan Greenspan said, it was only in certain regions. He told a congressional committee in June 2005 that growth in non-prime mortgages was helping to push home prices in some markets to unsustainable levels. Quote, although a bubble in home prices for the nation as a whole does not appear likely, unquote. Globally, prices jumped in many countries around the world during the 2000s. As Christopher Mayer, an economist from Columbia Business School, noted to the commission, quote, what really sticks out is how unremarkable the United States house price experience is relative to our European peers, unquote. From 1997 to 2007, price increases in the United Kingdom and Spain were above those in the United States, while price increases in Ireland and France were just below. In an International Monetary Fund study from 2009, more than 1/2 of the 21 developed countries analyzed had greater home price appreciation than the United States from late 2001 through the 3rd quarter of 2006. And yet, some of these countries did not suffer sharp price declines. Notably, Canada had strong home price increases, followed by a modest and temporary decline in 2009. Researchers at the Federal Reserve Bank of Cleveland attributed Canada's experience to tighter lending standards than in the United States, as well as regulatory and structural differences in the financial system. Other countries, such as the United Kingdom, Ireland, and Spain, saw steep house price declines. American economists and policymakers struggled to explain the house price increases. The good news was the economy was growing and unemployment was low. But a Federal Reserve study in May 2005 presented evidence that the cost of owning rather than renting was much higher than had been the case historically. Home prices had risen from 20 times the annual cost of renting to 25 times. In some cities, the change was particularly dramatic. From 1997 to 2006, the ratio of house prices to rents rose in Los Angeles, Miami, and New York City by 147%, 121%, and 98%, respectively. In 2006, the National Association of Realtors Affordability Index, which measures whether a typical family could qualify for a mortgage on a typical home, had reached a record low. But that was based on the cost of a traditional mortgage with a 20% down payment, which was no longer required. Perhaps such measures were no longer relevant. When Americans could make lower down payments and obtain loans such as payment option, adjustable rate mortgages, and interest-only mortgages with reduced initial mortgage payments. Or perhaps buying a home continued to make financial sense, given homeowners' expectations of further price gains. During a June meeting, the Federal Open Market Committee, or FMOC, composed of Federal Reserve governors, 4 regional Federal Reserve Bank presidents, and the Federal Reserve Bank of New York president, heard 5 presentations on mortgage risks and the housing market. Members and staff had difficulty developing a consensus on whether housing prices were overvalued. And, quote, it was hard for many FOMC participants to ascribe substantial conviction to the proposition that overvaluation in the housing market posed the major systemic risks that we now know it did, unquote, according to a letter from Fed Chairman Ben Bernanke to the FCIC. Quote, the national mortgage system might bend, but will likely not break, and neither borrowers nor lenders appeared particularly shaky, unquote, one presentation argued, according to the letter. In discussions about non-traditional mortgage products, the argument was made that, quote, interest-only mortgages are not an especially sinister development, and their risks could be cushioned by large down payments, unquote. The presentation also noted that while loan-to-value ratios were rising on a portion of interest-only loans, the ratios for most remained around 80%. Another presentation suggested that housing market activity could be the result of solid fundamentals. Yet another presentation concluded that the impact of changes in household wealth on spending would be, quote, perhaps only half as large as that of the 1990s stock bubble, unquote. Most FOMC participants agreed the probability of spillovers to financial institutions seemed moderate. As one recent study argues, many economists were agnostics on housing, unwilling to risk their reputations or spook markets by alleging a bubble without finding support in economic theory. Fed Vice Chairman Donald Cohn was one. Quote, identification of a bubble is a tricky proposition because not all the fundamental factors driving asset prices are directly observable, unquote, Cohn said in a 2006 speech, citing research by the European Central Bank. Quote, for this reason, any judgment by a central bank that stocks or homes are overpriced is inherently highly uncertain, unquote. But not all economists hesitated to sound a louder alarm. Quote, the situation is beginning to look like a credit-induced boom in housing that could very well result in a systemic bust if credit conditions or economic conditions deteriorate, unquote, Federal Deposit Insurance Corporation chief economist Richard Brown wrote in a March 2005 report. Quote, during the past 5 years, the average U.S. home has risen in value by 50%, while homes in the fastest-growing markets have approximately doubled in value, unquote. While this increase might have been explained by strong market fundamentals, quote, the dramatic broadening of the housing boom in 2004 strongly suggests the influence of systemic factors, including the low cost and wide availability of mortgage credit, unquote. A couple of months later, Fed economists, in an internal memo, acknowledged the possibility that housing prices were overvalued, but downplayed the potential impacts of a downturn. Even in the face of a large price decline, they argued, defaults would not be widespread, given the large equity that many borrowers still had in their homes. Structural changes in the mortgage market made a crisis less likely, and the financial system seemed well capitalized. Quote, even historically large declines in house prices would be small relative to the recent decline in household wealth owing to the stock market, unquote, the economists concluded. Quote, from a wealth effects perspective, this seems unlikely to create substantial macroeconomic problems, unquote. End of section 44. Section 45 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9, Mortgage Fraud, Crime-facilitative Environments. New Century, where 40% of the mortgages were loans with little or no documentation, was not the only company that ignored concerns about poor loan quality. Across the mortgage industry, with the bubble at its peak, standards had declined, documentation was no longer verified, and warnings from internal audit departments and concerned employees were ignored. These conditions created an environment ripe for fraud. William Black, a former banking regulator who analyzed criminal patterns during the savings and loan crisis, told the Commission that, by one estimate, in the mid-2000s, at least 1.5 million loans annually contained some sort of fraud, in part because of the large percentage of no-doc loans originated then. Fraud for housing can entail a borrower's lying or intentionally omitting information on a loan application. Fraud for profit typically involves a deception to gain financially from the sale of a house. Illinois Attorney General Lisa Madigan defines fraud more broadly to include lenders' sale of unaffordable or structurally unfair mortgage products to borrowers. In 80% of cases, according to the FBI, fraud involves industry insiders. For example, property flipping can involve buyers, real estate agents, appraisers, and complicit closing agents. In a silent second, the buyer, with the collusion of a loan officer and without the knowledge of the first mortgage lender, disguises the existence of a second mortgage to hide the fact that no down payment has been made. Straw buyers allow their names and credit scores to be used for a fee by buyers who want to conceal their ownership. In one instance, 2 women in South Florida were indicted in 2010 for placing ads between 2004 and 2007 in Haitian community newspapers offering assistance with immigration problems. They were accused of then stealing the identities of hundreds of people who came for help and using the information to buy properties, take title in their names, and resell at a profit. U.S. Attorney Wilfredo A. Ferrer told the Commission it was one of the cruelest schemes he had seen. Estimates vary on the extent of fraud, as it is seldom investigated unless properties go into foreclosure. Ann Fulmer, Vice President of Business Relations at Interthinks, a fraud detection service, told the FCIC that her firm analyzed a large sample of all loans from 2005 to 2007 and found 13% contained lies or omissions significant enough to rescind the loan or demand a buyback if it had been securitized. The firm's analysis indicated that about $1 trillion of the loans made during the period were fraudulent. Fulmer further estimated $160 billion worth of fraudulent loans from 2005 to 2007 resulted in foreclosures, leading to losses of $112 billion for the holders. According to Fulmer, experts in the field, lenders' quality assurance officers, attorneys who specialize in loan loss mitigation, and white-collar criminologists say the percentage of transactions involving less significant forms of fraud, such as relatively minor misrepresentations of fact, could reach 60% of originations. Such loans could stay comfortably under the radar because many borrowers made payments on time. Ed Parker, the head of mortgage fraud investigation at AmeriQuest, the largest subprime lender in 2003, 2004, and 2005, told the FCIC that fraudulent loans were very common at the company. Quote, "No one was watching. The volume was up, and now you see the fallout behind the loan origination process," unquote, he told the FCIC. David Gussman, the former vice president of enterprise management capital markets at Fannie Mae, told the commission that in one package of 50 securitized loans, his analysts found one purchaser who had bought 19 properties, falsely identifying himself each time as the owner of only one property, while another had bought 5 properties. Fannie Mae's detection of fraud increased steadily during the housing bubble and accelerated in late 2006, according to William Brewster, the current director of the company's mortgage fraud program. He said that, seeing evidence of fraud, Fannie demanded that lenders such as Bank of America, Countrywide, Citigroup, and J.P. Morgan Chase repurchase about $550 million in mortgages in 2008 and $650 million in 2009. Quote, "Lax or practically non-existent government oversight created what criminologists have labeled crime-facilitative environments, where crime could thrive," unquote, said Henry N. Pontel, a professor of criminology at the University of California, Irvine, in testimony to the commission. The responsibility to investigate and prosecute mortgage fraud violations falls to local, state, and federal law enforcement officials. On the federal level, the Federal Bureau of Investigation investigates and refers cases for prosecution to U.S. attorneys who are part of the Department of Justice. Cases may also involve other agencies, including the U.S. Postal Inspection Service, the Department of Housing and Urban Development, and the Internal Revenue Service. The FBI, which has the broadest jurisdiction of any federal law enforcement agency, was aware of the extent of the fraudulent mortgage problem. FBI Assistant Director Chris Swecker began noticing a rise in mortgage fraud while he was the special agent in charge of the Charlotte, North Carolina office from 1999 to 2004. In 2002, that office investigated First Beneficial Mortgage for selling fraudulent loans to Fannie Mae, leading to the successful criminal prosecution of the company's owner, James Edward McLean Jr., and others. First Beneficial repurchased the mortgages after Fannie discovered evidence of fraud, but then, without any interference from Fannie, resold them to Ginnie Mae. For not alerting Ginnie, Fannie paid $7.5 million of restitution to the government. McLean came to the attention of the FBI after buying a luxury yacht for $800,000 in cash. Soon after Swecker was promoted to Assistant FBI Director for Investigations in 2004, he turned a spotlight on mortgage fraud. Quote, "The potential impact of mortgage fraud is clear," unquote, Swecker told a congressional committee in 2004. Quote, "If fraudulent practices become systemic within the mortgage industry, and mortgage fraud is allowed to become unrestrained, it will ultimately place financial institutions at risk and have adverse effects on the stock market," unquote. In that testimony, Swecker pointed out the inadequacies of data regarding fraud and recommended that Congress mandate a reporting system and other remedies and require all lenders to participate, whether federally regulated or not. For example, suspicious activity reports, also known as SARs, are reports filed by FDIC-insured banks and their affiliates to the Financial Crimes Enforcement Network, or FinCEN, a bureau within the Treasury Department that administers money laundering laws and works closely with law enforcement to combat financial crimes. SARs are filed by financial institutions when they suspect criminal activity in a financial transaction. But many mortgage originators, such as Ameriquest, New Century, and Option One, were outside FinCEN's jurisdiction, and thus the loans they generated, which were then placed into securitized pools by larger lenders or investment banks, were not subject to FinCEN review. William Black testified to the Commission that an estimated 80% of non-prime mortgage loans were made by non-insured lenders not required to file SARs. And as for those institutions required to do so, he believed he saw evidence of underreporting, in that, he said, only about 10% of federally insured mortgage lenders filed even a single criminal referral for alleged mortgage fraud in the first half of 2009. Countrywide, the nation's largest mortgage lender at the time, had about 5,000 internal referrals of potentially fraudulent activity in its mortgage business in 2005, 10,000 in 2006, and 20,000 in 2007, according to Francisco San Pedro, the former senior vice president of special investigations at the company. But it filed only 855 SARs in 2005, 2,895 in 2006, and 2,621 in 2007. Similarly, in examining Bank of America in 2007, its lead bank regulator, the Office of the Comptroller of the Currency, or OCC, sampled 50 mortgages and found 16 with quality assurance referrals for suspicious activity for which no report had been filed with FinCEN. All 16 met the legal requirement for a filing. The OCC consequently required management to refine its processes to ensure that SARs were consistently filed. Darcy Palmer, a former quality assurance and fraud analyst at Wells Fargo, the second largest mortgage lender from 2004 through 2007 and the largest in 2008, told the Commission that, quote, hundreds and hundreds and hundreds of fraud cases, unquote, that she knew were identified within Wells Fargo's home equity loan division were not reported to FinCEN. And, she added, at least half the loans she flagged for fraud were nevertheless funded over her objections. Despite the underreporting, the jump in mortgage fraud drew attention. FinCEN in November 2006 reported a 20-fold increase in SARs related to mortgage fraud between 1996 and 2005. It noted that 2/3 of the loans being created were originated by mortgage brokers who were not subject to any federal standard or oversight. Swecker unsuccessfully asked legislators to compel all lenders to forward information about criminal fraud to regulators and law enforcement agencies. Swecker attempted to gain more funding to combat mortgage fraud, but was resisted. Swecker told the FCIC his funding requests were cut at either the director level at the FBI, at the Justice Department, or at the Office of Management and Budget. He called his struggle for more resources an uphill slog. In 2005, 25,988 SARs related to mortgage fraud were filed. In 2006, there were 37,457. The number kept climbing to 52,862 in 2007, 65,004 in 2008, and 67,507 in 2009. At the same time, top FBI officials, focusing on terrorist threats, reduced the agents assigned to white-collar crime from 2,342 in the 2004 fiscal year to fewer than 2,000 by 2007. That year, its mortgage fraud program had only 120 agents at any one time to review more than 50,000 SARs filed with FinCEN. In response to inquiries from the FDIC, the FBI said that to compensate for a lack of manpower, it had developed new and innovative methods to detect and combat mortgage fraud, such as a computer application created in 2006 to detect property flipping. Robert Mueller, the FBI's director since 2001, said mortgage fraud needed to be considered in context of other priorities, such as terrorism. He told the commission that he hired additional resources to fight fraud, but that we didn't get what we'd requested during the budget process. He also said that the FBI allocated additional resources to reflect the growth in mortgage fraud, but acknowledged that those resources may have been insufficient. Quote, "I'm not going to tell you that that is adequate for what is out there," unquote, he said. In the wake of the crisis, the FBI is continuing to investigate fraud, and Mueller suggested that some prosecutions may be still to come. Alberto Gonzales, the nation's Attorney General from February 2005 to September 2007, told the commission that while he might have done more on mortgage fraud, in hindsight, he believed that other issues were more pressing. Quote, "I don't think anyone can credibly argue that mortgage fraud is more important than the war on terror. Mortgage fraud doesn't involve taking loss of life, so it doesn't rank above the priority of protecting neighborhoods from dangerous gangs or predators attacking our children," unquote. In 2008, the Office of Federal Housing Enterprise Oversight, the regulator of the GSEs, released a report showing a, quote, "significant rise in the incidence of fraud in mortgage lending in 2006 and the first half of 2007, unquote. OFHEO stated it had been working closely with law enforcement and was an active member of the Department of Justice Mortgage Fraud Working Group. Quote, "The concern about mortgage fraud and fraud in general was an issue," unquote. Richard Spellenkothen, head of banking supervision and regulation at the Fed from 1991 to 2006, told the FCIC, quote, "And we understand there was an increasing incidence of mortgage fraud," unquote. Michael B. Mukasey, who served as U.S. Attorney General from November 2007 to the end of 2008, told the commission that he recalled, quote, "receiving reports of mortgage failures and of there being fraudulent activity in connection with flipping houses, overvaluation, and the like. I have a dim recollection of outside people commenting that additional resources should be devoted, and there being speculation about whether resources that were being diverted to national security investigations, and in particular the terrorism investigations, were somehow impeding fraud investigations, which I thought was a bogus issue," unquote. He said that the department had other pressing priorities, such as terrorism, gang violence, and southwestern border issues. In letters to the FCIC, the Department of Justice outlined actions it undertook, along with the FBI, to combat mortgage fraud. For example, in 2004, the FBI launched Operation Continued Action, targeting a variety of financial crimes, including mortgage fraud. In that same year, the agency started to publish an annual mortgage fraud report. The following year, the FBI and other federal agencies announced a joint effort combating mortgage fraud. From July to October 2005, this program, Operation Quick Flip, produced 156 indictments, 81 arrests, and 89 convictions for mortgage fraud. In 2007, the FBI started specifically tracking mortgage fraud cases and increased personnel dedicated to those efforts. And in 2008, Operation Malicious Mortgage resulted in 144 mortgage fraud cases, in which 406 defendants were charged by U.S. attorneys' offices throughout the country. William Black told the commission that Washington essentially ignored the issue and allowed it to worsen. The FBI did have severe limits because of the need to respond to the 9/11 attacks, Black said, and the problem was compounded by the lack of cooperation. Quote, "The terrible thing that happened was that the FBI got virtually no assistance from the regulators, the banking regulators and the thrift regulators," unquote. Swecker, the former FBI official, told the commission he had no contact with banking regulators during his tenure. As mortgage fraud grew, state agencies took action. In Florida, Ellen Wilcox, a special agent with the State Department of Law Enforcement, teamed with the Tampa Police Department and Hillsborough County Consumer Protection Agency to bring down a criminal ring scamming homeowners in the Tampa area. Its key member was Orson Benn, a New York-based vice president of Argent Mortgage Company, a unit of AmeriQuest. Beginning in 2004, 10 investigators and 2 prosecutors worked for years to unravel a network of alliances between real estate brokers, appraisers, home repair contractors, title companies, notaries, and a convicted felon in a case that involved some 130 loans. According to charging documents in the case, the perpetrators would walk through neighborhoods, looking for elderly homeowners they thought were likely to have substantial equity in their homes. They would suggest repairs or improvement to the homes. The homeowners would fill out paperwork, and insiders would use the information to apply for loans in their names. Members of the ring would prepare fraudulent loan documents, including false W-2 forms filled with information about invented employments and falsified salaries, and take out home equity loans in the homeowners' names. Each person involved in the transaction would receive a fee for his or her role. Ben, at Argent, received a $3,000 kickback for each loan he helped secure. When the loan was funded, the checks were frequently made out to the bogus home construction company that had proposed the work, which would then disappear with the proceeds. Some of the homeowners never received a penny from the refinancing on their homes. Hillsborough County officials learned of the scam when homeowners approached them to say that scheduled repairs had never been made to their homes, and then sometimes learned that they had lost years' worth of equity as well. 16 of 18 defendants, including Ben, have been convicted or pled guilty. Wilcox told the commission that the, quote, "cost and length of these investigations makes them less attractive to most investigative agencies and prosecutors trying to justify their budgets based on investigative statistics," unquote. She said it has been hard to follow up on other cases because so many of the subprime lenders have gone out of business, making it difficult to track down perpetrators and witnesses. AmeriQuest, for example, collapsed in 2007, although Argent and the company's loan servicing arm were bought by Citigroup that same year. End of section 45. Section 46 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9. Disclosure and Due Diligence, a Quality Control Issue in the Factory. In addition to the rising fraud and egregious lending practices, lending standards deteriorated in the final years of the bubble. After growing for years, Alt-A lending increased another 5% from 2005 to 2006. In particular, option ARMs grew 7% during that period. Interest-only mortgages grew 9%, and no documentation or low documentation loans, measured for borrowers with fixed-rate mortgages, grew 14%. Overall, by 2006, no-doc or low-doc loans made up 27% of all mortgages originated. Many of these products would perform only if prices continued to rise and the borrower could refinance at a low rate. In theory, every participant along the securitization pipeline should have had an interest in the quality of every underlying mortgage. In practice, their interests were often not aligned. Two New York Fed economists have pointed out the 7 deadly frictions in mortgage securitization, places along the pipeline where one party knew more than the other, creating opportunities to take advantage. For example, the lender who originated the mortgage for sale, earning a commission, knew a great deal about the loan and the borrower, but had no long-term stake in whether the mortgage was paid, beyond the lender's own business reputation. The securitizer who packaged mortgages into mortgage-backed securities similarly was less likely to retain a stake in those securities. In theory, the rating agencies were important watchdogs over the securitization process. They described their role as being an umpire in the market. But they did not review the quality of individual mortgages in a mortgage-backed security, nor did they check to see that the mortgages were what the securitizers said they were. So the integrity of the market depended on 2 critical checks. First, firms purchasing and securitizing the mortgages would conduct due diligence reviews of the mortgage pools, either using third-party firms or doing the reviews in-house. Second, following Securities and Exchange Commission rules, parties in the securitization process were expected to disclose what they were selling to investors. Neither of these checks performed as they should have. Due diligence firms waved in. As subprime mortgage securitization took off, securitizers undertook due diligence on their own or through third parties on the mortgage pools that originators were selling them. The originator and the securitizer negotiated the extent of the due diligence investigation. While the percentage of the pool examined could be as high as 30%, it was often much lower. According to some observers, as the market grew and originators became more concentrated, they had more bargaining power over the mortgage purchasers, and samples were sometimes as low as 2% to 3%. Some securitizers requested that the due diligence firm analyze a random sample of mortgages from the pool. Others asked for a sampling of those most likely to be deficient in some way, in an effort to efficiently detect more of the problem loans. Clayton Holdings, a Connecticut-based firm, was a major provider of third-party due diligence services. As Clayton Vice President Vicki Beal explained to the FCIC, firms like hers were, quote, not retained by their clients to provide an opinion as to whether a loan is a good loan or a bad loan, unquote. Rather, they were hired to identify, among other things, whether the loans met the originator's stated underwriting guidelines, and in some measure, to enable clients to negotiate better prices on pools of loans. The review fell into 3 general areas: credit, compliance, and valuation. Did the loans meet the underwriting guidelines? Generally, the originator's standards, sometimes with overlays or additional guidelines provided by the financial institutions purchasing the loans. Did the loans comply with federal and state laws, notably predatory lending laws and truth in lending requirements? Were the reported property values accurate? And critically, to the degree that a loan was deficient, did it have any compensating factors that offset these deficiencies? For example, if a loan had a higher loan-to-value ratio than guidelines called for, did another characteristic, such as the borrower's higher income, mitigate that weakness? The due diligence firm would then grade the loan sample and forward the data to its client. Report in hand, the securitizer would negotiate a price for the pool and could kick out loans that did not meet the stated guidelines. Because of the volume of loans examined by Clayton during the housing boom, the firm had a unique inside view of the underwriting standards that originators were actually applying, and that securitizers were willing to accept. Loans were classified into 3 groups: loans that met guidelines, a Grade 1 event; those that failed to meet guidelines but were approved because of compensating factors, a Grade 2 event; and those that failed to meet guidelines and were not approved, a Grade 3 event. Overall, for the 18 months that ended June 30, 2007, Clayton rated 54% of the 911,039 loans it analyzed as Grade 1 and another 18% as Grade 2, for a total of 72% that met the guidelines outright or with compensating factors. The remaining 28% of the loans were Grade 3. In theory, the banks could have refused to buy a loan pool, or indeed, they could have used the findings of the due diligence firm to probe the loan's quality more deeply. Over the 18-month period, 39% of the loans that Clayton found to be deficient, Grade 3, were waived in by the banks. Thus, 11% of the loans sampled by Clayton were accepted even though the company had found a basis for rejecting them. See Figure 9.1. Figure 9.1 is captioned Rejected Loans Waived In by Selected Banks, with the subcaption, From January 2006 through June 2007, Clayton rejected 28% of the mortgages it reviewed. Of these, 39% were waived in anyway. The table has 5 columns, from left to right. Column A, accepted loans, Event 1 and 2 divided by total pool of loans. Column B is rejected loans, Event 3 divided by total pool of loans. Column C, rejected loans waived in by financial institutions. Column D, rejected loans after waivers, column B minus column C, and column E labeled financial institution waiver rate, column C divided by column B. Along the left-hand margin is a list of financial institutions: Citigroup, Credit Suisse, Deutsche, Goldman, J.P. Morgan, Lehman, Merrill, UBS, and WAMU. The figures in column A, that is, the percentage of accepted loans, ranges from a low of 58%, that's Citigroup, to a high of 80% for UBS, and for the total bank sample, 72%. Column B, the percentage of rejected loans, ranges from a low of 20% for UBS to a high of 42% for Citigroup, and over the total bank sample, 28%. Column C, the percentage of rejected loans waived in, ranges from a low of 6% for UBS to a high of 14% for J.P. Morgan, and over the entire sample, 11%. Column D, percentage of rejected loans after waivers, ranges from a low of 13% for both J.P. Morgan and UBS to a high of 29% for Citigroup and an average of 17% across the sample. And finally, the waiver rate, column E, ranges from a low of 29% for Goldman and WAMU to a high of 51% for J.P. Morgan, and across the entire sample, 39%. Note, from Clayton Trending Reports, numbers may not add due to rounding. Source, Clayton Holdings. The entire chart can be viewed on page 167 of the printed volume. Returning to the text. Referring to the data, Keith Johnson, the president of Clayton from May 2006 to May 2009, told the commission, quote, "That 54% to me says there was a quality control issue in the factory for mortgage-backed securities," unquote. Johnson concluded that his clients often waived in loans to preserve their business relationship with the loan originator. A high number of rejections might lead the originator to sell the loans to a competitor. Simply put, it was a seller's market. Quote, "Probably the seller had more power than the Wall Street issuer," unquote, Johnson told the FCIC. The high rate of waivers following rejections may not itself be evidence of something wrong in the process, Beal testified. She said that as originators' lending guidelines were declining, she saw the securitizing firms introduce additional credit guidelines. Quote, "As you know, there was stated income. They were telling us, look for reasonableness of that income, things like that," unquote. With stricter guidelines, one would expect more rejections, and after the securitizer looks more closely at the rejected loans, possibly more waivers. As Moody's Investors Service explained in a letter to the FCIC, quote, a high rate of waivers from an institution with extremely tight underwriting standards could result in a pool that is less risky than a pool with no waivers from an institution with extremely loose underwriting standards, unquote. Nonetheless, many prospectuses indicated that the loans in the pools either met guidelines outright or had compensating factors, even though Clayton's records show that only a portion of the loans were sampled, and that of those that were sampled, a substantial percentage of Grade 3 event loans were waived in. Johnson said he approached the rating agencies in 2006 and 2007 to gauge their interest in the exception tracking product that Clayton was developing. He said he shared some of their company's results, attempting to convince the agencies that the data would benefit the ratings process. Quote, we went to the rating agencies and said, wouldn't this information be great for you to have as you assign tranche levels of risk, unquote, Johnson recalled. The agencies thought the due diligence firm's data were great, but they did not want the information, Johnson said, because it would presumably produce lower ratings for the securitizations and cost the agency business, even in 2007 as the private securitization market was winding down. When securitizers did kick loans out of the pools, some originators simply put them into new pools, presumably in hopes that those loans would not be captured in the next pool's sampling. The examiner's report for New Century Financial's bankruptcy described such a practice. Similarly, Fremont Investment and Loan had a policy of putting loans into subsequent pools until they were kicked out 3 times. The company's former regulatory compliance and risk manager, Roger Earnman, told the FCIC. As Johnson described the practice to the FCIC, this was the 3 strikes, you're out rule. Some mortgage securitizers did their own due diligence, but seemed to devote only limited resources to it. At Morgan Stanley, the head of due diligence was based not in New York, but rather in Boca Raton, Florida. He had at any one time 2 to 5 individuals reporting to him directly, and they were actually employees of a personnel consultant, Equinox. Deutsche Bank and J.P. Morgan likewise had only small due diligence teams. Banks did not necessarily have better processes for monitoring the mortgages that they purchased. At an FCIC hearing on the mortgage business, Richard Bowen, a whistleblower who had been a senior vice president at Citi Financial Mortgage, in charge of a staff of 200-plus professional underwriters, testified that his team conducted quality assurance checks on the loans bought by Citigroup from a network of lenders, including both subprime mortgages that Citigroup intended to hold and prime mortgages that it intended to sell to Fannie Mae and Freddie Mac. For subprime purchases, Bowen's team would review the physical credit file of the loans they were purchasing. Quote, during 2006 and 2007, I witnessed many changes to the way the credit risk was being evaluated for these pools during the purchase processes, unquote, Bowen said. For example, he said, the chief risk officer in Citigroup's consumer lending business reversed large numbers of underwriting decisions from turned down to approved. Another part of Bowen's charge was to supervise the purchase of roughly $50 billion annually in prime loan pools, a high percentage of which were sold to Fannie Mae and Freddie Mac for securitization. The sampling provided to Bowen's staff for quality control was supposed to include at least 5% of the loan pool for a given securitization, but, quote, this corporate mandate was usually ignored, unquote. Samples of 2% were more likely, and the loan samples that Bowen's group did examine showed extremely high rates of non-compliance. Quote, at the time that I became involved, which was early to mid-2006, we identified that 40 to 60% of the files either had a disagree decision or they were missing critical documents, unquote. Bowen repeatedly expressed concerns to his direct supervisor and company executives about the quality and underwriting of mortgages that Citi Mortgage purchased and then sold to the GSEs. As discussed in a later chapter, the GSEs would later require Citigroup to buy back $1.5 billion in loans as of November 2010, finding that the loans Citigroup had sold them did not conform to GSE standards. SEC, the elephant in the room is that we didn't review the prospectus supplements. By the time the financial crisis hit, investors held more than $2 trillion of non-GSE mortgage-backed securities and close to $700 billion of CDOs that held mortgage-backed securities. These securities were issued with practically no SEC oversight, and only a minority were subject to the SEC's ongoing public reporting requirements. The SEC's mandate is to protect investors, generally not by reviewing the quality of securities, but simply by ensuring adequate disclosures so that investors can make up their own minds. In the case of initial public offerings of a company's shares, the work has historically involved a lengthy review of the issuer's prospectus and other offering materials prior to sale. However, with the advent of shelf registration, a method of registering securities on an ongoing basis, the process became much quicker for mortgage-backed securities ranked in the highest grades by the rating agencies. The process allowed issuers to file a base prospectus with the SEC, giving investors notice that the issuer intended to offer securities in the future. The issuer then filed a supplemental prospectus describing each offering's terms. Quote, "The elephant in the room is that we didn't review the prospectus supplements," unquote. The SEC's Deputy Director for Disclosure in Corporate Finance, Shelley Parrott, told the FCIC. To improve disclosures pertaining to mortgage-backed securities and other asset-backed securities, the SEC issued Regulation AB in late 2004. The regulation required that every prospectus include, quote, "a description of the solicitation, credit granting or underwriting criteria used to originate or purchase the pool assets, including, to the extent known, any changes in such criteria, and the extent to which such policies and criteria are or could be overridden," unquote. With essentially no review or oversight, how good were disclosures about mortgage-backed securities? Prospectuses usually included disclaimers to the effect that not all mortgages would comply with the lending policies of the originator. Quote, "On a case-by-case basis, the originator may determine that, based upon compensating factors, a prospective mortgage not strictly qualifying under the underwriting risk category or other guidelines described below warrants an underwriting exception," unquote. The disclosure typically had a sentence stating that a substantial number, or perhaps a substantial portion, of the mortgage loans will represent these exceptions. Citigroup's Bowen criticized the extent of information provided on loan pools. Quote, "There was no disclosure made to the investors with regard to the quality of the files they were purchasing," unquote. Such disclosures were insufficient for investors to know what criteria the mortgages they were buying actually did meet. Only a small portion, as little as 2% to 3% of the loans in any deal were sampled, and evidence from Clayton shows that a significant number did not meet stated guidelines or have compensating factors. On the loans in the remainder of the mortgage pool that were not sampled, as much as 97%, Clayton and the securitizers had no information, but one could reasonably expect them to have many of the same deficiencies, and at the same rate as the sampled loans. Prospectuses for the ultimate investors in the mortgage-backed securities did not contain this information, or information on how few loans were reviewed, raising the question of whether the disclosures were materially misleading in violation of the securities laws. CDOs were issued under a different regulatory framework from the one that applied to many mortgage-backed securities, and were not subject even to the minimal shelf registration rules. Underwriters typically issued CDOs under the SEC's Rule 144A, which allows the unregistered resale of certain securities to so-called qualified institutional buyers, or QIBs. These included investors as diverse as insurance companies like MetLife, pension funds like the California State Teachers Retirement System, and investment banks like Goldman Sachs. The SEC created Rule 144A in 1990, making securities markets more attractive to borrowers and U.S. investment banks more competitive with their foreign counterparts. At the time, market participants viewed U.S. disclosure requirements as more onerous than those in other countries. The new rule significantly expanded the market for these securities by declaring that distributions which complied with the rule would no longer be considered public offerings, and therefore would not be subject to the SEC's registration requirements. In 1996, Congress reinforced this exemption with the National Securities Markets Improvement Act, legislation that Denise Voigt Crawford, a commissioner on the Texas Securities Board, characterized to the commission, quote, as prohibiting the states from taking preventative actions in areas that we now know have been substantial contributing factors to the current crisis, unquote. Under this legislation, state securities regulators were preempted from overseeing private placements, such as CDOs. In the absence of registration requirements, a new debt market developed quickly under Rule 144A. This market was liquid, since qualified investors could freely trade Rule 144A debt securities. But debt securities, when Rule 144A was enacted, were mostly corporate bonds, very different from the CDOs that dominated the private placement market more than a decade later. After the crisis unfolded, investors, arguing that disclosure hadn't been adequate, filed numerous lawsuits under federal and state securities laws. As we will see, some have already resulted in substantial settlements. End of section 46. Section 47 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9. Regulators. Markets will always self-correct. Where were the regulators? Declining underwriting standards and new mortgage products had been on regulators' radar screens in the years before the crisis, but disagreements among the agencies and their traditional preference for minimal interference delayed action. Supervisors had, since the 1990s, followed a risk-focused approach that relied extensively on banks' own internal risk management systems. Quote, as internal systems improve, the basic thrust of the examination process should shift from largely duplicating many activities already conducted within the bank to providing constructive feedback that the bank can use to enhance further the quality of its risk management systems, unquote, Chairman Greenspan had said in 1999. Across agencies, there was a, quote, historic vision, historic approach, that a lighter hand at regulation was the appropriate way to regulate, unquote. Eugene Ludwig, comptroller of the currency from 1993 to 1998, told the FCIC, referring to the Gramm-Leach-Bliley Act in 1999. The New York Fed, in a lesson learned analysis after the crisis, pointed to the mistaken belief that, quote, markets will always self-correct, unquote. A deference to the self-correcting property of markets inhibited supervisors from imposing prescriptive views on banks, the report concluded. The reliance on banks' own risk management would extend to capital standards. Banks had complained for years that the original 1988 Basel standards did not allow them sufficient latitude to base their capital on the riskiness of particular assets. After years of negotiations, international regulators, with strong support from the Fed, introduced the Basel II capital regime in June 2004, which would allow banks to lower their capital charges if they could show they had sophisticated internal models for estimating the riskiness of their assets. While no U.S. bank fully implemented the more sophisticated approaches that it allowed, Basel II reflected and reinforced the supervisor's risk-focused approach. Spillenkoven said that one of the regulator's biggest mistakes was their acceptance of Basel II premises, which he described as displaying, quote, an excessive faith in internal bank risk models, an infatuation with the specious accuracy of complex quantitative risk measurement techniques, and a willingness, at least in the early days of Basel II, to tolerate a reduction in regulatory capital in return for the prospect of better risk management and greater risk sensitivity, unquote. Regulators had been taking notice of the mortgage market for several years before the crisis. As early as 2004, they recognized that mortgage products and borrowers had changed during and following the refinancing boom of the previous year, and they began working on providing guidance to banks and thrifts. But too little was done, and too late, because of interagency discord, industry pushback, and a widely held view that market participants had the situation well in hand. Quote, within the board, people understood that many of these loan types had gotten to an extreme, unquote. Susan Bies, then a Fed governor and chair of the Federal Reserve Board's subcommittees on both safety and soundness supervision and consumer protection supervision, told the FCIC. So the main debate within the board was how tightly should we rein in the abuses that we were seeing. So it was more of to a degree, unquote. Indeed, in the same June 2005 Federal Open Market Committee meeting described earlier, one FOMC member noted that, quote, some of the newer, more intricate and untested credit default instruments had caused some market turmoil, unquote. Another participant was concerned that subprime lending was an accident waiting to happen. A third participant noted the risks in mortgage securities, the rapid growth of subprime lending, and the fact that many lenders had, quote, inadequate information on borrowers, unquote, adding, however, that record profits and high capital levels allayed those concerns. A fourth participant said that, quote, we could be seeing the final gasps of house price appreciation, unquote. The participant expressed concern about creative financing and was worried that piggybacks and other non-traditional loans, whose risk of default could be higher than suggested by the securities they backed, could be making the books of GSEs look better than they really were. Fed staff replied that the GSEs were not large purchasers of private label securities. In the spring of 2006, the FOMC would again discuss risks in the housing and mortgage markets and express nervousness about the growing ingenuity of the mortgage sector. One participant noted that negative amortization loans had the pernicious effect of stripping equity and wealth from homeowners, and raised concerns about non-traditional lending practices that seemed based on the presumption of continued increases in home prices. John Snow, then Treasury Secretary, told the FCIC that he called a meeting in late 2004 or early 2005 to urge regulators to address the proliferation of poor lending practices. He said he was struck that regulators tended not to see a problem at their own institutions. Quote, nobody had a full 360-degree view. The basic reaction from financial regulators was, well, there may be a problem, but it's not in my field of view, unquote, Snow told the FCIC. Regulators responded to Snow's questions by saying, quote, our default rates are very low. Our institutions are very well capitalized. Our institutions have very low delinquencies. So we don't see any real big problem, unquote. In May 2005, the banking agencies did issue guidance on the risks of home equity lines of credit and home equity loans. It cautioned financial institutions about credit risk management practices, pointing to interest-only features, low or no documentation loans, high loan-to-value and debt-to-income ratios, lower credit scores, greater use of automated valuation models, and the increase in transactions generated through a loan broker or other third party. While this guidance identified many of the problematic lending practices engaged in by bank lenders, it was limited to home equity loans. It did not apply to first mortgages. In 2005, examiners from the Fed and other agencies conducted a confidential peer group study of mortgage practices at 6 companies that together had originated $1.3 trillion in mortgages in 2005, almost half the national total. In the group were 5 banks whose holding companies were under the Fed's supervisory purview: Bank of America, Citigroup, Countrywide, National City, and Wells Fargo, as well as the largest thrift, Washington Mutual. The study, quote, showed a very rapid increase in the volume of these irresponsible loans, very risky loans, unquote. Cbteddy, then head of credit risk at the Federal Reserve Board's Division of Banking Supervision and Regulation, told the FCIC. A large percentage of their loans issued were subprime and Alt-A mortgages, and the underwriting standards for these products had deteriorated. Once the Fed and other supervisors had identified the mortgage problems, they agreed to express those concerns to the industry in the form of non-binding guidance. Quote, there was among the Board of Governors folks, some who felt that if we just put out guidance, the banks would get the message, unquote, Bees said. The federal agencies therefore drafted guidance on non-traditional mortgages, such as option ARMs, issuing it for public comment in late 2005. The draft guidance directed lenders to consider a borrower's ability to make the loan payment when rates adjusted, rather than just the lower starting rate. It warned lenders that low documentation loans should be used with caution. Immediately, the industry was up in arms. The American Bankers Association said the guidance overstated the risk of non-traditional mortgages. Other market participants complained that the guidance required them to assume a worst-case scenario. That is, the scenario in which borrowers would have to make the full payment when rates adjusted. They disputed the warning on low documentation loans, maintaining that, quote, almost any form of documentation can be appropriate, unquote. They denied that better disclosures were required to protect borrowers from the risks of non-traditional mortgages, arguing that they were, quote, not aware of any empirical evidence that supports the need for further consumer protection standards, unquote. The need for guidance was controversial within the agencies, too. Quote, we got tremendous pushback from the industry, as well as Congress, as well as, internally, unquote. The Fed's Sadiq told the FCIC, quote, because it was stifling innovation, potentially, and it was denying the American dream to many people, unquote. The pressures to weaken and delay the guidance were strong and came from many sources. Opposition from the Office of Thrift Supervision helped delay the mortgage guidance for almost a year. B said, quote, there was some real concern about if the Fed tightened down on the banks it regulated, whether that would create an unlevel playing field for standalone mortgage lenders whom the Fed did not regulate, unquote. Another challenge to regulating the mortgage market was Congress. She recalled an occasion when she testified about a proposed rule And, quote, members of Congress said that we were going to deny the dream of home ownership to Americans if we put this new, stronger standard in place, unquote. When guidance was put in place in 2006, regulators policed their guidance through bank examinations and informal measures, such as voluntary agreements with supervised institutions. It also appeared some institutions switched regulators in search of more lenient treatment. In December 2006, Countrywide applied to switch regulators from the Fed and OCC to the OTS. Countrywide's move came after several months of evaluation within the company about the benefits of OTS regulation, many of which were promoted by the OTS itself over the course of an outreach effort initiated in mid-2005 after John Reich became director of the agency. Publicly, Countrywide stated that the decision to switch to the OTS was driven by the desire to have one housing-focused regulator, rather than separate regulators for the bank and the holding company. However, other factors came into play as well. The OCC's top Countrywide examiner told the FCIC that Countrywide CEO Angelo Mozzillo and President and COO David Samble thought the OCC's position on property appraisals would be, quote, killing the business, unquote. An internal July 2006 Countrywide briefing paper noted, quote, the OTS regulation of holding companies is not as intrusive as that of the Federal Reserve. In particular, the OTS rarely conducts extensive on-site examinations, and when they do conduct an on-site examination, they are generally not considered intrusive to the holding company, unquote. The briefing paper also noted, quote, the OTS generally is considered a less sophisticated regulator than the Federal Reserve, unquote. In August 2006, Mozzillo wrote to members of his executive team, quote, it appears that the Fed is now troubled by pay options, while the OTS is not. Since pay options are a major component of both our volumes and profitability, the Fed may force us into a decision faster than we would like, unquote. Countrywide Chief Risk Officer John McMurray responded that, quote, based on my meetings with the FRB and OTS, the OTS appears to be more familiar and more comfortable with option ARMs, unquote. The OTS approved Countrywide's application for a thrift charter on March 5, 2007. End of section 47. Section 48 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9. Leveraged Loans and Commercial Real Estate. You gotta get up and dance. The credit bubble was not confined to the residential mortgage market. The markets for commercial real estate and leveraged loans, typically loans to below investment-grade companies to aid their business or to finance buyouts, also experienced similar bubble and bust dynamics, although the effects were not as large and damaging as in residential real estate. From 2000 to 2007, these other two markets grew tremendously, spurred by structured finance products, commercial mortgage-backed securities, and collateralized loan obligations, or CLOs, respectively, which were in many ways similar to residential mortgage-backed securities and CDOs. And just as in the residential mortgage market, underwriting standards loosened, even as the cost of borrowing decreased, and trading in these securities was bolstered by the development of new credit derivatives products. Historically, leveraged loans had been made by commercial banks, but a market for institutional investors developed and grew in the mid to late 1990s. An agent bank would originate a package of loans to only one company, and then sell or syndicate the loans in the package to other banks and large non-bank investors. The package generally included loans with different maturities. Some were short-term lines of credit, which would be syndicated to banks. The rest were longer-term loans syndicated to non-bank institutional investors. Leveraged loan issuance more than doubled from 2000 to 2007, but the rapid growth was in the longer-term institutional loans rather than in short-term lending. By 2007, the longer-term leveraged loans rose to $387 billion, up from $46 billion in 2000. Starting in 1998, the longer-term leveraged loans were packaged in CLOs, which were rated according to methodologies similar to those the rating agencies used for CDOs. Like CDOs, CLOs had tranches, underwriters, and collateral managers. The market was less than $5 billion annually from 1998 to 2002, but then it started growing dramatically. Annual issuance exceeded $40 billion in 2005 and peaked above $80 billion in 2007. From 2000 through the third quarter of 2007, more than 60% of leveraged loans were packaged into CLOs. As the market for leveraged loans grew, credit became looser and leverage increased as well. The deals became larger, and costs of borrowing declined. Loans that in 2003 had paid interest of 4 percentage points over an interbank lending rate were refinanced in early 2007 into loans paying just 2 percentage points over the same rate. During the peak of the recent leveraged buyout boom, leveraged loans were frequently issued with interest-only, payment-in-kind, and covenant-light terms. Payment-in-kind loans allowed borrowers to defer paying interest by issuing new debt to cover accrued interest. Covenant-light loans exempted borrowers from standard loan covenants that usually require corporate firms to limit their other debts and to maintain minimum levels of cash. Private equity firms, those that specialized in investing directly in companies, found it easier and cheaper to finance their leveraged buyouts. Just as home prices rose, so too did the prices of the target companies. One of the largest deals ever made involving leveraged loans was announced on April 2, 2007, by KKR, a private equity firm. KKR said it intended to purchase First Data Corporation, a processor of electronic data, including credit and debit card payments, for about $29 billion. As part of this transaction, KKR would issue $8 billion in junk bonds and take out another $15 billion in leveraged loans from a consortium of banks including Citigroup, Deutsche Bank, Goldman Sachs, HSBC Securities, Lehman Brothers, and Merrill Lynch. As late as July 2007, Citigroup and others were still increasing their leveraged loan business. Citigroup CEO Charles Prince then said of the business, quote, "When the music stops, in terms of liquidity, things will be complicated, but as long as the music is playing, you've got to get up and dance. We're still dancing," unquote. Prince later explained to the FCIC, quote, "At that point in time, because interest rates had been so low for so long, the private equity firms were driving very hard bargains with the banks. And at that point in time, the banks individually had no credibility to stop participating in this lending business. It was not credible for one institution to unilaterally back away from this leveraged lending business. It was in that context that I suggested that all of us, we were all regulated entities, that the regulators had an interest in tightening up lending standards in the leveraged lending area," unquote. The CLO market would seize up in the summer of 2007 during the financial crisis, just as the much larger mortgage-related CDO market seized. At the time, this would be roughly $300 billion in outstanding commitments for new loans. As demand in the secondary market dried up, these loans ended up on the bank's balance sheets. Commercial real estate, multifamily apartment buildings, office buildings, hotels, retail establishments, and industrial properties went through a bubble similar to that in the housing market. Investment banks created commercial mortgage-backed securities and even CDOs out of commercial real estate loans, just as they did with residential mortgages. And just as houses appreciated from 2000 on, so too did commercial real estate values. Office prices rose by nearly 60% between 2003 and 2008 in the central business districts of the 32 markets for which data are available. The increase was 193% in Phoenix, 153% in Tampa, 147% in Manhattan, and 146% in Los Angeles. Issuance of commercial mortgage-backed securities rose from $47 billion in 2000 to $169 billion in 2005, reaching $230 billion in 2007. When securitization markets contracted, issuance fell to $12 billion in 2008 and $3 billion in 2009. When about 1/4 of commercial real estate mortgages were securitized in 2007, securitizers issued $41 billion of commercial mortgage CDOs, a number that again dropped precipitously in 2008. Leveraged loans and the commercial real estate sector came together on July 3, 2007, when the Blackstone Group announced its plan to buy Hilton, a hotel chain with 2,900 properties, for $26 billion, a 40% premium over the share price. A year later, one author described this deal as the apogee of the early millennial mega buyout frenzy, where cheap and readily available credit, coupled with a relentless one-upmanship, spurred private equity firms to buy out companies at often absurd overvaluations, saddle them with massive debt, and then pay themselves hefty fees for the trouble. $20 billion in financing came from the top 5 investment banks and large commercial banks, such as Bank of America and Deutsche Bank. Bear Stearns was increasingly active in these markets. While Bear topped the 2006 market in residential securitizations, it ranked in the bottom half in commercial securitizations. But it was racing to catch up, and in a 2007 presentation boasted, quote, "In 2006, we firmly established Bear Stearns as a global presence in commercial real estate finance," unquote. The firm's commercial real estate mortgage originations more than doubled between 2004 and 2006. And then the market came crashing to a halt. Although the commercial real estate mortgage market was much smaller than the residential real estate market, in 2008, commercial real estate debt was less than $4 trillion, compared to $12 trillion for residential mortgages. It declined even more steeply. From its peak, commercial real estate fell roughly 45% in value, and prices have remained close to their lows. Losses on commercial real estate would be an issue across Wall Street, particularly for Lehman and Bear, and potentially for the taxpayer. When the Federal Reserve would assume $30 billion of Bear's illiquid assets in 2008, that would include roughly $4 billion in loans from the unsold portion of the Hilton financing package, and the commercial real estate market would continue to decline long after the housing market had begun to stabilize. End of section 48. Section 49 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9, Lehman, From Moving to Storage. Even as the market was nearing its peak, Lehman took on more risk. On October 5, 2007, when commercial real estate already made up 6.3% of its assets, Lehman Brothers acquired a major stake in Archstone Smith, a publicly traded real estate investment trust, for $5.4 billion. Archstone owned more than 88,000 apartments, including units still under construction, in over 340 communities in the United States. It was the bank's largest commercial real estate investment. Lehman initially projected that Archstone would generate more than $1.3 billion in profits over 10 years, projections based on optimistic assumptions, given the state of the market at that point. Both Lehman and Archstone were highly leveraged. Archstone had little cushion if its rent receipts should go down, and Lehman had little cushion if investments such as Archstone should lose value. Although the firm had proclaimed that, quote, risk management is at the very core of Lehman's business model, unquote, the executive committee simply left its risk officer, Madeline Antonick, out of the loop when it made this investment. Since the late 1990s, Lehman had also built a large mortgage origination arm, a formidable securities issuance business, and a powerful underwriting division as well. Then, in its March 2006 Global Strategy offsite, CEO Richard Fuld and other executives explained to their colleagues a new move toward an aggressive growth strategy, including greater risk and more leverage. They described the change as a shift from a moving or securitization business to a storage business in which Lehman would make and hold longer-term investments. By summer 2006, the housing market faced ballooning inventories, sharply reduced sales volumes, and wavering prices. Senior management regularly disregarded the firm's risk policies and limits, and warnings from risk managers, and pursued its countercyclical growth strategy. It had worked well during prior market dislocations, and Lehman's management assumed that it would work again. Lehman's Aurora unit continued to originate Alt-A loans after the housing market had begun to show signs of weakening. Lehman also continued to securitize mortgage assets for sale, but was now holding more of them as investments. Across both the commercial and residential real estate sectors, the mortgage-related assets on Lehman's books increased from $67 billion in 2006 to $111 billion in 2007. This increase would be part of Lehman's undoing a year later. Lehman's regulators did not restrain its rapid growth. The SEC, Lehman's main regulator, knew of the firm's disregard of risk management. The SEC knew that Lehman continued to increase its holding of mortgage securities, and that it had increased and exceeded risk limits, facts noted almost monthly in official SEC reports obtained by the FCIC. Nonetheless, Eric Seary, who led the SEC's supervision program, told the FCIC that it would not have mattered if the agency had fully recognized the risks associated with commercial real estate. To avoid serious losses, Seary maintained, Lehman would have had to start selling real estate assets in 2006. Instead, it kept buying, well into the first quarter of 2008. In addition, according to the bankruptcy examiner, Lehman understated its leverage through Repo 105 transactions, an accounting maneuver to temporarily remove assets from the balance sheet before each reporting period. Martin Kelly, Lehman's global financial controller, stated that the transactions had, quote, no substance, unquote. Their only purpose or motive was reduction in the balance sheet. Other Lehman executives described Repo 105 transactions as an accounting gimmick and, quote, a lazy way of managing the balance sheet as opposed to legitimately meeting balance sheet targets at quarter end, unquote. Bart McDade, who became Lehman's president and chief operating officer in June 2008, in an email called Repo 105 transactions, quote, another drug we are on, unquote. Ernst & Young, Lehman's auditor, was aware of the Repo 105 practice, but did not question Lehman's failure to publicly disclose it, despite being informed in May 2008 by Lehman Senior Vice President Matthew Lee that the practice was improper. The Lehman bankruptcy examiner concluded that E&Y took, quote, virtually no action to investigate the Repo 105 allegations, took no steps to question or challenge the non-disclosure by Lehman, unquote, and that, quote, colorable claims exist that E&Y did not meet professional standards, both in investigating Lee's allegations and in connection with its audit and review of Lehman's financial statements, unquote. New York Attorney General Andrew Cuomo sued E&Y in December 2010, accusing the firm of facilitating a massive accounting fraud by helping Lehman to deceive the public about its financial condition. The Office of Thrift Supervision had also regulated Lehman since 1999 through its jurisdiction over Lehman's thrift subsidiary. Although, quote, the SEC was regarded as the primary regulator, unquote, the OTS examiner told the FCIC, quote, we in no way just assumed that the SEC would do the right thing, so we regulated and supervised the holding company, unquote. Still, not until July 2008, just a few months before Lehman failed, would the OTS issue a report warning that Lehman had made an outsized bet on commercial real estate, larger than that by its peer firms, despite Lehman's smaller size, that Lehman was materially overexposed to the commercial real estate sector, and that Lehman had major failings in its risk management process. End of section 49. Section 50 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9, Fannie Mae and Freddie Mac, Two Stark Choices. In 2005, while Countrywide, Citigroup, Lehman, and many others in the mortgage and CDO business were going into overdrive, executives at the two behemoth GSEs, Fannie and Freddie, worried they were being left behind. One sign of the times, Fannie's biggest source of mortgages, Countrywide, expanded, that is, loosened its underwriting criteria, and Fannie would not buy the new mortgages, Countrywide President and COO Sam Bowl told the FCIC. Typical of the market as a whole, Countrywide sold 72% of its loans to Fannie in 2003, but only 45% in 2004 and 32% in 2005. The risk in the environment has accelerated dramatically. Thomas Lund, Fannie's head of single-family lending, told fellow senior officers at a strategic planning meeting on June 27, 2005. In a bulleted list, he ticked off changes in the market. The, quote, proliferation of higher-risk alternative mortgage products, growing concern about housing bubbles, growing concerns about borrowers taking on increased risks and higher debt, and aggressive risk layering, unquote. Quote, we face two stark choices, stay the course, or meet the market where the market is, unquote, Lund said. If Fannie Mae stayed the course, it would maintain its credit discipline, protect the quality of its book, preserve capital, and intensify the company's public voice on concerns. However, it would also face lower volumes and revenues, continued declines in market share, lower earnings, and a weakening of key customer relationships. It was simply a matter of relevance, former CEO Dan Mudd told the FCIC. Quote, if you're not relevant, you're unprofitable, and you're not serving the mission. And there was danger to profitability. I'm speaking more long-term than in any given quarter or any given year. So this was a real strategic rethinking, unquote. Lund saw significant obstacles to meeting the market. He noted Fannie's lack of capability and infrastructure to structure the types of riskier mortgage-backed securities offered by Wall Street. its unfamiliarity with the new credit risks, worries that the price of the mortgages wouldn't be worth the risk, and regulatory concerns surrounding certain products. At this and other meetings, Lund recommended studying whether the current market changes were cyclical or more permanent. But he also recommended that Fannie, quote, dedicate significant resources to develop capabilities to compete in any mortgage environment, unquote. Citibank executives also made a presentation to Fannie's board in July 2005, warning that Fannie was increasingly at risk of being marginalized, and that stay the course was not an option. Citibank proposed that Fannie expand its guarantee business to cover non-traditional products, such as Alt-A and subprime mortgages. Of course, as the second largest seller of mortgages to Fannie, Citibank would benefit from such a move. Over the next 2 years, Citibank would increase its sales to Fannie by more than a quarter, to $56 billion in the 2007 fiscal year, while more than tripling its sales of interest-only mortgages to $4 billion. Lund told the FCIC that in 2005, the board would adopt his recommendation. For the time being, Fannie would stay the course, while developing capabilities to compete with Wall Street in non-prime mortgages. In fact, however, internal reports show that by September 2005, the company had already begun to increase its acquisitions of riskier loans. By the end of 2005, its Alt-A loans were $181 billion, up from $147 billion in 2004 and $138 billion in 2003. Its loans without full documentation were $278 billion, up from $200 billion in 2003, and its interest-only mortgages were $75 billion in 2005, up from $12 billion in 2003. Note that these categories can overlap. For example, Alt-A loans may also lack full documentation. To cover potential losses from all of its business activities, Fannie had a total of $40 billion in capital at the end of 2005. Quote, plans to meet market share targets resulted in strategies to increase purchases of higher risk products, creating a conflict between prudent credit risk management and corporate business objectives, unquote. The Federal Housing Finance Agency, the successor to the Office of Federal Housing Enterprise Oversight, would write in September 2008, on the eve of the government takeover of Fannie Mae. Quote, since 2005, Fannie Mae has grown its Alt-A portfolio and other higher risk products rapidly without adequate controls in place, unquote. In its financial statements, Fannie Mae's disclosures about key loan characteristics changed over time, making it difficult to discern the company's exposure to subprime and Alt-A mortgages. For example, from 2005 until 2007, the company's definition of a subprime loan was one originated by a company or a part of a company that specialized in subprime loans. Using that definition, Fannie Mae stated that subprime loans accounted for less than 1% of its business volume during those years, even while it reported that 5% of its conventional single-family loans in 2005, 2006, and 2007 loans were to borrowers with FICO scores less than 620. Similarly, Freddie had enlarged its portfolios quickly with limited capital. In 2005, CEO Richard Siren fired David Androukonis, Freddie's longtime chief risk officer. Siren said one of the reasons that Androukonis was fired was that Androukonis was concerned about relaxing underwriting standards to meet mission goals. He told the FCIC, quote, I had a legitimate difference of opinion on how dangerous it was. Now, as it turns out, he was able to foresee the market better than a lot of the rest of us could, unquote. The new risk officer, Anurag Sankasa, recounted to the FCIC staff that he repeatedly made the case for increasing capital to compensate for the increasing risk. Although Donald Vicinius, Freddie's executive vice president for single-family housing, told FCIC staff that he did not recall such discussions. Cyron never made Sanxina part of the senior management team. OFHEO, the GSE's regulator, noted their increasing purchases of riskier loans and securities in every examination report. But OFHEO never told the GSEs to stop. Rather, year after year, the regulator said that both companies had adequate capital, strong asset quality, prudent credit risk management, and qualified and active officers and directors. In May 2006, at the same time as it paid a $400 million penalty related to deficiencies in its accounting practices, Fannie agreed to limit its on-balance sheet mortgage portfolio to $728 billion, the level on December 31, 2005. 2 months later, Freddie agreed to limit the growth of its portfolio to 2% per year. In examination reports for the year 2005, issued to both companies in May 2006, OFHEO noted the growth in purchases of risky loans and non-GSE securities, but concluded that each GSE had strong asset quality and was adequately capitalized. OFHEO reported that management at Freddie was committed to resolving weaknesses, and its board was qualified and active. The 2005 examination of Fannie was limited in scope, focusing primarily on the company's efforts to fix accounting and internal control deficiencies. Because of the extensive resources needed to complete a 3-year special examination initiated in the wake of Fannie's accounting scandal. In that special examination, OFHEO pinned many of the GSE's problems on their corporate cultures. Its May 2006 special examination report on Fannie Mae detailed the arrogant and unethical corporate culture where Fannie Mae employees manipulated accounting and earnings to trigger bonuses for senior executives from 1998 to 2004. OFHEO Director James Lockhart, who had assumed that position the month the report was issued, recalled discovering during the special examination an email from Mudd, then Fannie's chief operating officer, to CEO Franklin Raines. Mudd wrote, quote, "The old political reality at Fannie was that we always won. We took no prisoners. We used to be able to write or have written rules that worked for us," unquote. Soon after his arrival, Lockhart began advocating for reform. Quote, "The need for legislation was obvious, as OFHEO was regulating 2 of the largest and most systematically important U.S. financial institutions," unquote, he told the FCIC. But no reform legislation would be passed until July 30th, 2008, and by then it would be too late. End of Section 50. Section 51 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9, 2006, Increase Our Penetration into Subprime. After several years during which Fannie Mae purchased riskier loans and securities, then Chief Financial Officer Robert Levin proposed a strategic initiative to, quote, "increase our penetration into subprime," unquote, at Fannie's January 2006 board meeting. In the next month, the board gave its approval. Fannie would become more and more aggressive in its purchases. During a summer retreat for Fannie's senior officers, as Stephen Ashley, the chairman of the board, introduced Fannie's new chief risk officer, Enrico Dalla Vecchia, he declared that the new CRO would not stand in the way of risk-taking. Quote, "We have to think differently and creatively about risk. about compliance, and about controls. Historically, these have not been strong suits of Fannie Mae. Today's thinking requires that these areas become active partners with the business units and be viewed as tools that enable us to develop product and address market needs. Enrico Della Vecchia was not brought on board to be a business dampener, unquote. In 2006, Fannie acquired $516 billion of loans. Of those, including some overlap, $65 billion, or about 13%, had combined loan-to-value ratios above 95%. 15% were interest-only, and 28% did not have full documentation. Fannie also purchased $36 billion of subprime and $12 billion of Alt-A non-GSE mortgage-backed securities. The total amount of riskier loans represented larger multiples of capital than before. At least initially, while house prices were still increasing, the strategic plan to increase risk and market share appeared to be successful. Fannie reported net income of $6 billion in 2005, and then $4 billion in 2006. In those 2 years, CEO Mudd's compensation totaled $24.4 million, and Levin, who was interim CFO and then chief business officer, received $15.5 million. In 2006, Freddie Mac also continued to increase risk, quote, expanding the purchase and guarantee of higher-risk mortgages to increase market share, meet mission goals, stay competitive, and be responsive to sellers' needs, unquote. It lowered its underwriting standards, increasing the use of credit policy waivers and exceptions. Newer alternative products, offered to a broader range of customers than ever before, accounted for about 24% of that year's purchases. Freddie Mac's plan also seemed to be successful. The company increased risk and market share while maintaining the same net income for 2005 and 2006, $2 billion. CEO Richard Siron's compensation totaled $23.2 million for 2005 and 2006 combined, while Chief Operating Officer Eugene McQuaid received $13.4 million. Again, OFHEO was aware of these developments. Its March 2007 report noted that Fannie's new initiative to purchase higher-risk products included a plan to capture 20% of the subprime market by 2011, and OFHEO reported that credit risk increased slightly because of growth in subprime and other non-traditional products. But overall asset quality in its single-family business was found to be strong, and the board members were qualified and active, and of course, Fannie was adequately capitalized. Similarly, OFHEO told Freddie in 2007 that it had weaknesses that raised some possibility of failure, but that overall, Freddie's strength and financial capacity made failure unlikely. Freddie did remain a significant supervisory concern, and OFHEO noted the significant shift toward higher-risk mortgages. But again, as in previous years, the regulator concluded that Freddie had adequate capital, and its asset quality and credit risk management were strong. The GSEs charged a fee for guaranteeing payments on GSE mortgage-backed securities, and OFHEO was silent about Fannie's practice of charging less to guarantee securities than their models indicated was appropriate. Mark Weiner, the head of Fannie's Business Analysis and Decisions Group since May 2006, and the person responsible for modeling pricing fees, raised concerns that Fannie Mae was not charging fees for Alt-A mortgages that adequately compensated for the risk. Weiner recalled that Levin was critical of his models, asking, quote, "Can you show me why you think you're right and everyone else is wrong?" unquote. Undercharging for the guarantee fees was intended to increase market share, according to Todd Hempstead, the senior vice president at Fannie in charge of the Western region. Mudd acknowledged the difference between the model fee and the fee actually charged, and also told the FCIC that the scarcity of historical data for many loans caused the model fee to be unreliable. In the September 6, 2008 memo that would recommend that Fannie be placed into conservatorship, OFHEO would expressly cite this practice as unsafe and unsound. Quote, during 2006 and 2007, modeled loan fees were higher than actual fees charged, due to an emphasis on growing market share and competing with Wall Street and the other GSE. Unquote. 2007, moving deeper into the credit pool. By the time housing prices had peaked in the second quarter of 2006, delinquencies had started to rise. During the board meeting held in April 2007, Lund said that dislocation in the housing market was an opportunity for Fannie to reclaim market share. At the same time, Fannie would support the housing market by increasing liquidity. At the next month's meeting, Lund reported that Fannie's market share could increase to 60%, from about 37% in 2006. Indeed, in 2007, Fannie Mae forged ahead, purchasing more high-risk loans. Fannie also purchased $16 billion of subprime non-GSE securities and $5 billion of Alt-A. In June, Fannie prepared its 2007 five-year strategic plan, titled Deepen Segments, Develop Breadth. The plan, which mentioned Fannie's tough new challenges, a weakening housing market and slower-growing mortgage debt market, included taking and managing more mortgage credit risk, moving deeper into the credit pool to serve a large and growing part of the mortgage market. Overall, revenues and earnings were projected to increase in each of the following 5 years. Management told the board that Fannie's risk management function had all the necessary means and budget to act on the plan. Chief Risk Officer Dalla Vecchia did not agree, especially in light of a planned 16% cut in his budget. In a July 16, 2007 email to CEO Mudd, Dalla Vecchia wrote that he was very upset that he had to hear at the board meeting that Fannie had, quote, the will and the money to change our culture and support taking more credit risk, unquote, given the proposed budget cut for his department in 2008 after a 25% reduction in headcount in 2007. In an earlier email, Dalla Vecchia had written to Chief Operating Officer Michael Williams that Fannie had, quote, one of the weakest control processes that he had ever witnessed in his career, was not even close to having proper control processes for credit, market, and operational risk, and was already back to the old days of scraping on controls to reduce expenses, unquote. These deficiencies indicated that, quote, people don't care about the risk function, or they don't get it, unquote. Mudd responded, quote, my experience is that email is not a very good venue for conversation, venting, or negotiating, unquote. If Dalla Vecchia felt that he'd been dealt with in bad faith, he should, quote, address it man to man, unquote, unless he wanted Mudd, quote, to be the one to carry messages for you to your peers, unquote. Mudd concluded, quote, please come and see me today, face to face, unquote. Dalla Vecchia told the FCIC that when he wrote this email, he was tired and upset, and that the view it expressed was more extreme than what he thought at the time. Fannie, after continuing to purchase and guarantee higher-risk mortgages in 2007, would report a $2.1 billion net loss for the year, caused by credit losses. In 2007, Mudd's compensation totaled $11.6 million, and Levin's totaled $7 million. In 2007, Freddie Mac also persisted in increasing purchases of riskier loans. A strategic plan from March highlighted pressure on the franchise and the risk of falling below our return aspirations. The company would try to improve earnings by entering adjacent markets. Quote, Freddie Mac has competitive advantages over non-GSE participants in non-prime, unquote, the strategy document explained. Quote, we have an opportunity to expand into markets we have missed, subprime and Alt-A, unquote. It took that opportunity. As OFHEO would note in its 2007 examination report, Freddie purchased and guaranteed loans originated in 2006 and 2007 with higher risk characteristics, including interest-only loans, loans with FICO scores less than 620, loans with higher loan-to-value ratios, loans with high debt-to-income ratios, and loans without full documentation. Financial results in 2007 were poor, a $3.1 billion net loss driven by credit losses. The value of the $152 billion subprime and Alt-A private label securities book suffered a $13 billion decline in market value. In 2007, Siren's compensation totaled $18.3 million, and McQuaid's totaled $3.8 billion. End of section 51. Section 52 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 9. Affordable Housing Goals? GSEs cried bloody murder forever. As discussed earlier, beginning in 1978, the Department of Housing and Urban Development, or HUD, periodically set goals for the GSEs related to increasing home ownership among low and moderate income borrowers and borrowers in underserved areas. Until 2005, these goals were based on the fraction of the total mortgage market made up of low and moderate income families. The goals were intended to be only a modest reach beyond the mortgages that GSEs would normally purchase. From 1997 to 2000, 42% of GSE purchases were required to meet goals for low and moderate income borrowers. In 2001, the goal was raised to 50%. Mudd said that as long as the goals remained below half of the GSE's lendings, loans made in the normal course of business would satisfy the goals. Quote, what comes in the door through the natural course of business will tend to match the market, and therefore will tend to meet the goals, unquote. Levin told the FCIC that, quote, there was a great deal of business that came through normal channels that met goals, unquote, and that most of the loans that satisfied the goals would have been made anyway. In 2004, HUD announced that starting in 2005, 52% of the GSE's purchases would need to satisfy the low and moderate income goals. The targets would reach 55% in 2007 and 56% in 2008. Given the dramatic growth in the number of riskier loans originated in the market, the new goals were closer to where the market really was. But, as Mudd noted, quote, when 50% became 57% ultimately, then you have to work harder, pay more attention, and create a preference for those loans. Targeted goals loans made specifically to meet the targets, while always a small share of the GSE's purchases, rose in importance. Mudd testified that by 2008, when the housing market was in turmoil, Fannie Mae could no longer balance its obligations to shareholders with its affordable housing goals and other mission-related demands. Quote, there may have been no way to satisfy 100% of the myriad demands for Fannie Mae to support all manner of projects or housing goals which were set above the origination levels in the marketplace, unquote. As the combined size of the GSEs rose steadily, from $3.6 trillion in 2003 to $4.9 trillion in 2007, the number of mortgage borrowers that the GSEs needed to serve in order to fulfill the affordable housing goals also rose. By 2005, Fannie and Freddie were stretching to meet the higher goals, according to a number of GSE executives, OFHEO officials and market observers. Yet all but 2 of the dozens of current and former Fannie Mae employees and regulators interviewed on the subject told the FCIC that reaching the goals was not the primary driver of the GSEs' purchases of riskier mortgages and of subprime and Alt-A non-GSE mortgage-backed securities. Executives from Fannie, including Mudd, pointed to a mix of reasons for the purchases, such as reversing the declines in market share, responding to originators' demands, and responding to shareholder demands to increase market share and profits, in addition to fulfilling the mission of meeting affordable housing goals and providing liquidity to the market. For example, Levin told the FCIC that while Fannie, to meet its housing goals, did purchase some subprime mortgages and mortgage-backed securities it would otherwise have passed up, Fannie was driven to meet the market and to reverse declining market share. On the other hand, he said that most Alt-A loans were high-income oriented and would not have counted toward the goals, so those were purchased solely to increase profits. Similarly, Lund told the FCIC that the desire for market share was the main driver behind Fannie's strategy in 2006. Housing goals had been a factor, but not the primary one. And Dalla Vecchia likewise told the FCIC that Fannie increased its purchases of Alt-A loans to regain relevance in the market and meet customer needs. Hempstead, Fannie's principal contact with Countrywide, told the FCIC that while housing goals were one reason for Fannie's strategy, the main reason Fannie entered the riskier mortgage market was that those were the types of loans being originated in the primary market. If Fannie wanted to continue purchasing large quantities of loans, the company would need to buy riskier loans. Kenneth Bacon, Fannie's executive vice president of multifamily lending, said much the same thing, and added that shareholders also wanted to see market share and returns rise. Former Fannie Chairman Stephen Ashley told the FCIC that the change in strategy in 2005 and 2006 was owed to a mix of reasons, including the desire to regain market share and the need to respond to pressures from originators, as well as to pressures from real estate industry advocates to be more engaged in the marketplace. To ensure an adequate supply of mortgages, in case the goals were not met in the normal course of business, Fannie and Freddie instituted outreach programs in underserved geographic areas and conducted educational programs for originators and brokers. In addition, as explained by Mike Quinn, the Fannie executive responsible for the goals, Fannie set lower fees on loans that met the goals, although they would not purchase mortgages that fell outside its predetermined risk targets. Ashley also maintained that Fannie did not shift eligibility or underwriting standards to meet goals, but instead directed its resources to marketing and promotional efforts, housing fairs, and outreach programs run by the company's partnership offices. Quote, "The effort was really in the outreach, as opposed to reduced or diminished or loosened standards," unquote, Ashley told the FCIC. Former OFHEO Director Armando Falcon Jr. testified that the GSEs invested in subprime and Alt-A mortgages in order to increase profits and regain market share, and that any impact on meeting affordable housing goals was simply a byproduct of this activity. Lockhart, a subsequent OFHEO director, attributed the GSE's change in strategy to their drive for profit and market share, as well as the need to meet housing goals, noting that the affordable housing goals increased markedly in 2005. He said in an FCIC interview that the, quote, "goals were just one reason, certainly not the exclusive reason," unquote, for the change. These views were corroborated by numerous other officials from the agency. The former HUD official, Mike Price, told the FCIC that while the, quote, "GSEs cried bloody murder forever," unquote, when it came to the goals, they touted their contribution to increasing home ownership. In addition, Price and other HUD officials told the FCIC that the GSEs never claimed that meeting the goals would leave them in an unsafe or unsound condition. Indeed, the law allowed both Fannie Mae and Freddie Mac to fall short of meeting housing goals that were infeasible or that would affect the company's safety and soundness. And while the GSEs often exceeded the goals, in some cases those targets were adjusted downward by HUD, or in rare cases were simply missed by the GSEs. For example, on December 12, 2007, MUD wrote to HUD, quote, Fannie Mae believes that the low and moderate income and special affordable subgoals are infeasible for 2007, unquote. Fannie Mae's 2007 strategic plan had already anticipated such a communication, stating, quote, in the event we reach a viewpoint that achieving the goals this year is infeasible, we will determine how best to address the matter with HUD, and will continue to keep the board apprised accordingly, unquote. In fact, both Fannie and Freddie appealed to HUD to lower two components of the goals for affordable housing. HUD complied and allowed the GSEs to fall short without any consequences. The impact of the goals. At least until HUD set new affordable housing goals for 2005, the GSEs only supplemented their routine purchases with a small volume of loans and non-GSE mortgage-backed securities needed to meet their requirements. The GSEs knew that they might not earn as much on these targeted goal loans as they would earn on both goal-qualifying and non-goal qualifying loans purchased in the usual course of business. On some of these loans, they might even lose money. The organizations also had administrative and other costs related to the housing goals. In June 2009, Freddie Mac's staff made a presentation to the Business and Risk Committee of the Board of Directors on the costs of meeting its goals. From 2000 to 2003, the cost of the targeted goal loans was effectively zero, as the goals were reached through profitable expansion of the company's multifamily business. During the refinance boom, the goals became more challenging and cost Freddie money in the multifamily business. Thus, only after 2004 did meeting the multifamily and single-family goals cost the GSE money. Still, only about 4% of all loans purchased by Freddie between 2005 and 2008 were bought, quote, specifically because they contribute to the goals, unquote. Loans it labeled as targeted affordable. These loans did have higher than average expected default rates, although Freddie also charged a higher fee to guarantee them. From 2003 through 2008, Freddie's costs of complying with the housing goals averaged $200 million annually. The costs of complying with these goals took into account three components: expected revenues, expected defaults, and foregone revenues, based on an assumption of what they might have earned elsewhere. These costs were only computed on the narrow set of loans specifically purchased to achieve the goals, as opposed to goal-qualifying loans purchased in the normal course of business. For comparison, the company's net earnings averaged just under $3 billion per year from 2003 to 2006. In 2004, Fannie Mae retained McKinsey and Citigroup to determine whether it would be worthwhile to give up the company's charter as a GSE, which, while affording the company enormous benefits, imposed regulations and put constraints on business practices, including its mission goals. The final report to Fannie Mae's top management, called Project Phineas, found that the explicit cost of compliance with the goals from 2000 to 2003 was close to zero. Quote, it is hard to discern a fundamental marginal cost to meeting the housing goals on the single-family business side, unquote. The report came to this conclusion despite the slightly greater difficulty of meeting the goals in the 2003 refinancing boom. The large number of homeowners refinancing, in particular those who were middle and upper income, necessarily reduced the percentage of the pool that would qualify for the goals. In calculating these costs, the consultants computed the difference between fees charged on goal-qualifying loans and the higher fees suggested by Fannie's own models. But this cost was not unique to goal-qualifying loans. Across its portfolio, Fannie charged lower fees than its models computed for goals loans as well as for non-goals loans. As a result, goals loans, even targeted goals loans, were not solely responsible for this cost. In fact, Fannie's discount was actually smaller for many goal-qualifying loans than for the others from 2000 to 2004. Facing more aggressive goals in 2006 and 2007, Fannie Mae expanded initiatives to purchase targeted goals loans. These included mortgages acquired under the My Community Mortgage program, mortgages underwritten with looser standards, and manufactured housing loans. For these loans, Fannie explicitly calculated the opportunity cost, foregone revenues based on an assumption of what they might have earned elsewhere, along with the so-called cash flow cost, or the difference between their expected losses and expected revenue on these loans. For 2006, as the market was peaking, Fannie Mae estimated the cash flow cost of the loans to be $115 million, and the opportunity cost of the targeted goals loans, $390 million, compared to net income that year to Fannie of $4.1 billion, a figure that includes returns on the goal qualifying loans made during the normal course of business. The targeted goals loans amounted to $18 billion, or 3.4% of Fannie Mae's $524 billion of single-family mortgage purchases in 2006. As the markets tightened in the middle of 2007, the opportunity cost for that year was forecast to be roughly $1 billion. Looking back at how the targeted affordable portfolio performed in comparison with overall losses, the 2009 presentation at Freddie Mac took the analysis of the goals costs one step further. While the outstanding $60 billion of these targeted affordable loans was only 4% of the total portfolio, these were relatively high-risk loans and were expected to account for 19% of total projected losses. In fact, as of late 2008, they had accounted for only 8% of losses, meaning that they had performed better than expected in relation to the whole portfolio. The company's major losses came from loans acquired in the normal course of business. The presentation noted that many of these defaulted loans were Alt-A. End of section 52. Section 53 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Commission conclusions on Chapter 9. The Commission concludes that firms securitizing mortgages failed to perform adequate due diligence on the mortgages they purchased, and at times knowingly waived compliance with underwriting standards. Potential investors were not fully informed, or were misled, about the poor quality of the mortgages contained in some mortgage-related securities. These problems appear to have been significant. The Securities and Exchange Commission failed to adequately enforce its disclosure requirements governing mortgage securities, exempted some sales of such securities from its review, and preempted states from applying state law to them, thereby failing in its core mission to protect investors. The Federal Reserve failed to recognize the cataclysmic danger posed by the housing bubble to the financial system and refused to take timely action to constrain its growth, believing that it could contain the damage from the bubble's collapse. Lax mortgage regulation and collapsing mortgage lending standards and practices created conditions that were ripe for mortgage fraud. End of Section 53 and end of Chapter 9. Section 54 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 10, The Madness. The collateralized debt obligation machine could have sputtered to a natural end by the spring of 2006. Housing prices peaked, and AIG started to slow down its business of insuring subprime mortgage CDOs. But it turned out that Wall Street didn't need its golden goose anymore. Securities firms were starting to take on a significant share of the risks from their own deals, without AIG as the ultimate bearer of the risk of losses on super senior CDO tranches. The machine kept humming along throughout 2006 and into 2007. Quote, that just seemed kind of odd, given everything we had seen and what we had concluded, unquote. Gary Gorton, a Yale finance professor who had designed AIG's model for analyzing its CDO positions, told the FCIC. The CDO machine had become self-fueling. Senior executives, particularly at three of the leading promoters of CDOs, Citigroup, Merrill Lynch, and UBS, apparently did not accept or perhaps even understand the risks inherent in the products they were creating. More and more, the senior tranches were retained by the arranging securities firms. The mezzanine tranches were bought by other CDOs, and the equity tranches were bought by hedge funds that were often engaged in complex trading strategies. They made money when the CDOs performed, but could also make money if the market crashed. These factors helped keep the mortgage market going long after house prices had begun to fall, and created massive exposures on the books of large financial institutions, exposures that would ultimately bring many of them to the brink of failure. The subprime mortgage securitization pioneer Louis Ranieri called the willing suspension of prudent standards the madness. He told the FCIC, quote, you had the breakdown of the standards because you break down the checks and balances that normally would have stopped them, unquote. Synthetic CDOs boomed. They provided easier opportunities for bullish and bearish investors to bet for and against the housing boom and the securities that depended on it. Synthetic CDOs also made it easier for investment banks and CDO managers to create CDOs more quickly. But synthetic CDO issuers and managers had two sets of customers, each with different interests. And managers sometimes had help from customers in selecting the collateral, including those who were betting against the collateral, as a high-profile case launched by the Securities and Exchange Commission against Goldman Sachs would eventually illustrate. Regulators reacted weakly. As early as 2005, supervisors recognized that CDOs and credit default swaps, or CDSs, could actually concentrate rather than diversify risk. But they concluded that Wall Street knew what it was doing. Supervisors issued guidance in late 2006 warning banks of the risks of complex structured finance transactions, but excluded mortgage-backed securities and CDOs because they saw the risks of those products as relatively straightforward and well understood. Disaster was fast approaching. CDO managers, we are not a rent-a-manager. During the madness, when everyone wanted a piece of the action, CDO managers faced growing competitive pressures. Managers' compensation declined as demand for mortgage-backed securities drove up prices, squeezing the profit they made on CDOs. At the same time, new CDO managers were entering the arena. Wing Chow, a CDO manager who frequently worked with Merrill Lynch, said the fees fell by half for mezzanine CDOs over time. and overall compensation could be maintained by creating and managing more new product. More than had been the case 3 or 4 years earlier, in picking the collateral, the managers were influenced by the underwriters, the securities firms that created and marketed the deals. An FCIC survey of 40 CDO managers confirmed this point. Sometimes managers were given a portfolio constructed by the securities firm. The managers would then choose the mortgage assets from that portfolio. The equity investors, who often initiated the deal in the first place, also influenced the selection of assets in many instances. Still, some managers said that they acted independently. Quote, "We are not a rent-a-manager. We actually select our collateral," unquote, said Loyal Foss, the general counsel at Vertical Capital. As we will see, securities firms often had particular CDO managers with whom they preferred to work. Merrill, the market leader, had a constellation of managers. CDOs underwritten by Merrill frequently bought tranches of other Merrill CDOs. According to market participants, CDOs stimulated greater demand for mortgage-backed securities, particularly those with high yields, and the greater demand, in turn, affected the standards for originating mortgages underlying those securities. As standards fell, at least one firm opted out. PIMCO, one of the largest investment funds in the country, whose CDO management unit was one of the nation's largest in 2004. Early in 2005, it announced that it would not manage any new deals, in part because of the deterioration in the credit quality of mortgage-backed securities. Quote, "There was an awful lot of moral hazard in the sector," unquote. Scott Simon, a managing director at PIMCO, told the audience at an industry conference in 2005, quote, "You either take the high road or you don't. We're not going to hurt accounts or damage our reputation for fees," unquote. Simon said the rating agencies' methodologies were not sufficiently stringent, particularly because they were being applied to new types of subprime and all-day loans with little or no historical performance data. Not everyone agreed with this viewpoint. Quote, "Managers who are sticking in this business are doing it right," unquote. Armand Pastine, the chief operating officer at Maxim Group, reported at the same conference. Quote, "To suggest that CDO managers would pull out of an economically viable deal for moral reasons, that's a cop-out," unquote. As was typical for the industry during the crisis, 2 of Maxim's 8 mortgage-backed CDOs, Maxim High Grade CDO 1 and Maxim High Grade CDO 2, would default on interest payments to investors, including investors holding bonds that had originally been rated AAA, and the other 6 would be downgraded to junk status, including all of those originally rated AAA. Another development also changed the CDOs. In 2005 and 2006, CDO managers were less likely to put their own money into their deals. Early in the decade, investors had taken the manager's investment in the equity tranche of their own CDOs to be an assurance of quality, believing that if the managers were sharing the risk of loss, they would have an incentive to pick collateral wisely. But this failsafe lost force as the amount of managers' investment per transaction declined over time. ACA Management, a unit of the financial guarantor ACA Capital, provides a good illustration of this trend. ACA held 100% of the equity in the CDOs it originated in 2002 and 2003, 52% and 61% of 2 deals it originated in 2004, between 10 and 25% of deals in 2005, and between 0% and 11% of deals in 2006. And synthetic CDOs, as we will see, had no fail-safe at all with regard to the manager's incentives, by the very nature of the credit default swaps bundled into these synthetics, Customers on the short side of the deal were betting that the assets would fail. End of section 54. Section 55 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 10, Credit Default Swaps, Dumb Question. In June 2005, derivatives dealers introduced the pay-as-you-go credit default swap, a complex instrument that mimicked the timing of the cash flows of real mortgage-backed securities. Because of this feature, the synthetic CDOs into which these new swaps were bundled were much easier to issue and sell. The pay-as-you-go swap also enabled a second major development, introduced in January 2006, the first index based on the prices of credit default swaps on mortgage-backed securities. Known as the ABX.HE, it was really a series of indices meant to act as a sort of Dow Jones Industrial Average for the non-prime mortgage market, and it became a popular way to bet on the performance of the market. Every 6 months, a consortium of securities firms would select 20 credit default swaps on mortgage-backed securities in each of the 5 ratings-based tranches: AAA, AA, single A, BBB, and BBB-. Investors who believed that the bonds in any given category would fall behind in their payments could buy protection through credit default swaps. As demand for protection rose, the index would fall. The index was therefore a barometer, recording the confidence of the market. Synthetic CDOs proliferated, in part because it was much quicker and easier for managers to assemble a synthetic portfolio out of pay-as-you-go credit default swaps than to assemble a regular cash CDO out of mortgage-backed securities. Quote, "The beauty, in a way, of these synthetic deals is you can look at the entire universe. You don't have to go and buy the cash bonds," unquote, said Laura Schwartz of ACA Capital. There were also no warehousing costs or associated risks, and they tended to offer the potential for higher returns on the equity tranches. One analyst estimated that the equity tranche on a synthetic CDO could typically yield about 21%, while the equity tranche of a typical cash CDO could pay 13%. An important driver in the growth of synthetic CDOs was the demand for credit default swaps on mortgage-backed securities. Greg Glipman, a Deutsche Bank mortgage trader, told the FCIC that he often brokered these deals, matching the shorts with the longs and minimizing any risk for his own bank. Lipman said that between 2006 and 2007, he brokered deals for at least 50 and maybe as many as 100 hedge funds that wanted to short the mezzanine tranches of mortgage-backed securities. Meanwhile, on the long side, quote, "Most of our CDS purchases were from UBS, Merrill, and Citibank because they were the most aggressive underwriters of synthetic CDOs," unquote. In many cases, they were buying those positions from Lipman to put them into synthetic CDOs. As it would turn out, the banks would retain much of the risk of those synthetic CDOs by keeping the super senior and AAA tranches, selling below AAA tranches largely to other CDOs, and selling the equity tranches to hedge funds. Issuance of synthetic CDOs jumped from $15 billion in 2005 to $61 billion just 1 year later. We include all CDOs with 50% or more synthetic collateral. Again, unless otherwise noted, our data refers to CDOs that include mortgage-backed securities. Even CDOs that were labeled as cash CDOs increasingly held some credit derivatives. A total of $225 billion in CDOs were issued in 2006, including those labeled as cash, hybrid, or synthetic. The FCIC estimates that 27% of the collateral was derivatives, compared with 9% in 2005 and 7% in 2004. The advent of synthetic CDOs changed the incentives of CDO managers and hedge fund investors. Once short investors were involved, the CDOs had two types of investors with opposing interests: those who would benefit if the assets performed, and those who would benefit if the mortgage borrowers stopped making payments and the assets failed to perform. Even the incentives of long investors became conflicted. Synthetic CDOs enabled sophisticated investors to place bets against the housing market or pursue more complex trading strategies. Investors, usually hedge funds, often used credit default swaps to take offsetting positions in different tranches of the same CDO security. That way, they could make some money as long as the CDOs performed, but they stood to make more money if the entire market crashed. An FCIC survey of more than 170 hedge funds, encompassing over $1.1 trillion in assets as of early 2010, found this to be a common strategy among medium-sized hedge funds. Of all the CDOs issued in the second half of 2006, more than half of the equity tranches were purchased by hedge funds that also shorted other tranches. The same approach was being used in the mortgage-backed securities market as well. The FCIC's survey found that by June 2007, the largest hedge funds held $25 billion in equity and other lower-rated tranches of mortgage-backed securities. These were more than offset by $45 billion in short positions. These types of trades changed the structured finance market. Investors in the equity and most junior tranches of CDOs and mortgage-backed securities traditionally had the greatest incentive to monitor the credit risk of an underlying portfolio. With the advent of credit default swaps, it was no longer clear who, if anyone, had that incentive. For one example, consider Merrill Lynch's $1.5 billion Norma CDO, issued in 2007. The equity investor, Magnetar Capital, a hedge fund, was executing a common strategy known as the correlation trade. It bought the equity tranche while shorting other tranches in Norma and other CDOs. According to court documents, Magnetar was also involved in selecting assets for Norma. Magnetar received $4.5 million related to this transaction, and NIR Capital Management, the CDO manager, was paid a fee of $75,000 plus additional fees. Magnetar's counsel told the FCIC that the $4.5 million was a discount in the form of a rebate on the price of the equity tranche and other long positions purchased by Magnetar, and not a payment received in return for goods or services. Court documents indicate that Magnetar was involved in selecting collateral, and that NIR abdicated its asset selection duties to Magnetar with Merrill's knowledge. In addition, they show that when one Merrill employee learned that Magnetar had executed approximately $600 million in trades for Norma without NIR's apparent involvement or knowledge, she emailed colleagues, quote, "dumb question, is Magnetar allowed to trade for NIR?" unquote. Merrill failed to disclose that Magnetar was paid $4.5 million, or that Magnetar was selecting collateral when it also had a short position that would benefit from losses. The counsel for Merrill's new owner, Bank of America, explained to the FCIC that it was a common industry practice for, quote, the equity investor in a CDO, which had the riskiest investment, to have input during the collateral selection process. However, the collateral manager made the ultimate decisions regarding portfolio composition, unquote. The letter did not specifically mention the Norma CDO. Bank of America failed to produce documents related to this issue requested by the FCIC. Federal regulators have identified abuses that involved short investors influencing the choice of the instruments inside synthetic CDOs. In April 2010, the SEC charged Goldman Sachs with fraud for telling investors that an independent CDO manager, ACA management, had picked the underlying assets in a CDO, when in fact a short investor, the Paulson and Company hedge fund, had played a significant role in the selection. The SEC alleged that those misrepresentations were in Goldman's marketing materials for Abacus 2007-AC1, one of Goldman's 24 Abacus deals. Ira Wagner, the head of Bear Stearns' CDO group in 2007, told the FCIC that he rejected the deal when approached by Paulson representatives. When asked about Goldman's contention that Paulson's picking the collateral was immaterial because the collateral was disclosed, and because Paulson was not well known at that time, Wagner called the argument ridiculous. He said that the structure encouraged Paulson to pick the worst assets, while acknowledging the point that every synthetic deal necessarily had long and short investors. Wagner saw having the short investors select the referenced collateral as a serious conflict, and for that reason declined to participate. ACA executives told the FCIC they were not initially aware that the short investor was involved in choosing the collateral. CEO Alan Roseman said he first heard of Paulson's role when he reviewed the SEC's complaint. Laura Schwartz, who was responsible for the deal at ACA, said she believed that Paulson's firm was the investor taking the equity tranche and would therefore have an interest in the deal performing well. She said she would not have been surprised that Paulson would also have had a short position because the correlation trade was common in the market, but added, quote, "To be honest, at that time, until the SEC testimony, I did not even know that Paulson was only short," unquote. Paulson told the FCIC that any synthetic CDO would have to invest in, quote, "a pool that both a buyer and seller of protection could agree on," unquote. He didn't understand the objections. Quote, "Every synthetic CDO has a buyer and seller of protection. So for anyone to say that they didn't want to structure a CDO because someone was buying protection in that CDO, then you wouldn't do any CDOs," unquote. In July 2010, Goldman Sachs settled the case, paying a record $550 million fine. Goldman, quote, "acknowledged that the marketing materials for the Abacus 2007 ACA1 transaction contained incomplete information. In particular, it was a mistake for the Goldman marketing materials to state that the reference portfolio was selected by ACA Management LLC without disclosing the role of Paulson and Company Incorporated in the portfolio selection process, and that Paulson's economic interests were adverse to CDO investors," unquote. The new derivatives provided a golden opportunity for bearish investors to bet against the housing boom. Home prices in the hottest markets in California and Florida had blasted into the stratosphere. It was hard for skeptics to believe that their upward trajectory could continue. And if it did not, the landing would not be a soft one. Some spoke out publicly. Others bet the bubble would burst. Betting against CDOs was also, in some cases, a bet against the rating agencies and their models. Jamie May and Ben Hockett, principals at the small investment firm Cornwall Capital, told the FCIC that they'd warned the SEC in 2007 that the agencies were dangerously over-optimistic in their assessment of mortgage-backed CDOs. May and Hockett saw the rating agencies as the root of the mess because their ratings removed the need for buyers to study prices and perform due diligence, even as, quote, "there was a massive amount of gaming going on," unquote. Shorting CDOs was pretty attractive because the rating agencies had given too much credit for diversification. Sihan Shu of Paulson and Company told the FCIC. Paulson established a fund in June 2006 that initially focused only on shorting BBB-rated tranches. By the end of 2007, Paulson and Company's Credit Opportunities Fund, set up less than a year earlier to bet exclusively against the subprime housing market, was up 590%. Quote, each MBS tranche typically would be 30% mortgages in California, 10% in Florida, 10% in New York. And when you aggregate 100 MBS positions, you still have the same geographic diversification. To us, there was not much diversification in CDOs, unquote. Shu's research convinced him that if home prices were to stop appreciating, BBB-rated mortgage-backed securities would be at risk for downgrades. Should prices drop 5%, CDO losses would increase 20-fold. And if a relatively small number of the underlying loans were to go into foreclosure, the losses would render virtually all of the riskier BBB-rated tranches worthless. Quote, the whole system worked fine as long as everyone could refinance, unquote. Steve Eisman, the founder of a fund within Front Point Partners, told the FCIC. The minute refinancing stopped, quote, losses would explode. By 2006, about half the mortgages sold were no doc or low doc. You were at max underwriting weakness, at max housing prices. And so the system imploded. Everyone was so levered there was no ability to take any pain, unquote. On October 6, 2006, James Grant wrote in his newsletter about the mysterious alchemical processes in which, quote, Wall Street transforms BBB- rated mortgages into AAA-rated tranches of mortgage securities, unquote, by creating CDOs. He estimated that even the AAA tranches of CDOs would experience some losses if national home prices were to fall just 4% or less within 2 years. And if prices were to fall 10%, investors of tranches rated AA- or below would be completely wiped out. In 2005, Eisman and others were already looking for the best way to bet on this disaster by shorting all these shaky mortgage-related securities. Buying credit default swaps was efficient. Eisman realized that he could pick what he considered the most vulnerable tranches of the mortgage-backed bonds and bet millions of dollars against them, relatively cheaply and with considerable leverage. And that's what he did. By the end of 2007, Eisman had put millions of dollars into short positions on credit default swaps. It was, he was sure, just a matter of time. Quote, everyone really did believe that things were going to be okay, unquote, Eisman said. Quote, I thought they were certifiable lunatics, unquote. Michael Burry, another short who became well known after the crisis hit, was a doctor turned investor whose hedge fund, Scion Capital, in Northern California's Silicon Valley, bet big against mortgage-backed securities, reflecting a change of heart because he had invested in home builder stocks in 2002. But the closer he looked, the more he wondered about the financing that supported this booming market. Burry decided that some of the newfangled adjustable rate mortgages were, quote, the most toxic mortgages, quote, unquote, created. He told the FCIC, quote, I watched those with interest as they migrated down the credit spectrum to the subprime market. As home prices had increased on the back of virtually no accompanying rise in wages and incomes, I came to the judgment that in 2 years there will be a final judgment on housing when those 2-year adjustable rate mortgages seek refinancing, unquote. By the middle of 2005, Burry had bought credit default swaps on billions of dollars of mortgage-backed securities and the bonds of financial companies in the housing market, including Fannie Mae, Freddie Mac, and AIG. Eisman, Cornwall, Paulson, and Burry were not alone in shorting the housing market. In fact, on one side of tens of billions of dollars worth of synthetic CDOs were investors taking short positions. The purchasers of credit default swaps illustrate the impact of derivatives in introducing new risks and leverage into the system. Although these investors profited spectacularly from the housing crisis, they never made a single subprime loan or bought an actual mortgage. In other words, they were not purchasing insurance against anything they owned. Instead, they merely made side bets on the risks undertaken by others. Paulson told the FCIC that his research indicated that if home prices remained flat, losses would wipe out the BBB-rated tranches. Meanwhile, at the time, he could purchase default protection on them very cheaply. On the other side of the zero-sum game were often the major U.S. financial institutions that would eventually be battered. Burry acknowledged to the FCIC, quote, "There is an argument to be made that you shouldn't allow what I did," unquote. But the problem, he said, was not the short positions he was taking. It was the risks that others were accepting. Quote, "When I did the shorts, the whole time I was putting on the positions. There were people on the other side that were just eating them up. I think it's a catastrophe, and I think it was preventable," unquote. Credit default swaps greased the CDO machine in several ways. First, they allowed CDO managers to create synthetic and hybrid CDOs more quickly than they could create cash CDOs. Second, they enabled investors in the CDOs, including the originating banks, such as Citigroup and Merrill, to transfer the risk of default to the issuer of the credit default swap, such as AIG and other insurance companies. Third, they made correlation trading possible. As the FCIC survey revealed, most hedge fund purchases of equity and other junior tranches of mortgage-backed securities and CDOs were done as part of complex trading strategies. As a result, credit default swaps were critical to facilitate demand from hedge funds for the equity or other junior tranches of mortgage-backed securities and CDOs. Finally, they allowed speculators to make bets for or against the housing market without putting up much cash. On the other hand, it can be argued that credit default swaps helped end the housing and mortgage-backed securities bubble. Because CDO arrangers could more easily buy mortgage exposure for their CDOs through credit default swaps than through actual mortgage-backed securities, demand for credit default swaps may in fact have reduced the need to originate high-yield mortgages. In addition, some market participants have contended that without the ability to short the housing market via credit default swaps, the bubble would have lasted longer. As we will see, the declines in the ABX index in late 2006 would be one of the first harbingers of market turmoil. Quote, "Once pessimists can, in effect, sell short via the CDS, prices must reflect their views, and not just the views of the leveraged optimists," unquote. John Giannakopoulos, a Yale economics professor and a partner in the hedge fund Ellington Capital Management, which both invested in and managed CDOs, told the FCIC. End of section 55.